when we talk about start discussing about India's 103, which deals with business combinations, there is one such very important amendment or an introduction into India's 103 which has been done recently in 2020. There's a certain adjustment or an amendment which has happened in India's 103, where he introduced the concept of concentration test. Listen to this word very carefully. They've introduced the concept of concentration test in determining whether there is a business which has been acquired or is it just an acquisition of an asset. I am only trying to differentiate whether this is an acquisition of an asset or it is an acquisition of a business. To determine this, they have introduced something called as concentration test. What is this concentration test? What does it determine? A concentration test is optional, is only optional. If an enterprise wants to adopt a concentration test in determining whether it is a business being taken over or is it only an asset or a group of assets of similar nature being taken over, they can apply this concentration test, or else they can go on with the definition of business by itself. Clear? So concentration test is a new addition and becomes really important for our discussion perspective. Let's see what is this concentration test. Concentration test. Latest introduction into your India's 103, guys. When I talk about this word concentration test, it talks about something called as optional. It says this is optional. If let's say this test results are satisfied, if it is satisfied, then it should be considered as acquisition of assets it is considered as acquisition of assets. If it is not satisfied, then I can consider it as business combination under Ind AS 103. Subjected to further check of definition of business, guys. But I'm saying this test is optional. If it is satisfied, then it should not be considered as a business combination. It is just an acquisition of assets or group of similar assets or a group of similar assets. But if it is not satisfied, it can be considered as a business combination. This is what he's saying as far as concentration test is concerned. Now, what is this concentration test? How do I apply these principles of concentration test? Let us see. Application of concentration test. The application of concentration test should be divided into three parts, where I'll do three things to determine whether the concentration test is satisfied or not. What are the three things that I have to do? Number one, first measure the fair value of the gross assets acquired. First, I'm saying, first assess the first measure what is the fair value of the gross assets acquired. Measure fair value of gross assets acquired. I'll tell you how do I measure this fair value of gross assets acquired. But for that, let me first complete those 3 steps. First one is to measure the fair value of gross assets acquired. Number 2, identify a single identifiable group or a single identifiable asset. Identify a single identifiable asset or group of similar assets or a group of similar assets. Then I'll go into part C. What is part A? First, you determine the fair value of gross assets acquired. Part B, identify what is a single identifiable asset or a group of similar assets which are acquired. And finally, I'll go into the last one, determine if substantially the value that you have determined in part A, which is nothing but the gross value, the fair value of gross assets acquired, is concentrated in the value determined as per part B, which is a single identifiable asset or a group of similar identifiable assets. Clear? Assess whether the fair value of group assets determined in A is concentrated in fair value of asset or group of similar assets determined in part B. On assessment of part C, if your answer is yes, that means the fair value of the group assets acquired is concentrated or substantially the amount of fair value of assets or similar assets or group of assets acquired in part B, then you can say that the concentration test is satisfied. If concentration test is satisfied, then it is not a business combination. It is only an acquisition of asset or a group of assets. Clear? If your answer to part C is no, that means the fair value of the group assets identified in part A are substantially not concentrated in the fair value of asset or group of assets acquired in part B, then you can consider it as a business combination as per Ind AS 103. Clear? Any doubt so far that you got? Now, let us look at this. Remember, I said I will tell you how to assess part A. First, part A. What is part A? Fair value or fair value of gross assets or group assets acquired. What is the gross value or measure of fair value of group assets acquired? How do I identify this value or fair value of gross assets acquired? Guys, it is gross assets, guys. While I wrote part C, I wrote it as group assets. How do I measure this? Fair value of gross assets acquired again. To measure this fair value of gross assets acquired, I'll take 3 things into consideration. What are the 3 things which I have to consider? First one, part 1, The first part where I will start considering what is the fair value of consideration transferred. First one, fair value of consideration transferred. Guys, to determine fair value of consideration transferred, I should include three things. First one, my purchase consideration, at what value I am acquiring it. Number two, fair value of investments already held. In acquiry, if I already held some investments in the acquiry and additionally I'm acquiring another part of it, now fair value of NCI. In the acquiry, a combination of these three things is equal to fair value of consideration transferred. That is the first part. So fair value of gross assets acquired includes fair value of consideration transferred. What is the second part? Fair value of liabilities assumed. Fair value of liabilities assumed. What do you mean by fair value of liabilities assumed? That means these liabilities are also being taken over. Acquirer is not just taking over asset, but also taking over liabilities as well. In such cases, we'll call it as fair value of liabilities assumed. Part 3 is talking about exclusion. What should be excluded? The exclusion is basically for cash and cash equivalents, your deferred tax asset, and goodwill. Excludes three things. First one, cash and cash equivalents. Second one, deferred tax asset, which we have determined as per Ind AS 12. And finally, goodwill. These three should be excluded. So how do I calculate fair value of gross assets acquired? I'll calculate like this. Fair value of gross assets acquired is equal to part 1 plus part 2 minus part 3, which is nothing but fair value of consideration transferred plus fair value of liabilities assumed minus fair value of, minus cash and cash equivalents, deferred tax asset, and goodwill. In these three ways, I will identify what is the fair value of gross assets acquired. This is your part A in concentration test. This part A which I calculated, I will identify what is part B. What is the single identifiable asset or a group of similar assets? A and B, once I determine, I'll come down to C and I will see if A is substantially equal to B, or the value of A, that is the fair value of gross assets acquired, is concentrated in the fair value of identifiable asset. Then in such case, the concentration test is satisfied. Let's understand with the help of example. Let's say this is my acquirees business. In this acquiry, let's say I have a land and building to the extent of 100, Along with that, there is a cash, which is 20. And there also exists a deferred tax asset. And there also exists a deferred tax asset to the extent of 10. Okay. They had an equity share capital of 100. They had an equity share capital of 100, and they had other liabilities for purchase of that land and building, which was to the extent of 30, and there the balance sheet has actually tallied at 130. In this particular case, let's say the acquirer is already holding investments in the acquiry. To what extent? Holds 20% investment in acquiry. Now acquires 50% in acquiry. Now he acquires 50% in acquiry. At what price did he acquire in acquiry? Let's say he has acquired 50% in acquiry at the rate of rupees 55. Okay. Lastly, sufficient, right? I got off 70%. So 20% plus 50% is 70%. I got holding controlling interest. Now, let's apply this test now. Let us start with the first part. What is the fair value of gross assets acquired? Part A. What is fair value of gross assets acquired? Let's say the fair value of gross assets acquired include three parts. First one, part A, first one is nothing but the fair value of consideration transferred. Fair value of consideration. How do I determine fair value of consideration? Again, I broke it down into three parts. First one is your consideration. For 50%. How much did I pay for 50%? I paid 55 rupees for 50%. Correct? Number two, second part. Fair value of investments existing. Fair value of investment in acquiry already held by acquirer. How much did he already holds? That is 20% investment which he already held. Fair value, if 50% is 55, what is 20%? 22. Correct? Part 3. Fair value of NCI. What is your fair value of NCI? NCI here is 30%. If 20% is 22, 50% is 55, then NCI is 33. Total being 110. This is the fair value of gross assets acquired. Correct? Now, that is fair value of consideration transferred. Now, what do I do? Add fair value of liabilities assumed. Part B. fair value of liability assumed. What is the liability which relates to land and building which is being acquired now? Is 30 plus 30 minus part C, exclusions relating to cash and cash equivalents, and also an exclusion which relates to deferred tax asset. How much is cash and cash equivalents? 20 rupees. Deferred tax asset? 10 rupees. So that means the total amount of fair value of gross assets acquired is exactly 110. Is exactly 110. Now let's get into the second part, that is part B. What is part B? Fair value of an identifiable asset or group of similar assets, similar identifiable assets. Here, what is the only identifiable asset that you find in the balance sheet? Look at the balance sheet of acquiry and tell me what is a single identifiable asset or similar assets that you find in acquiry? Only land and building. Only land and building. So the major identifiable asset which I get is land and building. What is the fair value of that land and building? I'm assuming that my carrying value is equal to fair value, and let's say it is 100. I assume that fair value is equal to carrying value. Fair value is equal to carrying value. This is my assumption. That's why I took it as 100. Now determine your part C. Now tell me, what is your part C? Is your fair value of consideration or gross assets acquired, which is 110, substantially or concentrated in fair value of individual assets acquired? Part A is concentrated in part B. Fair value of gross assets acquired is substantially equal to the fair value of identifiable asset or a group of similar identifiable asset. Because if I look at this is 100 by 110, which is something coming around to 90.9 percentage or 91 percentage. Therefore, it is concentrated. Therefore, your concentration test is satisfied. If the concentration test is satisfied, I will not perform business acquisition. I will not perform your acquisition as per Ind AS 103, but instead, I will consider it as assets taken over. I'll only consider it as acquisition of the asset. So in the given example, what did they acquire? They only acquired the land and building. It cannot be considered as business acquisition where you apply Ind AS 103. You simply adopt Ind AS 16 and try to calculate what is the amount of what is the value at which the land and building is acquired. So therefore, I will record the entry as land and building account debit to loan account debit, and I will make sure that I'm only recording this entry as acquisition of assets, and I will not account it as per Ind AS 103. No acquisition of Ind AS 103 shall apply in this case. Clear? Now let's look at the concept of Ind AS 103. When I talk about Ind AS 103, I'm particularly looking at this aspect relating to business combination. When I discuss about a business combination, it is nothing but acquiring a control over another enterprise is called as business combination. So when I use the word business combination, it simply means acquiring control over another enterprise. When do you say that you acquired control over the other enterprise? Control definition, which we have discussed as far as Ind AS 110 is concerned. That means what? So basically, when an enterprise has a power over the investee, is subjected to variable returns from the investee, and has a power to has an ability to use the power to influence the return that they can extract from the investee. The conditions we put up. I said there is a power over the investee, they're exposed to variable returns from the investee, and they have an ability to use this power to influence the returns which are received from the investee. If these three conditions are satisfied, then you can say that an enterprise has a control over another enterprise. The day on which the transaction which gives rise to the control over another enterprise is discussed as far as the standard is concerned. Now, subsequent to the transaction has occurred, when there is a control existing, on each balance sheet date, I'll apply consolidated procedures, which we already know as far as Ind AS 110 is concerned. So what is Ind AS 103 talking about? It is a single point accounting. What is that single point? The date on which control has been acquired. The day on which the control is acquired, you will have to account for it as per Ind AS 103 business combination. Clear? So let's see what business combination involves. Business combination Ind AS 103 talks about the laying down the principles of recognizing for the acquiring control over another enterprise. Generally, control means at least 50% of voting power. So if X, an acquirer, is taking hold of at least 50% of voting power in Y, then he is said to be having a control over Y. The date on which this acquisition has happened, it should be recorded as per Ind AS 103. Clear? Now, we come across a situation where we have a reverse acquisition, where let's say, for suppose, there is a transaction between X and Y. I'll help you with an example, guys, here. Let me take an example to help you understand this concept. Let's say, for example, there is a transaction between two enterprises, X and Y. Okay. Let's say, for example, Y is transferring its net assets to X. As an exchange, X has to pay consideration. Let's say this purchase consideration is in the form of equity shares of X. Purchase consideration. This purchase consideration in the form of equity shares in X. Let's say 15,000. 15,000 equity shares in X were directly issued to the shareholders of Y. Instead of Y Limited, they are directly issuing the purchase consideration to shareholders of Y. Before this transaction, the actual number of equity shares in X were, let's say, 10,000. So what happened here? The shareholders of X were holding 10,000 shares in X, but now X has given purchase consideration to Y in a form of its equity shares to the extent of 15,000. So what happened now? Now, if you observe, after acquisition, in X Limited, the total equity shares is how much? Total equity shares are 25,000. Out of this 25,000, 15,000 equity shares are held by shareholders of Y. That is more than 50%. Therefore, here Y Limited, though is whose net assets are taken over by X, you need to understand that it is the shareholders of Y which will now start controlling X. Therefore, it might look as if like actually this person who is X Limited is actually the acquirer. But if you observe this sense that the shareholders of Y are ultimately getting more than 50% in X, so X is not the acquirer, but X should be considered as an acquiree. Then who is the acquirer in this case? The acquirer is Y Limited in this case, because it is the shareholders of Y Limited which are acquiring control or more than 50% of voting power in X Limited after the transaction of business combination has occurred. This is a simple situation which leads to a reverse acquisition, where sometimes this can be very tricky to identify who is the acquirer and who is the acquiree. Clear? So in this example, the same example which I have given there, I am saying X is the acquiree and Y is the acquirer, unlike it actually looks like. Actually, Y is the acquiree. Now, this determination of cost of control we have already seen before, where cost of control is computed on the day on which the parent enterprise has acquired control over the subsidiary. How do you calculate? Cost of control is about determination of goodwill or bargain purchase. So that is cost of investment in subsidiary added by the non-controlling interest on the date of acquisition compared with the fair value of identifiable net assets in the subsidiary on date of acquisition. This will result in either goodwill or bargain purchase. This is exactly the similar computation that we have seen even as per Ind AS 110. If you look at the same thing we have done under Ind AS 110, where there is multiple dates of acquisition. In such case, what I did, cost of investment in subsidiary plus fair value of investment in subsidiary already held by holding company plus NCI on date of acquisition, that is compared with fair value of net assets in the subsidiary on the date of acquisition, which might result either in goodwill or bargain purchase. This is ascertained as per Ind AS 103. Have a look at this computation. This computation is something that we have already seen as per Ind AS 110. Have a good view of this computation. If you remember, this was the same computation which we have done as per Ind AS 110, and there itself I told you this is as per your Ind AS 103 and not as per Ind AS 110. Hope you're done with that. How do they recognize the transaction? Look at the transaction being recorded. If I'm preparing the transaction in the books of the acquirer in his books of accounts will record the entry as investments in acquiree account debit to bank. That's a simple transaction. I buy shares in Infosys. What will I record? Investment in shares of Infosys account debit to bank. But upon business combination, how do I record? I'm taking over the assets and liabilities. So therefore, I'll have to de-recognize the investment and I have to recognize the assets and liabilities of the acquiree. So net assets of the acquiree account debit, either goodwill or cap bargain purchase will arise to bank to NCI. NCI will be recognized as a liability to the extent the consideration is paid in bank, credited to the bank. This is the combination entries or the entry to be recorded whenever a business combination arises in the books of acquirer. Have a look at the entry. Yes, guys, so let's continue. What are the steps involved in a business combination? Whenever there is a business combination, I have to involve 6 steps to derive at the balance sheet on the date of business combination. The first step is to identify who is the acquirer and who is the acquired. Generally, it is evident from a problem of who is the acquirer and who is the acquirer. But there are stages, there are cases where I've given you a reverse acquisition where the identification of acquiree and acquirer might be a little difficult or might get a little complicated. So, but in general sense, it is a very simple, straightforward situation of identifying an acquirer and an acquiree. Once you identify the acquirer and acquiree, I'll have to identify the date on which the controlling interest was acquired. That is the date on which Ind AS 103 should be applied. That is the date of acquiring controlling interest by the acquirer in the acquiree. That is the second date, which is evident from any problem that you find. Number 3, then you start determining what is purchase consideration. What do you mean by purchase consideration? It is a consideration paid by the acquirer to the shareholders of acquiring. Consideration paid by the acquirer towards the shareholders of acquiring is called as purchase consideration. When I say shareholders, such purchase consideration could be paid either to the equity shareholders or to the preference shareholders. Guys, if your preference shareholders are classified as equity only, this purchase consideration to preference shareholders will get included in step 3. If your preference share capital is classified as a financial liability, why does it get classified as financial liability? Because it has a fixed maturity date. It gives rise to an obligation for the enterprise to pay cash or to an obligation to deliver cash on a particular maturity date. In such situation, preference share capital should not be recognized in equity but should be recognized as a financial liability. Guys, this discussion we'll have in a much more elaborate sense when we are discussing about Ind AS 109. Clear? In Ind AS 32, we have the discussion between equity and financial liability where we come across this discussion. But I am saying if you have a particular preference share which is classified as equity, only then that preference share consideration paid to preference shareholders should be included in step 3. Then your step 4 is the most important step where you identify the net assets of the acquiry at their fair value, where you determine the fair value of each asset and each liability as it exists in the acquiry, and that should be the total net assets or total identifiable net assets in the acquiry. Step 5 is determination of cost of control to identify a goodwill or bargain purchase, and finally we draft the balance sheet. This is a 6-step approach, out of which the first 2 are identifiable right from the face of the question itself, where we know who is the acquirer and who is the acquiring and what is the date on which the controlling interest is acquired. These 2 are already available. So fundamentally, I have to do 3 steps before I draft a balance sheet. Number 1, determine the purchase consideration. Number 2, determine the fair value of net assets in acquiry which were acquired under business combination. Finally, I determine what is the cost of control. It is identifying either goodwill or bargain purchase in the transaction before I draft a balance sheet on the date of business combination. Like I told you, purchase consideration is paid to the equity shareholders or the preference shareholders of the selling company or the acquiring. So such kind of consideration paid to the shareholders of acquiring should be considered as purchase consideration. In what way does the purchase consideration gets discharged? The acquirer, to purchase the shares of selling company or the acquiring, could either issue consideration in the form of cash, could issue consideration in the form of some assets, could issue consideration in the form of securities in acquirer's company, which is debt securities or bonds, or can also be in the form of equity investment in acquirer. So acquirer, while taking over the entire shareholders or shareholding in acquiring, can issue their own equity shares, or can they issue debentures or bonds, or they can issue an asset, or they can issue cash. Whatever it is, this consideration is called as purchase consideration. To determine purchase consideration, that is nothing but your step 3, we have 3 methods of identifying. Purchase consideration can be computed using net payments method, net assets method, or intrinsic value method. What are these 3 methods and how do I determine purchase consideration under each of these 3 methods? And also one should know when to apply each of these methods. When to apply is very important. Remember, my first preference is always net payments method. I will identify purchase consideration by net payment method if purchase consideration is given in the form of fixed sum of money. A acquires B Limited by paying 10 lakhs. Very simple. Straightforward, I got them. A acquires B Limited by paying 10 lakhs. Over. Case is over. So 10 lakhs is your purchase consideration. That is net payments method. Or the purchase consideration is determined in the form of number of equity shares to be issued by the acquirer to the acquiring. X Limited takes over Y Limited. by issuing 10,000 shares in X Limited at a price of 25 rupees per share, where purchase consideration is given in the form of number of equity shares to be issued by the acquirer to the acquiree. Second situation, why I use net payments method. Third one, where the purchase consideration is given in the form of an exchange ratio. X Limited is taking over Y Limited by exchange of their shares in the ratio of 5 shares for every 7 shares held in Y Limited. So that means by taking over 7 shares in Y Limited, X Limited will issue 5 shares. 5 by 7 is your exchange ratio. So therefore, if I want to apply net payments method in computation of purchase consideration, then the purchase consideration should either be given in the form of fixed sum of money, or fixed number of equity shares issued to the acquiree, or where the consideration is expressed in the form of an exchange ratio of shares between the acquiree and the acquirer. In these 3 cases, I will apply net payments method. Under net payments method, the purchase consideration is equal to the fixed amount or is equal to the number of shares issued by the acquirer multiplied by issue price per share. Clear? Look at it. Only if the consideration is specified as a fixed amount or by fixed number of shares or given in the form of exchange ratio. X Limited takes over Y Limited for a consideration of 10 lakhs. X Limited takes over Y Limited by issuing 10,000 equity shares at 25 rupees each. X Limited takes over Y Limited by exchanging its shares in the ratio of 3 shares for every 5 shares held. All these are examples of net payments method in determining purchase consideration. Then what is net assets method? Like net assets is nothing but assets minus outside liabilities. Correct? It is nothing but net assets minus outside liabilities. But here, under per determination of purchase consideration, your net assets method put up like this. Purchase consideration is equal to assets measured at fair value minus outside liabilities measured at settlement values plus the amount of goodwill. This technique of measuring purchase consideration by net assets method will be only applied if you cannot determine purchase consideration as per net payments method. Only if you cannot determine purchase consideration by net payments method, I think that is a correction required. If the purchase consideration cannot determine by net payments method, then I'll apply net assets method, where under net assets method, purchase consideration is equal to assets minus outside liabilities plus goodwill, where assets are measured at realizable values and liabilities are measured at settlement values. Clear? Guys, before I get into your intrinsic value method, I want you to look at net assets method once again. If you're comfortable with net assets method, I'll move into intrinsic value method. I wanted you people to look at net assets method once again because your intrinsic value method, that is the third method in determining purchase consideration, is more or less aligned with net assets method itself. The third method of determining purchase consideration, which is as per intrinsic value method, is more or less aligned with net assets method, because an intrinsic value per share of a company is determined by using the mathematical application of net assets attributable to equity shareholders divided by number of equity shares. That is the formula for intrinsic value. What did I say? Net assets attributable towards equity shareholders divided by number of equity shares. Now, when I say net assets, is it different from net assets attributable to equity shareholders? Yes. Your net assets attributable to equity shareholders is nothing but the net assets which you have determined as per part 2 or your step 2, where you have determined assets minus outside liabilities plus goodwill minus liability to preference shareholders. What is your liability to preference shareholders? To pay out his capital, to pay out the dividends which are payable in arrears, or to pay out any premium on redemption of preference shares. These three combined are called as liability to preference shareholders. If your liability to preference shareholders is reduced from the value of net assets, then we determine something called as net assets attributable to equity shareholders. Such net assets attributable to equity shareholders, if it is divided by number of equity shares, we get something called as intrinsic value method. For determining purchase consideration under intrinsic value method, the number of shares issued by the acquirer should be multiplied by the issue price per share. How do I identify number of shares issued by acquirer? Number of shares issued by acquirer is nothing but number of shares in acquiry multiplied by exchange ratio. What is exchange ratio? Exchange ratio is intrinsic value per share in acquiry divided by intrinsic value per share in acquiry by acquirer. How do I determine intrinsic value? Net assets attributable to equity shareholders divided by number of equity shares, where net assets attributable to equity shareholder is equal to net assets minus liability to preference shareholders, which is given as preference share capital plus preference dividend plus any premium on redemption of preference shares. Guys, before I move into from next topic, I would still want to stick with intrinsic value method. And let me tell you something, that in absence of intercompany holdings, I'll repeat, in absence of intercompany holdings, your intrinsic value method purchase consideration is equal to net assets in acquiry. In case there is no intercompany holdings, my intention is that I am continuing to say that purchase consideration under intrinsic value method is equal to the net assets of the acquiry. Now, I would want you people to see what is given out here, try to perform your functions and determine how I said that. How did I say that? I am saying the purchase consideration is equal to net assets of acquiry. You determine how do you get that value. Use your pen and paper and try to determine how do I get purchase consideration is equal to net assets. One minute, I'll start solving. By the time I want you people to determine it. I made a statement saying that under intrinsic value method, purchase consideration is equal to net assets of acquiry. I want you people to determine. Go ahead, guys. I'll determine for you. I'll tell you how I get that answer. I said purchase consideration under intrinsic value method is equal to number of equity shares to be issued by the acquirer multiplied by issue price per share. If you look at the formulas which I gave you earlier, I said number of shares to be issued by acquirer is equal to number of shares in acquiry multiplied by exchange ratio. This should be multiplied by issue price per share, which is nothing but intrinsic value of acquirer. Again, I gave you a formula for exchange ratio. So I again write it. Number of shares in acquiry multiplied by intrinsic value. I'm writing it as IV, guys. I don't want to write the entire thing. Intrinsic value of acquiry divided by intrinsic value of acquirer. Right? This is what your exchange ratio is, multiplied by intrinsic value of acquirer, which is the issue price per share. By simple math, intrinsic value of acquirer should get cancelled, one in the numerator and the other one in the denominator. So now I will be left out with number of shares in acquiry multiplied by what is intrinsic value of acquiry? Intrinsic value of acquiry is nothing but net assets attributable to equity shareholders. Net assets attributable to equity shareholders in acquiry divided by number of equity shares in acquiry. This is the formula for intrinsic value of acquiry. Again, I can cancel number of equity shares. Therefore, what is your PC? Therefore, purchase consideration is equal to net assets attributable to equity shareholders in acquiry. This is exactly what I was telling. I told you, right? Your net assets, your purchase consideration will be exactly equal to the net assets in the acquiry. This is how I calculate. Guys, this derivation which I've done is only correct if there is no intercompany holding. What are these intercompany holdings and how do I determine them? Remember, whenever I get this concept of intercompany holdings, the most predominant one that I find, which I find is acquirer already holding shares in acquiry. In this case, when you have acquirer already holding shares in acquiry, this gives rise to multiple dates of acquisition. in this case, that means acquirer already holds 20%. Now is purchasing 50%. So the total holding became 70%. In such cases, the second date of acquisition should be the date on which they have acquired control. The second date on which they have acquired control, I have to apply Ind AS 103. In such cases, what will change? Only your cost of control will change. What do you do with respect to cost of control? Whatever investments were already held in the acquiry, they should be measured at fair value. Now, the cost of acquisition of 50% plus fair value of the 20% already held plus NCI balance 30% should be compared with fair value of net assets to derive either goodwill or bargain purchase. But whatever is the difference between the carrying value of investment and fair value of investment of which was already held in the acquiry, the difference should be transferred to fair value reserve. Here, the second type of intercompany holding is where the acquiry has certain shares in the acquirer. Whenever your acquiry has certain shares in acquirer, remember, Companies Act says the subsidiary cannot hold shares in its parent. Small exception, he said, if the subsidiary has acquired these shares before it became a subsidiary of the parent, that means subsidiary initially held 10% in the parent company. Parent company subsequently has acquired more than 50% shares in subsidiary. Only in that circumstance, subsidiary can hold shares in parent. Otherwise, the subsidiary should never hold shares as far as the parent enterprise is concerned. Therefore, this concept of acquiring holding shares in acquirer does not emerge. Clear? It does not emerge as far as business combination is concerned. Clear logic now? So only one intercompany holding where acquirer already holds shares in acquiry, and on such cases, I will apply the concept of the determination of cost of control or for multiple dates of acquisition. Clear? What do you mean by contingent consideration? What do you mean by contingent consideration? Contingent consideration means such amount of consideration which is payable on occurrence or non-occurrence of a future event. That future event occurs after the date of business combination. But you are agreeing today. I'll put it like this. On the date of acquisition, the acquiree's business is making a net profit of 8%. The acquirer has paid some purchase consideration and he said that the existing purchase consideration will increase by 10% if the net profit of the acquiree's business in the next 3 years increases to 10%. Today's net profit percentage of 8, if it becomes 10% within the next 3 years, then the purchase consideration which I paid now will increase by 10%. So that is contingent consideration. Guys, if you think this is, sir, I've never come across this logic only. Wait, I'll tell you. This is very common as far as footballing world is concerned. Football world outside India, because India, our football world is very limited. We don't have so much of prominence to the sport. But if you go outside India, let's say I have a player like Lionel Messi or Cristiano Ronaldo. Let's say Messi, who is today owned by Barcelona, that means Barcelona owns the services of Messi on the field. If Barcelona is selling Messi to another club, let's say I sold it to a club, let's say in London. So what happens? This London club is basically agreeing terms with Barcelona to acquire the services of this player, Lionel Messi. They'll say, I will give you $80 million today or 80 million pounds today, plus I will give you an additional 20 million if with the help of Lionel Messi, I will be able to win the Champions League. If I will be able to win a particular competition, then I will give you extra 20 million, which is future. It is an uncertain future event which is giving rise to a consideration for a transaction which already occurred. Then such consideration is called as contingent consideration, and this is common. This is very common. So what he says, whenever there is a contingent consideration, it should be measured at its fair value. It should be measured at its fair value. And by measuring it at fair value, I will add it to the purchase consideration on the date of acquisition. So acquirer shall recognize the acquisition date fair value of the contingent consideration as a part of consideration transferred in exchange for the acquiry. The acquirer shall classify the obligation to pay contingent consideration either as a liability or equity in accordance with Ind AS 32. Let's say they said contingently I will issue 10,000 shares in future, equity instrument. Let's say if I say I will give you 10 lakhs in future if certain condition is met, then it is a obligation. So depending on obligation or equity, it will be classified, but it should be measured at fair value and included in purchase consideration. Clear? What is deferred consideration? How is it different from contingent consideration? Contingent consideration, you don't know whether this consideration will be paid or not, because the payment of that consideration depends on an uncertain future event. But deferred consideration is not like that. Today I don't have sufficient money, so I will make the payment to you a year later or 5 years later. A part of consideration I'll pay now, a part is deferred to 2 years later. So that means I'm determining the consideration. It is not dependent on uncertain future event, but it is payable not today, but this part of consideration is payable after a specific period. This is called as deferred consideration. Whenever this concept of deferred consideration comes in, I'll have to apply the concept of time value into it. So therefore, in measurement of purchase consideration on the date of acquisition, I will measure this deferred consideration at its present value and include it in computation of PC. What did he write? An acquirer shall recognize the present value of the deferred consideration as a part of consideration transferred in exchange of acquiry. Acquirer shall recognize the finance expense in P&L related to the deferred consideration. What is finance cost? Because you are discounting it to the present value, every year there should be an interest catch up. That interest catch up, the acquirer will recognize it as a finance cost in your P&L. Clear? Now guys, why should I talk about goodwill? Go up above. When you did your net assets method, I said purchase consideration is equal to assets minus outside liabilities plus goodwill. So there plus goodwill, that means goodwill has to be identified. It has to be determined. So what are the methods in determining goodwill and what is goodwill will be our next discussion. Yes, guys. So let's get into this concept of goodwill valuation. What is goodwill and why do they value goodwill? How is the goodwill being valued? See, goodwill is an intangible asset, but at the time of acquisition, I will always ascertain the value of goodwill to be included in the purchase consideration. Now, let's say, for example, I am having a particular enterprise which is into manufacturing of steel. My today's capacity per day is to produce 8 metric tons of steel. That is my current production capacity, 8 metric tons of steel per day. I have sufficient demand outside for basically this purchase of 8 metric tons of steel. Today, a purchaser or an acquirer came up to me or approached me for buying the stake in my company. So I told him, these are my set of assets, these are my set of liabilities. He ascertained the net assets value as 150 crores. At this 150 crores, I will say, I will not sell you because this is the fair value of my assets and liabilities. What is the value for my existing production facility? My existing production facility of 8 metric tons, finding a customer is not easy. If you put up your same 150 crores and start put up your new plant, it will take you at least 3 years for you to reach 8 metric ton capacity. So therefore, there should be a value which is attached to that. We'll say that is qualitative in nature. So let's quantify this. This quantification of abnormal or higher profits to your enterprise is called as goodwill. So goodwill can be given with an expression as an excess earning capacity of an enterprise in future. It is an excess earning capacity of an enterprise in future. If an enterprise has a capacity to earn in future, then you can definitely say that yes. So if an enterprise has an excess earning capacity in future, it should be called as goodwill. Now, what is your excess earning capacity? How do I calculate it? How do I measure it? This excess earning capacity measurement is given with a word called as goodwill. So how do I determine goodwill? Let's see. So when I talk about goodwill determination, it is future excess earning capacity of an enterprise which can be determined by 4 methods: average profit method, super profit method, annuity method, and capitalization method. Well, let's quickly go through what these 4 methods are. The 3 determinants of goodwill which I always need are: number 1, future maintainable profit. I'm saying the 3 determinants of goodwill are future maintainable profits. Let me write down. My determinants of goodwill are predominantly 3 things. 1, 2, 3. First one called as future maintainable profits. In short, we call it as FMP. Future maintainable profits, in short called as FMP. Second one, average capital employed. Average capital employed. Third one is NRR. Whenever I say NRR, NRR is always given as a percentage. And this NRR is generally industry specific. It is industry specific. So it depends upon the industry to which I'm actually determining goodwill. Let's say I'm determining goodwill with respect to an enterprise which is in the industry of technology. So my NRR will be different. Let's say an enterprise which is in the industry of steel manufacture is trying to determine goodwill. their NRR will be different. Let's say I'm looking at enterprise which is in the industry of FMCG, fast moving consumer goods. NRR is slightly different. So you need to understand that NRR depends upon the industry to which the enterprise belongs, based on which the NRR should be determined. Guys, in general sense, when I try to determine NRR, I will always use the logics of Ashwadamodaran. He is the author, Ashwadamodaran. He will basically give you NRR of various industries. You can basically log into nye.edu. So that is where he basically gives you all this information. So he is a very renowned guy. You can search him on Google. We normally use NRR of that particular person, Ashwadamodaran, who will give us the industry-based NRRs. Clear? Moving. That is too much into practical sense. Push it aside. Industry-specific value. How do I determine average capital employed? To determine my average capital employed, I'll go like this. My average capital employed is equal to my opening capital plus closing capital divided by 2. Or I'll use the formula closing capital employed minus half of current year profit after tax. Closing capital employed minus half of current year profit after tax. Either of these formulas shall be applied in determining what is average capital. Now, capital employed, you are saying what is capital employed? Capital employed is nothing but your value of net assets. So if I want to determine the value of capital employed, I'll again use the formula assets minus outside liabilities. Remember when I say this, assets should always be valued at their realizable values and liabilities should always be measured. Your liabilities should always be measured at their settlement values. Right, sir? Very good, sir. I just did not even realize that my meetings got shut down, sir.
Okay.
So yes, guys, I was talking about your determination of goodwill and I said there are 3 determinants: FMP, future maintainable profits, average capital employed, and NRR. What is your NRR? It is an industry specific number. So it depends to which industry the enterprise belongs to. NRR will be depending on that. What is your average capital employed? Opening capital plus closing capital divided by 2, or closing capital minus half of current year profit after tax. What is capital employed? Capital employed is nothing but assets minus outside liabilities, where all assets should be measured at their realizable values and their liabilities should be measured at settlement values. The liabilities should be measured at settlement values. Now, whenever I say this logic, remember, while considering my assets, I particularly exclude my non-operating assets, which are not held for operating purposes. Investments in fixed deposits, they are non-operating assets. Number two, and my fictitious assets. What do you mean by fictitious assets? Fictitious assets are miscellaneous expenses not written off. Such kind of assets do not have realizable values. In this case, the realizable value is equal to 0. Since they don't have realizable value, there is no point of including them in computation of your net assets or capital employed. But if I talk about your future maintainable profits on how to determine, future maintainable profits should always be determined with the help of average of past profits, adjusted by plus some growth. Last year I made a profit of so much, that average plus the growth which I am expecting to have. Now, whenever I say average, then the question comes up, should I consider a weighted average or should I consider a simple average? It depends upon the past profits. If the past profits of the enterprise either show an increasing trend or a decreasing trend, then it is advisable for the average to be considered as a weighted average. If the past profits either show an increasing trend or show a decreasing trend, it is always advisable to use weighted average. If there is no trend, no increase, no decreasing trend, in such cases I will use simple average of past profits to determine your FMP. While we are trying to measure our past profits should always exclude extraordinary items, winning from lottery. Due to COVID, 3 months got shut down. That is extraordinary. Number two, non-operating items, non-operating expenses and non-operating incomes. I have investment in fixed deposit. That investment derived some interest income. Such interest on fixed deposit should not be considered as an average of past profits. In computation of past profit, this is non-operating in nature, which should be excluded. Profit or loss from sale of asset, extraordinary. You will sell assets every day. Your fixed assets are there. They are meant for use. You have sold it during a particular year. You derived some gain or loss. That is an extraordinary item, should not be considered in computation of past profits for determining FMP. Clear? Now, let's get back to what we were discussing. Valuation of goodwill. We just saw 3 determinants. Using these 3 determinants, how do I value goodwill? Average profit method. It is nothing but goodwill is equal to FMP into number of years purchase. How do you determine FMP? FMP is determined based on past profits, where they excludes abnormal gains and losses, non-operating incomes and expenses. What is your number of years purchase? The number of years for which the enterprise is expected to derive such profit. The number of years for which the enterprise is expected to derive such excess profit is called as number of years purchase. So the number of years purchase into your future maintainable profits is called as goodwill under average profit method. Guys, if you again go back to the definition of goodwill, What did the goodwill define as? Future excess earning capacity. But if you look at this formula, FMP into number of years purchase, where is the concept of excess earnings? You just took whatever earning I'll do tomorrow, multiplied by number of years. That's it. The concept of excess earning has not been incorporated into this. That is the reason why, to correct it, he came up with something called as super profit method. Where under super profit method, goodwill is equal to super profit into number of years purchase. What is super profit? Excess profit. What is the excess profit? FMP, future maintainable profit, minus my normal profit. How do you get normal profit? Normal profit means if my average capital employed is 100 and if my NRR of the industry is 12%, then normal profit is 12. If my maintainable profits in future are 15, then I am expected to get an excess earning of 3 rupees every year. That 3 rupees is called as super profit. So to calculate super profit, it should be FMP minus normal profit. Future maintainable profits minus normal profit. I know how to determine FMP, which is average of past profits plus growth rate. But whenever I talk about normal profit is nothing but average capital employed into NRR, which is represented as a percentage. We have already discussed just now how to calculate average profits. Average capital employed is equal to opening capital employed plus closing capital employed divided by 2. What is annuity method? Annuity method is a further development over super profits method. Because what are you saying, super profits method? This much excess profit I will earn for the future 5 years. Guys, it's a future cost. Future profit, today you are assessing. If you are today assessing what is a future profit, on today's date, I'll have to apply the present value factors. So that super profit, instead of being multiplied by number of years purchase, if I consider the time value of money and multiply it with PVAF, that will give me goodwill as per annuity method. The last one, where I identify goodwill as per capitalization method, I will forget about this concept of number of years purchase. I'll simply say goodwill is equal to your normal capital minus average capital. How do I get normal capital employed? Normal capital employed is equal to FMP by NRR. It is FMP by NRR. Alternatively, goodwill can be calculated as super profits divided by NRR also. Both formulas should derive the same answer. Either you do normal capital minus average capital or you do super profit divided by NRR. You should be deriving at the same answer for goodwill. Clear? That will bring us to the end of discussions regarding goodwill valuation. Moving further, what about direct cost of acquisition? For any acquisition to happen or for any merger to happen, for any business combination to occur, multiple costs are involved. I'll first identify a valuation officer. He is called as registered valuation officer or can be called also as merchant bankers. These people get involved in determining the value of the company. This determination of value of the company will come at a cost. Some cost has to be incurred. Legal documents have to be drafted. Legal documents like share transfer agreement, your term sheet, all these have to be drafted by technical subject matter experts, which also comes at a particular cost. Additional shares should be issued. To issue the additional shares, authorized capital should be increased. Authorized capital increase will give rise to stamp duty, which is also a cost incidental. These are costs which are directly associated to acquisition. Whoever incurs it, if the acquiree incurs it or the acquirer incurs it, it should be charged off to P&L. It should never be included in purchase consideration. It should never be included in purchase consideration. Clear? Yes, guys. What is the concept of demerger and why does it occur? Guys, demerger in the sense where, let's say, for example, I am involved in, uh, let's say I'm Raymond's industry. Okay. Raymond's is into cloth and also makes ready-made garments. My cloth is known to be one of the premium cloths or fine cloths, fine clothing. I also produce ready-made garments. These are two distinct businesses for me. If you talk about India's 108 operating segments, both should be considered as two different business cycles, two different operating segments. Over a period of time, I understood that both of them are equally doing good. So what I thought was, let us make the ready-made garments into a separate company as such, and let's try to market that separate company again. So instead of Raymond, I wanted to create something else. I want to name it something else, and I wanted to make sure that it was continued. So this way, out of my existing business, one of the division has got demerged, has emerged into in the form of a new company altogether. So the net assets of the demerged division get transferred to the new company. That new company is going to pay purchase consideration either to the original company or to the shareholders of the original company directly. This is a simple case of demerger. This is what I have represented as far as your the sheet is concerned or the presentation is concerned. A has two divisions, X and Y. The Y division will get transferred to B Limited, where B Limited issues purchase consideration either directly to A Limited or can issue to the shareholders of A Limited. In such case, the acquiring company or the selling company, in this case, is A Limited. What is the entry they have to record? They'll have to de-recognize the net assets of Y division. So, to net assets and debit whatever purchase consideration they receive from the acquirer should be debited. Credit the net assets of the division which is transferred. The balance of this entry or the difference of this entry should be transferred to other equity. I will debit purchase consideration only if the consideration is received by A Limited. In this case, I clearly told you the purchase consideration can either be paid to A Limited or can be paid to the shareholders of A Limited. If the consideration is not paid to A Limited but instead directly paid to the shareholders, then the debit will not be given to purchase consideration. In such case, I will only credit the net asset and the entire book value of the net assets will be transferred to other equity. So I'll record the entry as other equity account debit or retained earnings account debit to net assets. Clear? Acquirer company who is taking over the net assets of the demerged division, I will record the net assets taken over at their fair value. So net assets account debit to purchase consideration which is transferred. Now, unlike the acquiree, where I will basically, the difference of the entry is adjusted to other equity. In this case, the difference of the entry should be adjusted to either goodwill or capital reserve. Please make sure that you're checking the entries. Please make sure that you check the entries, guys. Like I told you, please observe the entries very carefully what are being passed. Why is it debited to the net assets? Why is it credited to the net assets in books of acquiree and acquirer are really important to understand. Now, there is one concept of statutory reserve which I have to tell. Statutory reserve should be created in compliance to a law, like investment allowance reserve, export profit reserves, and development rebate reserves. The peculiar nature of these reserves is that the reserve shall exist irrespective of the corporate restructuring process. That means you can do any business acquisition possible. It could be an amalgamation, it could be an absorption, it is only business combination, you do whatever. Irrespective of the process of corporate restructuring you do, this reserve has to appear again in the books of purchasing company or the acquirer company. So therefore, when the Ind AS 103, when it talks about acquisition method, the reserves of the acquiring company are not taken over. What I take over is only the net assets. That is the reason why it requests or it requires us to pass an additional entry in the books of acquirer. The acquirer will now recognize an entry as amalgamation adjustment to statutory reserve. That is an extra entry which the acquirer has to record because this reserve should appear irrespective of corporate restructuring process. If there is an absorption which happens, that means let's say X is absorbing Y Limited, Y Limited is liquidated. If Y Limited has that statutory reserve, it should appear in the books of X Limited as well. In the books of X Limited, since I don't take over the reserves of Y Limited, I'll have to create an additional entry called as amalgamation adjustment account debit to statutory reserve. That is the last topic before I get into concentration test. We have already discussed this concentration test. It is only an optional test for a simplified assessment of whether the set of activities acquired is an asset or a business. Now, it is met, a concentration test is met if substantially all the fair value of the gross assets acquired is concentrated in single identifiable asset or a group of similar assets. That means if your part A, fair value of gross assets acquired, is substantially equal or substantially concentrated in part B, that is the fair value of single identifiable asset or group of similar asset, then you can say that the concentration test is met. If the concentration test is met, then you will say that it is only an acquisition of asset, it is not an acquisition of business. Your concentration test excludes cash and cash equivalents, deferred tax, and goodwill. It includes any consideration transferred in excess of fair value of net assets acquired. A single identifiable asset shall include any asset or group of assets that would be recognized and measured as single identifiable asset in a business combination. If a tangible asset is attached to and cannot be physically removed from another tangible asset without significant cost or diminution in utility or fair value, then those assets should be considered as single identifiable asset. When assessing whether the assets are similar, the entity should consider the nature of each single identifiable asset, risk associated to managing and creating the output from those assets. What are the steps? Measure the fair value of gross assets acquired, identify the single identifiable asset, and determine if substantially all the fair value is concentrated in the value determined as per part B. Clear? Few assets are not supposed to be considered as similar. What are those assets which should not be considered as similar? A tangible and an intangible asset are not similar assets. A tangible asset in different class unless they are considered as single identifiable asset in accordance with criteria D. The criteria D is nothing but the point number 4, where it is attached to and cannot be physically removed without separating from the other tangible asset, without incurring significant cost or significant diminution in value of utility, then the asset should be considered as single identifiable asset. So assets of different class should be considered as single identifiable asset if they satisfy point D. Otherwise, they should be considered as separate assets. Identified intangible assets of different classes. One is a license, other one is a patent. These are assets of different classes of intangible asset. cannot be considered as single identifiable asset. A financial asset cannot be identified together with a non-financial asset as a single identifiable asset. Inventory and receivables. Inventory, non-financial. Receivables, that is nothing but debtors. They are financial in nature. They cannot be considered as a single identifiable asset. Identifiable assets that are within the same class but have significantly different risk characters. So it could be a similar asset, same machinery, but the other machinery is subjected to significant risk. Let's say I have one machine somewhere in Bangalore, one machinery which is sitting right on the shore in Chennai. The machinery is made of steel, so the machinery in Chennai is more subjected to corrosion due to the humidity in the environment. So therefore, there is a subjected to different risk classification. They cannot be classified as single identifiable asset. And that will bring us to the end of the topic, Ind AS 103. So we look at illustrations which are given under Ind AS 103 as a part of your revised study material. So new illustrations, concentration test also being tested upon. So let's see what these new illustrations are. First one, I'll start with an example. Example 1 on concentration test. Entity A holds 20% of entity B. Subsequently, entity A, one second guys. Subsequently, entity A further acquires 50% shares in entity B by paying 300 crores. So guys, initially it was holding 20%. Now it further acquired 50%. That will give rise to 70% of holding. Therefore, you can definitely agree on saying that A has acquired controlling interest in B once the 50% was acquired. The fair value of assets acquired and liabilities assumed were 1000 crores of a building, cash and cash equivalent for 200 crores, financial liabilities worth 800 crores, and deferred tax liability of 150 crores. The fair value of entity B is 400 crores. And the fair value of non-controlling interest is 30% of the entity's value, which is 120 crores. The fair value of entity A's previously held interest of 20% is 80 crores, which is 20% of the fair value. So therefore, it is 80 crores in value. Entity A needs to determine whether the acquisition is an asset acquisition as per concentration test. Now, how do we do it? I told you 3-step process. First, you need to identify what is the gross value, what is the fair value of the gross assets acquired. Look at the fair value of the gross assets acquired. Now, to identify or determine the fair value of the gross assets acquired, I need to take 3 figures. Number 1, what is the consideration paid today? Today, to acquire 50%, I paid 300 crores plus fair value of shares already held. What is the fair value of shares already held? 20% already held. Today's value, fair value is 80. So 300 plus 80 makes it 380 plus NCI measured at fair value on the date of acquisition is 120. So 120 plus 80 plus 300 total will give rise to 500 crores. Clear? Moving down. Then we have to look at what is the fair value, that is the fair value of consideration. That is the fair value of consideration. Fair value of consideration plus liability. What is the liability assumed? 800. 500 plus 800 is 1300 minus the value of cash and cash equivalents, which is 200. Therefore, 1300 minus 500 plus 800, 1300 minus 200 cash and cash equivalents will give me a total answer of 1100. 1100 is considered as fair value of gross assets acquired. This should be compared with the fair value of identified asset. Fair value of identified asset in this situation, if you look at the assets, the only identifiable asset is a building which has a fair value of 1000 crores. So part A total is 1100, part B total is 1000. Therefore, your consideration is a substantial part or concentrated in the fair value of the building, which is 91%. Therefore, as a matter of judgment, it cannot be considered as a business combination. it is only an asset being acquired. So in the above scenario, substantially all fair value of the gross assets is concentrated in the single identifiable asset of building. Hence, it is an asset acquisition that is concentrated in a single identifiable asset, that is building. A judgment is required to conclude on the word substantially, as the same is not defined by the standard. In our view, we consider 91 as substantial to conclude that the above transaction is not a business combination but is only a asset acquisition. Now, moving further. Simple business combination. X is a liquor manufacturer, has traded for a number of years. The company produces variety of liquor and employs a workforce of machine operators, testers, and other operational, marketing, and administrative staff. It owns and operates the factory, warehouse, machinery, holds raw material, and finished products. Guys, this is a proper business function. They are involving in owning, operating the factory, warehouse, machinery, holding raw material, getting the finished goods, everything they are doing. So this is a business process. On 1st Jan, company Y pays 80 million US dollars to acquire 100% of ordinary shares of company X. No other type of share is issued by company X. On the same day, the four main executive directors of company Y take on the same roles of company X. In this case, it is clear that X is a business. It operates in trade of variety of assets and is used by its employees in a number of related activities. These assets and activities are necessarily integrated in order to create and sell the company's products. As per the definition in the above acquisition, it includes inputs. Thus, it can be concluded that a significant process acquired along with other inputs. Thus, Y obtains control on 1st January by acquiring 100% of voting rights. It should be covered as per Ind AS 103 and should be classified as a business combination. Look at example 3 then. D is a development stage entity that has not started any revenue generating operations. The existing workforce consists mainly of research engineers who are developing a new technology that a pending patent application. Negotiations to license this technology to a number of customers are at an advanced stage. Company A requires additional funding to complete the development and commence the planned commercial production. The value of the net identifiable assets in D is 750 million. Company A pays 600 million in exchange of 60% of entity D, a controlling interest. Although company D is not yet earning revenues, there are a number of indicators that is sufficiently integrated set of activities and assets that are capable of being managed to produce a return to the investor. In particular, company D employs specialist engineers developing a know-how and is pursuing a viable plan to complete the development work and commence the commercial production. Has identified and will be accessing the customers willing to buy the output. In addition, company A pays a premium of goodwill for 60% interest. In absence of evidence to the contrary, D is assumed to be a business, and this acquisition of 60% is by company A should be considered as a business combination as per Ind AS 103. One last example before I go into illustrations. Acquisition of entity A or entity holding investment property. Company A acquires 100% of equity and voting rights of P, a subsidiary of property investment company. Company P owns 3 investment properties. These properties are single tenant industrial warehouses subjected to long-term leases. The lease obliges company P to provide basic maintenance and security services. There are other activities also, but they are very basic in nature is what he said, which have been outsourced to a third party contractor. The administration of company P leases were carried out by an employee of its former parent company on a part-time basis, but his individual did not transfer any new owner to the new owner. In most cases, the assets and liabilities are capable of generating revenues, and combined with all or many activities might to earn the revenues would constitute a business. However, investment property is a specific case in which Earning a return to the investor is a defining character of the asset. So you don't need any other activities. One investment property by itself is capable of generating cash flows or returns to the owner of the asset. Accordingly, revenue generation and activities are specific and auxiliary to the inventory investment property. Its tenancy agreement should therefore be given a lower weightage in assessment of whether acquiry is a business or not. Further process, basic maintenance and security services, they are not critical to the ability to continue producing outputs. Also, processes such as basic maintenance and security are not unique. They can be easily replaced without significant cost. In our view, the purchase of investment property with tenants and services are purely ancillary to the property, and a tenancy agreement should not generally be accounted as an asset purchase. Clear? To generally be accounted as asset purchase. So you might say, sir, building is not being acquired. Tenancy rights are also acquired. The tenancy agreements are also acquired. Auxiliary services are also provided. So can't I treat it as a business? Guys, you need to understand that the basic nature of investment property itself is to derive revenues. So there is only basic security services and maintenance services which are involved. Therefore, they should not be looked at separately. It is predominantly the purchase of property if you are taking over company P. It cannot be considered as business combination. Acquisition of an entity holding investment property. Company A acquires 100% equity and voting rights of company B, Q, which owns 3 investment properties. The properties are multi-tenant residential condominium. Condominium is basically apartments subjected to short-term lease rentals, rental arrangements that oblige company P to provide substantive maintenance and security services. Earlier question, what did you use? It is a general maintenance. It is not substantive. Here it is substantive maintenance and security services which are outsourced with specialist providers. So that means this is not a basic nature activity. It cannot be treated as ancillary to the investment property. It by itself is a process, a business process. Company Q has 5 employees who ideally direct the tenants and with the outsourced contractors to resolve any non-routine security and maintenance requirement. These employees are involved in a variety of lease management tasks and marketing activities to maximize the quality of tenants and rental income. In this case, the company Q consists of revenue generating assets together with employees and also activities which clearly go beyond auxiliary activities to the property and tenancy arrangements. Further process, identification and selection of tenants, lease negotiation, rent reviews is critical to the ability to continue producing outputs to maximize the rental income and the quality of the tenants. Therefore, company Q should be considered as a business and should not be considered as an asset acquisition separately. Seller retains some activities and assets. Company S is a manufacturer of a wide range of products. The company's payroll and accounting system is managed by a separate cost center supporting all operating segments and the head office function. Company A agrees to acquire the trade, assets, liabilities, and workforce of the operating segments of Company S, but did not acquire the payroll and account cost center or any head office function. Company A is a direct competitor of Company S. In this case, the activities and assets within the operating segments are capable of being managed as a business. So Company A accounts for the business combination, and the payroll or the cost center or head office functions are typically not creating any output. They're generally not considered as an essential element in assessing whether the integrated set of activities or the business or the asset is a business or not. Oh, what he took over is trade, assets, liabilities, workforce, which is integral to generating output from the business. What he did not take over is simple payroll and accounting cost center, which is not directly generating any economic benefit, and they are not directly integrated to the other assets as well. Therefore, takeover of company S by company A should still be considered as a business combination. Acquisition of shell company. Company A is a property development company with a number of subsidiary companies, each of which has a single development. After completion of development, Company A sells its equity investment because the applicable tax rate is lower than the applicable to the sale of underlying property. Company A is planning for the development of a large new retail complex rather than incorporating a new company. Company A acquires the entire capital of the shell company. The shell company does not contain any integrated set of activities or assets, so it does not constitute a business. Consequently, the company A should account the purchase of shell company in the same way as if they are incorporating a new subsidiary. In the consolidated financial statements, any cost incurred should be in accordance with the nature and applicable Ind AS, and there is no goodwill which should be recognized in this transaction. Why there is no goodwill? Because there is no business only. What they acquired is a pure shell company. Shell company means there is no business activity, there is no asset, there is no operations, there is no other activity which for generation of revenue. So therefore, there cannot be any goodwill arising on business combination. So that will bring us to the end of examples on this. So from here, we will start looking at illustrations or questions relating to the standard. Yes, guys, so let's continue to look at questions here. Question number 1, which deals with Ind AS 103. Company A is a pharmaceutical company. Since inception, the company has been conducting in-house research and development activities through its skilled workforce. So workforce is skilled, so it should be considered as an activity necessary to generate some output, and recently has obtained some intellectual property rights. It's an intangible asset in the form of patents over certain drugs. The company has a production plant that recently obtained regulatory approvals. So one more plant, intangible asset, and workforce. All three are fundamental activities necessary to generate output. The company has a production plant that recently obtained regulatory approval. However, the company has not earned any revenue so far and does not have any customer contracts for sale of good. Company B acquires company A. Does company A constitute a business in accordance with Ind AS 103? Now, you need to understand with the help of definition of business. The definition of business requires existence of inputs and processes. In this case, the skilled workforce, the manufacturing plant, the intellectual property rights, along with strategic and operational process constitute to the operating activities or inputs and processes in line with requirements of Ind AS 103. When the said inputs and processes are applied as an integrated set, the company A is capable of producing output. So along with the plant, the IPRs, intellectual property rights, and the skilled workforce together are generating some output. So the fact that company A does not have revenue is irrelevant in analyzing whether it is a business or not. Based on this, presuming that the company A has not been able to obtain access to the customers that will purchase the output, the present case can still constitute to a business as per Ind AS 103. Modifying the above illustration, if company A had revenue contracts and sales force such that the company B acquires all inputs and process other than the sales force, whether the definition of business is still met. Guys, I did not take over revenue contracts. I did not take over sales force. Do you still say it is a business acquisition? Can be considered as a business acquisition because what is the significant activity in the business? The significant activity is performed by the asset, by the factory premises, by the IPRs, and by the skilled workforce. If the sales force can be substituted easily because it is not an integral function, you can always be, it is always replaceable, then you can still constitute it as a business. But if in case the customers and the sales force are also an integral part because it is difficult to sell these kind of output and to identify such kind of customers, then you can always say that the acquisition of all the other items except the sales force and the contracts of sale should not be considered as business. So in this case, it more looks like a business than it is not. Though the sales force has not been taken over, however, if the missing inputs can be easily replicated or obtained by the market participant to generate output, it can be concluded that A has acquired business. Further, if company B is in same line of business, then the existing sales force of the company B may be relevant to mitigate the missing input. As such, the definition of business is still met under Ind AS 103. Veera Limited, Zara Limited are both in the business of manufacturing and selling lubricants. Shares of Veera and Zara are agreed to join forces. Shareholders of Veera and Zara are agreed to join forces to benefit from the lower delivery and distribution cost. That means there is some synergy. The business combination is carried out by setting up a new entity called Veera Limited that issues 100 shares to Veera and 50 shares to Zara in exchange of transfer of shares in those entities. The number of shares reflect the representative fair value of the entities before the combination. Also, respective company shareholders get voting right in Veera Limited based on their shareholding. Determine the acquirer by applying the principles of Ind AS 103. Guys, it is particularly a business combination because a new company Veera is taking over both Veera and Zara. In this case, Veera Limited is issuing some shares. How many shares is he issuing? He is issuing 100 shares to Veera Limited, 50 shares to Zara Limited. So Veera Limited in total has 150 shares. Out of this 150 shares, 100 shares belong to Veera Limited. So that means their shareholding is 66.67%. Majority of the shareholding in Veera Limited belongs to Veera Limited. Therefore, Veera should be considered as an acquirer and and Zara, which is only allotted 50 shares, which is 1/3, 33.33%, should be considered as an acquiree. In the business combination effected primarily by exchanging equity interest, the acquirer is usually the entity that issues its equity interest. However, in some business combinations, commonly as reverse acquisition, the issuing entity is the acquiree. So we have seen this concept of reverse acquisition. Other pertinent facts and circumstances have to be considered in identifying the acquirer in a business combination affected by exchanging equity interest. The relative voting right in the combined entity after the business combination, the acquirer usually the combined entity whose owners have group retain and reserve a largest portion of voting rights. Based on the above mentioned paragraph, the acquirer shall be either the combined entities Vida and Zara, whose owners as a group receive or retain the largest portion of voting rights. Hence, in the above scenario, Vida, who holds 67% and Zara holds only 33%, therefore Vida is the acquirer as per the principles of Ind AS 103. Look at question number 4. Sita and Beta, they decide to combine their businesses to form a dual listed corporation, DLC. For their shareholders agreement, both the parties will retain original listing and the board of DLC will comprise of 10 members, 6 of Sita and 4 of Beta. The fair value of Sita is 100 crores and the fair value of Beta is 80 crores. Fair value of net identifiable assets in Beta is 70 crores. Assuming that the NCI is measured at fair value, you are required to determine the goodwill to be recognized on acquisition. Guys, look at this situation, guys. Here, what is happening here? I am basically trying to identify who is the acquirer and who is the acquired. Percentage holding is not explained to me, but I know out of the 10 members of board in DLC, that is a new incorporating entity, 6 members will be of Sita and 4 members will be of Beta. So therefore, who has the power over the investee? The one who has majority directors. So who is the majority directors held by Sita Limited? So who is the acquirer? Sita. Who is the acquiring? Beta. Look at Beta. Beta's fair value is 80 crores, while his net identifiable assets are only 70 crores. So I am acquiring it at 80, but their net assets are only 70. Therefore, the value of goodwill should be 10. Sita has more board members, thereby the majority control in DLC. Therefore, Sita is the acquirer and Beta is the acquiree. Since no consideration has been transferred, the goodwill needs to be calculated as a difference of the consideration paid by the acquiree or the controlling interest and compared with the acquirer's net identifiable asset. So 80 minus 70, 10 crores is a goodwill arising on business combination achieved through the contract alone and when the NCI is measured at its fair value. How will the financial statements of prior period be restated under common control in the following scenario? Common control period extends beyond the start of the comparative period. XYZ acquired PQR in a common control transaction on 1st October 2019. The year end of XYZ is 31st March. Both XYZ and PQR are controlled by the same shareholders since their incorporation. Common control period stated in comparative period. ABC Limited is acquired DEF Limited in a common control transaction on 1st October. The year end of ABC is 31st March. Both ABC and DEF are controlled by shareholder A. A made investment in ABC on 2010 and made investment on 1st October 2018 in DEF Limited. Ind AS 103 states that financial statements and financial information and financial statements in respect of prior periods should be restated as if the business combination has occurred at the beginning of the preceding period of the financial statements, irrespective of the date of business combination. However, if the business combination occurred after the date, then the prior period information should be restated only from that date. In accordance with para, the entity is required to restate its financial statements under Part A. Under Part A, where they have been since acquisition, they had common control, right? Since incorporation. In such cases, it requires to restate as if the business combination has occurred at the beginning of the preceding year of financial statements. So that means current accounting period is 2018-19, correct? Because they have it is occurred in 18-19 only, common control, the common control transaction. So 19-20 is current year, 18-19 is previous year. So beginning of previous year, 1st April 2018. According to the second case, ABC will have to restate its comparatives for financial year 18-19 as if the acquisition has occurred on 1st April 2018 but not earlier. Additionally, the results in the current reporting period are required to include the financial statements of ABC starting from 1st April up to 1st October. Entity A owns 100 shares of Entity B since 1st April 2011. Entity A arranges a loan funding from financial institutions in a wholly owned subsidiary called Entity C. So A holds 100% shares in Entity B. A arranges a loan funding from financial institution in a wholly owned subsidiary called as Entity C. The loan is used by Entity C to acquire 100% of shareholding of Entity B. Okay, so it is among the same group transactions only. So A owned B, A arranges a loan for C so that C takes over entire Entity B. Ultimately, A owns C, C owns B. Again, B is still a subsidiary only. Entity A applies Ind AS 103 to account common control transaction and C will adopt the same policy. Fair value of net identifiable assets is 1,50,000. Carrying value of net identifiable asset is 1 lakh. So consideration is 2 lakhs. So you need to understand that we are applying common control transaction. So as per common control, you cannot give rise to goodwill or bargain purchase. It should be adjusted among the reserves. The common control business combination means a business combination involving entities or businesses in which all combined entities or businesses are ultimately controlled by the same party or same parties before and after the business combination. Control is not transitory. In the above scenario, entity A and B after acquisition are controlled by entity A. As per para 8 of this appendix C, business combination involves entities and business process under common control to be accounted for using pooling of interest method. So no application of acquisition method appears here. As per para 9.1, the pooling of interest is considered to involve assets and liabilities of combining entities at carrying values. So therefore, the assets and liabilities in this given question should be recognized at their carrying value of 1 lakh and not identified at 1,50,000. But what is the consideration which I paid? 2 lakhs. What is the fair value of net assets? 1 lakh. What is the difference? That 1 lakh which I paid extra should be adjusted amongst the reserves of C Limited. It should not be transferred to goodwill. Based on the above analysis, entity C cannot be the acquirer. Entity A has created entity C and is a seller, and entity C has effectively been formed and issued shares to effect the business combination. Entity C is not a business, and a transaction between B and C is not business combination. It is reorganization of entity B. As a result, entities B's assets and liabilities are included in C's business combination or consolidated financial statements at pre-combined carrying amounts without fair value uplift. Therefore, they have to be recognized only at 1 lakh. No fair valuation should be applicable. Last question in business combination. Entity A and B provide construction services in India. A is owned by a group of individuals. None of them control and do not have a collective control agreement. B is owned by a single individual, Mr. Ram. Owners of A and B have decided to combine their businesses. The consideration will be settled by issue of shares of entity B. Entity B issues new shares amounting to 40% of its issued capital to its controlling shareholder, Mr. Ram. Mr. Ram then transfers the shares to the owners of entity A in exchange of the interest in entity A. At that point, A controls both entity A and B, owning to 100% in entity A and 71.42% in entity B. Okay. Mr. Ram has controlling interest in both entity A and B before and after the contribution. If the business combination is the combination of entity A and B a business combination under common control? Absolutely no. It cannot be considered as a business combination because it is within the same control. No, it is not a business combination of entities under common control. Mr. Ram's control of both entities before the business combination is transitory. The substance of the transaction is that entity B has obtained the control over entity A. Entity B accounts for this transaction as business combination with entity A as on the date of acquisition. That will bring us to the end of discussion on Ind AS 103, which deals with business combinations. Then let's look at questions on Ind AS 24, guys. Related party disclosures. Entity P has a controlling interest over the subsidiary SA, SB, SC. SC is a subsidiary of SB. P Limited has significant influence over its associates A, A1, A2, and SC has another associate which is A3. Let us try to put this up in a particular way. Let's understand how they have been put up. There is an entity P which controls SA and SB. Okay. SB controls SC. Control. Direct control I'm talking about. SB controls SC. Apart from this, P Limited has two associates, A1, A2. Associates, that means there is significant influence. SC has another associate A3 in which it has significant influence. From P Limited's perspective, all are related parties. SA, SB, SC due to control, A1, A2, A3 because they are significant influence. They are associates of P. So they are definitely related. Look at from SA's perspective. P, since P controls SA, is controlled by SA is controlled by P is related. SB and SC are also related because they are under common control with P. Correct? Now look at SA, A1 and A2. P has a control over SA. P has a significant influence over A1, A2 and A3. Therefore, in one side it is control. If both are under common influence or significant influence, you cannot say that they are related parties. But if one is control, other one is significant influence, there is a definite situation of related party. So for SA, SB, SC, P, A1, A2, A3, all are related. So if I want to give you related parties of P, SA, SB, SC, A1, A2, A3. If I have to give for SA, P, SB, SC, A1, A2, A3. If I have to give for SB, P, SA, SC, A1, A2, A3. But if I want to give out related party disclosures for A1, P is related, SA, SB, SC is also related. But for associate, A2 is not related or A3 is not related because between A1, A2 and A3, they are sharing common significant influence. It is if one is control, other one is significant influence, they are said to be related parties. But in this case, if there is a common significant influence, they cannot be considered as related parties. We have already seen above when we discussed about related party transactions, exclusions from related party transactions we have seen. Second, I'll go to that slide. Yep. If one is control, other one is control or joint control, other one is significant influence, both the parties are related. But if both of them have some significant influence, then they are common associates, they cannot be considered as related parties. Going with the same logic, if I apply it into this question, Now look at the solution. What are related parties? For P Limited, SA, SB, SC, A1, A2, A3 all are related. Same thing happens even for the subsidiaries SA, SB, SC as well. But if you look at associates, then A1, A2, A3 only related parties are P, SA, SB, SC. A1, A2, A3 are not related to each other. Clear? X is a financial controller of ABC Limited, a listed enterprise which prepares consolidated financial statements in accordance with Ind AS. Mr. X recently provided a final draft of financial statements of ABC Limited for the year ending on 31st March 2012 to the Managing Director Mr. Y for approval. Mr. Y is not an accountant, has raised a query from Mr. X on going through the draft. One of the notes of the financial statements gives details of purchases made by ABC from PQR during the financial year 11-12. Mr. Y, who is the main head of the managing director, he owns 100% shares in PQR. However, he felt that there is no requirement to give such disclosure in ABC Limited's financials since the transaction is basically carried out in normal commercial terms and is insignificant to ABC Limited as it represents only 1% of ABC's total purchases. Guys, materiality is not even a concept here. So, your Mr. Weiss, that is the managing director's contention, is absolutely wrong. You will have to understand that a managing director is a key management personnel of ABC Limited. Since he is a key management personnel and holds or controls 100% of equity shares in PQR, therefore PQR is a related party to ABC. Therefore, whenever such a relationship exists, the nature of relationship and name of party should be specified. If there is a transaction, in this case there is a transaction, and such transaction, even if it is immaterial, has to be disclosed. Ongoing through the queries raised by managing director, the financial controller explained the notes as follows. Related parties are generally characterized by presence of control or influence between two parties. According to Ind AS 24, identifies related parties, key management personnel and companies controlled by key management personnel. On this basis, PQR is a related party of ABC. The transaction is required to be disclosed in the financial statements of ABC Limited since Mr. Y is a key management person of ABC and at the same time owns 100% shares in PQR, that is, he controls PQR. This implies that PQR and ABC are related parties. Where transactions occur with related parties, Ind AS 25 requires the details of transactions to be disclosed in notes to financials. This is required even if the financial transactions are occurred on arm's length basis. Transactions with related parties are material by their nature of transaction. So transaction volume may not be significant, but still they do not affect the need of disclosure. Let's come to the last question, guys. S, wholly owned subsidiary of P, is a sole distributor of electricity to customers in a specified geographical location. A's manufacturing facility, a manufacturing facility of P Limited, is located in the same geographical area and accordingly, P Limited is a consumer of electricity supplied by S. The tariffs in the geographical area are determined by independent rate setting authority and are applicable to all customers including P. Whether the above transaction is required to be disclosed as related party. Guys, what is it? Ultimately has to be disclosed whether it is arm's length transaction or not. There is a related party relationship because S Limited is wholly owned subsidiary of P. Therefore, it has to be reported. In the context of the standard, the following are not related parties, where he talks about two entities simply because they are directors. We have seen all these exclusions. Being engaged in the distribution of electricity, S is a public utility and he had only relationship between S Limited and P Limited being supplier and a consumer of electricity, then P Limited would not have regarded the related party transaction of S. However, as per the given facts of the case, this is not just the relationship between, it is not only the relationship between S Limited and P Limited, Apart from being supplier of electricity, S is also the subsidiary of P. This is a relationship that is covered under related party relationship. In the view of the above, supply of electricity by S to P is a related party transaction and attracts disclosure requirements as per para 18 and other relevant requirements of the standard. This is notwithstanding the fact that P Limited has been charged the same electricity tariff determined by the independent rate setting authority. That means that P has been treated on par with any other customer. Ind AS 24 does not exempt from disclosing related party transaction merely because they are carried out on arm's length transaction basis. That will bring us to the end of discussion on problems related to Ind AS 24. So understanding the importance of this standard, Ind AS 32, 107 and 109 becomes very important. Like I told you, 32 deals with definitions part. Identification of equity and financial liabilities, defining what is a financial liability, what is an equity instrument, what is a financial asset, all that goes into the aspect of Ind AS 32. While it comes to Ind AS 109, here is the main accounting principles where you talk about recognition, measurement, classification, derecognition, all these accounting concepts, recognition and measurement concepts are embedded into the concept of Ind AS 109. So that is the fundamental difference. While 107 is a pure disclosure standard and where you only talk about disclosures relating to financial instruments. Now, if you observe what we just see is that in the statement of financial statement, in the financial statements drafted as per Ind AS, as per Schedule 2, Schedule 3, you will observe that majority of my assets, apart from PPE, investment property and intangible assets, which was covered as per their respective standard, most of the other assets will be covered as per Ind AS 109, except for inventory, which is dealt as per Ind AS 2. While if you look at the equity and liabilities part, your significance of Ind AS 109 even further enhances because you find that share capital, all your non-current liabilities and your current liabilities are covered as per Ind AS 109. On the liability side, there are only two items which does not get covered under Ind AS 109, which is provisions. Either you prepare the provision as per Ind AS 19, which we have already seen regarding employee benefits, or regarding the provisions created under Ind AS 37. Apart from these two standards, you need to understand that most of the other items are covered under Ind AS 109, and this explains with perspective why is this standard even more important than we actually look at. Clear? Now, let us try to understand how this standard has to be dealt with. This standard has to be dealt with in parts. So therefore, this is going to be at least a 5-hour long session, which we are discussing on your financial instruments, we'll have to break down each part separately so that it is easier for you to understand. So I will discuss this entire standard into multiple parts. The first one, where I will talk about the definitions on what is a financial instrument, what is a financial asset, what is a financial liability. This is first thing that I will talk about. And I'll also discuss about what is an equity instrument as well. When it comes to financial liability and equity, that is where the confusion starts. So I will start discussing as a second part the difference or the distinguishment between an equity instrument and a financial liability. That will be my second part of discussion. The third part of discussion is where I will talk about compound financial instrument. That means an instrument where two aspects coexist. These are called as compound financial instrument. First one, the definition. Second one is your equity and financial liability differentiation. And then I'll talk about compound financial instruments. These are significant items into our Ind AS 32 itself. There are other items under Ind AS 32 which I will park it after these three aspects. Now, after the first three aspects which we have understood, the definitions and the significance of identifying a financial liability and equity, then I will jump into the concept of Ind AS 109, where I'll first start with classification. There could be a classification of financial asset, also a classification of financial liability. Once I complete the classification, that is your part 4 totally, then I will come to part 5, where I'll do the recognition and measurement aspect. Then I'll come to part 6, where I will talk about derecognition of financial assets and financial liability. So classification, recognition, measurement, derecognition. So that will be a complete holistic view of your entire recording or accounting for financial instruments. So there I'm talking about 4, 5, 6, these three items dealing only with Ind AS 109. Then I will come to the aspect of something called as hedge accounting. Remember, there is also something to be discussed as far as recognition of financial instruments is concerned. So that aspect also has to be dealt with. So total 8 aspects so far. Then I'll come to the concept of what is a derivative and what is a hybrid instrument with an embedded derivative in it. So in logical, I will be discussing the standard into 9 pieces. 9 pieces. If required, I'll make it into 10 so that you understand it better. At the end of each piece, I'll keep on telling you that this is the first aspect that we discuss and this is as per so and so standard. So that should help you in breaking down the standard into small parts. Even when you revise the standard, always revise it in small parts. Such a big standard, if you basically read it at one single stretch, nothing will enter your head. Clear? Let us start with, first of all, understanding what is included as far as the standards are concerned. When I discuss about 32, 109 and 107, 107 is a pure disclosure standard. I'll move it aside. I will concentrate on 32 and 109. 32 deals with predominantly three aspects. What is the definition? What is the bifurcation or the division distinguishment between equity and financial liability? Lastly, offsetting of financial assets and liabilities. This concept of offsetting we have also covered under Ind AS 1. So similar concept of offsetting will appear as far as your Ind AS 32 is concerned as well. Then I'll go into Ind AS 109, which talks about classification and then the recognition and derecognition, measurement of these items, and finally into the aspect of hedge accounting. Here, so this is the basic ambits which I will discuss as a part of it. What I did not cover in this particular slide, but I will be discussing as we move further, is derivatives and hybrid instruments, which should also be covered under Ind AS 32. Clear? First of all, what is a financial instrument? When I talk about this concept of financial instrument, the first thing one has to understand is a financial instrument is arising from a contract. A financial instrument always arises by a contract. And this contract gives rise to a contractual right to one entity and a contractual obligation to the other entity. Let me take an example. X sold goods to Y at 1000 rupees consideration. The sale transaction is complete. Now what is left out? X, since it has made the sale, has a right to collect 1000 rupees from Y. Think from Y's perspective. Y has an obligation to pay 1000 rupees to X. So therefore, such contract of sale of goods has given rise to a contractual right to collect cash to X and a contractual obligation to deliver cash to Y. These contractual rights are called as financial assets and the others are called as financial liabilities, or contractual obligations are called as financial liabilities. Clear? Always remember, any contract or a financial instrument always gives rise to financial asset to an enterprise and a financial liability to another enterprise. But sometimes it may not always be a financial liability to the other enterprise. It could also be an equity instrument to the other enterprise. What is this situation which I'm talking about? Let's get into this. Let's say I enter into a rental agreement. A rental agreement is a perfect contract, purely a contract. This contract has given rise to two things. a right to receive rent to the owner or the lessor. Same way, it gives rise to an obligation to pay rent. An obligation to pay rent. Who took this obligation? To the lessee. This right to receive rent, when I said right to receive cash, is basically termed as financial asset. At the same time, my obligation to pay cash is termed as financial liability. I already gave you the example of sale of goods. So I'm giving you a different example here in the form of rental agreement, which also gives rise to a financial asset as well as a financial liability. But I said sometimes it need not be a financial liability, but it could be an equity instrument to the other enterprise. Let's see that example as well. If let's say I come with a discussion saying that issue of shares for share application money receipt. I've issued a prospectus. I've collected application money from the investor. So in that case, as far as the investor is concerned, the investor has a right to receive equity instrument of another enterprise. A right to receive shares. This right to receive share is perfectly an example of financial asset. It is an example of financial asset. But it also gives rise to an obligation to the enterprise, which is the company which collected the share application money. So the company which collected share application money has an obligation to issue share. It has an obligation to issue shares. This obligation to issue shares to the investor from whom I collected the share application money, can it be called as a financial liability? If I issue shares of my enterprise, is it a liability? Absolutely no. If I issued share of my enterprise, it cannot be considered as a financial liability, but it should be in turn considered as equity. It should be forming part of equity share capital of the enterprise. So this is exactly what I'm saying. I said it might give rise to financial asset to one enterprise, and in turn it might either result in a financial liability or sometimes might also result in equity instrument to another enterprise. So this is exactly why I said it could either result in financial asset or financial liability to the or financial liability or equity to the other enterprise. Look at what he said here. So therefore, a financial instrument gives rise to a financial asset to one enterprise, a financial liability or equity instrument to another enterprise. That is the first part of discussion that I go around here. Now, let's move further and understand what are these financial assets. One thing I understood, that is a financial instrument is a contract. It arises due to a contract which is written or oral and gives rise to a financial asset to one enterprise, financial liability or equity instrument to another enterprise. Then what is a financial asset? A financial asset can be defined in 5 different parts. First one, cash and cash equivalents, cash in hand, cash in bank, any short term securities which can be converted into cash within 60 days as per Ind AS 7. This part is a compulsory financial asset. Such cash can be held in any denomination, can be in rupee terms, can be in dollar terms, whatever it is, ultimately it is cash held in form of cash. Such item should be considered as a financial asset. Second, an equity instrument of another enterprise. I hold shares in the shares in Infosys. I hold shares in Reliance. I hold shares in Tata Steel. So I am holding the shares of another entity. So I hold equity instrument of another entity, which should be classified as financial asset to my enterprise because it is a pure form of investment. Clear? So investment into equity instrument of another enterprise should be considered as a financial asset. Cash and cash equivalent, first aspect. Second aspect was equity instrument of another enterprise. Third one, a contractual right to receive cash or a right to receive financial asset. Now, what is this contractual right to receive cash? A debtor gives me a contractual right to receive cash. A bills receivable gives me a right to receive cash. Deposits give me a right to collect back the deposit at the end of maturity period. Right? So these are a right to receive cash, where I have a right to receive cash. For example, let's say a rent deposit. I paid 3 months rent as a deposit to the owner. The deposit will be refunded back to me immediately at the end of when I vacate the premises. So when I vacate the premises, I'm going to get it back. So that means I have a right to receive that cash back at the end of the lease term. So even such kind of lease deposits should also be considered as a right to receive cash, therefore should be called as a financial asset. Clear? Moving on. Contractual right to receive another financial instrument. Let's say I have an amount receivable from a particular party. He said, instead of delivering cash, I will give you shares of a particular company. Shares of a particular company are also financial assets. So an agreement to basically receive or an arrangement to basically receive an equity instrument of another enterprise can also be considered as a financial asset. This falls under the definition of contractual right to receive another financial asset which is not cash. Clear? Moving on. Number 4. Contracts for exchange of financial assets and financial liabilities under conditions potentially favorable to the enterprise. What is this? What is this exchange of financial assets and exchange of financial liabilities under conditions which are potentially favorable to the enterprise? Let's come across this. Let's say, for example, I entered into a contract. The contract was between two enterprises, X and Y. X, under the part of a contract, is agreeing to deliver $100 on 25th of April. Okay. Y in return is agreeing to pay a consideration of rupees 7,500. Let's say this is the contract. A contract between X and Y where it will deliver $100 on 25th of April and has a right to receive cash to the extent of 7,500. Guys, if you look from X's perspective or Y's perspective, let me come up with this. From X's perspective, if I write down, I'll say he has a right to collect 7,500. At the same time, he has an obligation to deliver $100. If I write it for Y Limited, he has a right to collect $100 and he has an obligation to pay. What is his obligation to pay? 7,500 rupees. So therefore what? There is an exchange. What is the exchange? I have a right along with an obligation. I have a right along with an obligation. So therefore these items are rights are financial assets, right to receive cash, obligation to deliver cash, financial liability. Financial asset, financial liability. So each enterprise is exchanging their financial assets and financial liability. X is exchanging its dollars for cash in rupees. So therefore there is an exchange of financial assets and financial liability. Now what is this condition of potentially favorable and potentially unfavorable? Let's say as on 31st of March, as on 31st of March balance sheet date, if the exchange rate of rupee to dollar is rupees 78 per dollar, if I come across the exchange rate on 31st March or balance sheet date as 78 rupees per dollar, now you look at this. I am delivering $100 which are worth 7,800, but I am receiving a cash as a consideration only for 7,500. Therefore, when the dollar rate has increased to 78, then in such cases I can say that it is for X, it is potentially unfavorable. It is potentially unfavorable. To Y Limited, it is potentially favorable. Why did I use the word potentially? Why can't I simply use the word favorable or unfavorable? I'll tell you. This is potentially favorable. I use the word potentially favorable, potentially unfavorable because I am assessing this on balance sheet date 31st March. But when is the assessment going to happen? I'll have to assess whether there is an actual gain or loss on the date of settlement of the contract, that is 25th April. Therefore, as on 31st March, I'll still call it as potentially favorable or potentially unfavorable contract. While it comes to 25th April, the loss, the favorable or unfavorable positions are settled. On that day, I will remove the word potential. Clear? In a similar instance, let's say on 31st March again, if exchange rate is rupees 74 per dollar, X is delivering $100, which at the rate of 74 is 7,400 rupees of worth. He is receiving in turn from Y 7,500 rupees. In such case, this situation exactly reverses. Today, X is in a potentially favorable situation. For X, it is potentially favorable. And for Y, it is potentially unfavorable. Clear? So this is what I'm saying. So whenever there is an exchange of financial assets and financial liabilities between two entities, or where there's a contract for exchange of financial assets and financial liabilities, you will have to assess a situation where it is potentially favorable and potentially unfavorable. If it is potentially favorable, like we have seen in the situation, then it should be considered as a financial asset. Contracts for exchange of financial assets and financial liabilities under a contract which are potentially favorable to the enterprise. So the word potentially favorable is appearing out there. Last point, that is point number 5 under financial assets, is irrelevant for us. I'll tell you why. Contracts settled by receiving entities' own equity instruments. Contracts settled by receiving my own equity instrument. Now, if you know Companies Act, you cannot receive your own equity instrument because it would normally account for the situation as buyback. So a buyback is restricted as per Companies Act, only subjected to certain conditions buyback is possible. Therefore, under a contract, you are not entitled to receive your own equity instruments. So that's why I discussed about part 5, saying that you can receive entity's own equity instrument, but I'm saying it is irrelevant because your Companies Act in India is restricting you from doing that. Then you might ask, sir, why is it included then? This is an IFRS. It is not just applicable to India, but it is applicable everywhere across the world except for a very few countries. So US is one big exception out there. But fundamentally, if you look at US is also coming into the ambit of IFRS now. So therefore, you have to be open to ideas where it will be in such a situation that it might be against the law of the land, but it might be included in your standard. If you remember in India's 12, we came across the concept of carrying backward of losses. India's 12 carrying backward of losses is there under the standard, but in under Income Tax Act, you don't have application of such kind of carrying backward of losses. We only know about carrying forward of losses. There are certain countries where there is a concept of carrying backward of losses, not in India. So let us be open to the idea that the standards are applicable to every other country as well. So let us accept that certain paragraphs may not have an application in India because it might be restricted as per some other act. Clear? So financial assets broadly into 4 categories which are relevant for us. Cash and cash equivalents, equity instrument of another enterprise, like I holding shares in Infosys, I holding shares in Reliance, my holding of shares in Tata Steel, so on. Contracts for exchange of financial assets and financial liabilities, which are potentially favorable to the enterprise, or a contractual right to receive cash or another financial asset. This in total will be my definition of financial asset. Now, what is a financial liability? If you go back to the earlier case which I told you, here I said it could be potentially favorable to X, then automatically it will become potentially unfavorable to Y. So whenever the situation of potentially favorable arises, it is a financial asset. But whenever there is an exchange of financial assets and liabilities under conditions which are potentially unfavorable to the enterprise, then it should be classified as a financial liability. Clear? Financial liabilities are contractual obligation to deliver cash or another financial asset, creditors, outstanding expenses, bills payable, salaries payable, contractual obligation to pay cash or deliver cash, or instead of cash to deliver another financial asset. Clear? These are financial liability. Contracts for exchange of financial assets and liabilities under conditions which are potentially unfavorable to the enterprise. We have seen the example of X and Y exchanging in a contract. Wherever it is potentially favorable, I'll classify it as financial asset. When it is potentially unfavorable, should be classified as financial liability. Remember, if it is a financial asset to one enterprise, it will automatically become unfavorable to the other enterprise and classified as financial liability. The last one is the most important. Contracts settled by delivery of entities' own equity instruments. Contracts which are settled by delivery of entities' own equity instrument. That part is very important. Park it aside. I'll discuss it. I'll discuss it in detail. But come to equity instrument. Equity instrument is an instrument which evidences residual interest in enterprise. What do you mean by residual interest? What is residual interest first of all? A residual interest means the last interest in the enterprise. After realizing all assets, settling all liabilities, whatever is left out, last is residue. That residue, if I am entitled to receive, then I should be classified as equity instrument. That is a pro rata share in net assets. What is net asset? Asset minus outside liabilities. After settling of all the liabilities with the help of your net assets, the balance of the net assets residue is what the equity instruments are entitled to receive. Clear? And contract settled by delivery of entity's own equity instrument. If you look at this part, contract settled by delivery of entity's own equity instrument, this I have included both under financial liabilities as well as equity instrument. So therefore, I have to understand the significance of when does it become a financial liability, when does it become an equity instrument. Whenever there is a contract settled by delivery of entity's own equity instruments. Clear? Yes, guys. So let's look at this concept of contract settled by delivery of entity's own equity instruments. And I'm telling you that these contracts can either be classified as financial liability or as equity instrument. Now you might come up and ask me, is it at the intention of the management? Absolutely no. Because it should be as per the terms of the contract that should either be classified as financial liability or as equity instrument. Let us understand this concept first. In essence, if I'm talking about, we apply a test called as fixed for fixed test. We apply a test called as fixed for fixed test. Now, based on this fixed for fixed test, we determine if a contract for settlement of delivery, which is settled by delivery of entity's own equity instrument, is a financial liability or an equity instrument. What is this fixed for fixed test? Let us understand. I'm talking about contracts which are settled by delivery of entities' own equity instruments contracts which are settled by delivery of entities own equity instrument. Now let's say the contract has two aspects. One is a receiving aspect and other one is a giving aspect, right? Right to receive and obligation to deliver. What are you delivering here? Under this contract, I'm only delivering entities own equity instrument. Let's say I have a right to receive. In the first example I'm giving, right to receive rupee 10 lakhs. I have an obligation to deliver 10,000 shares of my enterprise. First type of contract. Second, where I have a right to receive $5,000 and I have an obligation to deliver 2,000 equity shares of my enterprise. Number 3, I have a right to receive 10 lakhs, but my obligation to deliver shares based on market price on date of settlement. I don't know how many shares I'll issue, but it will depend upon market price of the date of the settlement. If market price is 50, 10 lakhs divided by 50. Market price is 60, 10 lakhs divided by 60. That way I keep delivering the shares. Number 4, a right to receive $5,000, where again my shares are based on market price. Shares to be issued are based on market price on date of settlement. When I talk about such kind of contracts, a right to receive 10 lakhs, this is a fixed consideration. My right to deliver 10,000 shares, fixed number of shares. My right to receive $5,000, it depends upon the dollar exchange rate. So this is a variable consideration. But my obligation to pay 2,000 shares is a fixed obligation. Right to receive 10 lakh rupees, fixed right. There's no change in the amount. The amount is 10 lakhs. But the shares which I will issue is based on the market price on date of settlement. Therefore, the number of shares are variable, will depend on the market price on the date of settlement. $5,000, it's a variable consideration because it depends on the exchange rate of dollar. And even my shares are also variable. So in this way, every contract to deliver entity's own equity instrument, we will have to look at what is the consideration which I am getting and what is my obligation to deliver entity's shares. If my consideration is fixed for delivering a fixed number of shares, then these instruments will be classified as equity instrument. This will be classified as equity instrument. Where I have a variable consideration to receive a fixed number of shares or to deliver a fixed number of shares, then it will be classified as financial liability. Similarly, if I have a right to receive 10 lakhs fixed consideration to deliver shares based on the market price at the date of settlement, it will again be classified as financial liability. Where both are variable, it will still be classified as financial liability. So in a simple understanding, I can say, if I have an obligation to deliver fixed number of shares to receive against a fixed consideration, to receive a fixed consideration, only in such cases, those contracts shall be classified as equity instruments. In any case, either the consideration which I have to receive or the number of shares which I have to deliver are variable. That means they depend upon what is the situation at the time of settlement. Then they should be classified as financial liability. So this is called as fixed for fixed test. This test is fundamentally called as fixed for fixed test. Clear? So this is fundamentally what I'm talking about, a fixed for fixed test. And this fixed for fixed test is applicable whenever the contracts are intended to be settled by delivery of entities on equity instrument. And if your fixed for fixed test is satisfied, then such instrument should be classified as an equity instrument. If your fixed for fixed test is not satisfied, then it should be classified as a financial liability. Let's look at something. So what did we say? Contracts settled by delivery of entities own equity instrument can either be a financial liability or could be classified as financial instruments. It depends on a fixed for fixed test. If the consideration payable under the contract or the number of shares issued for settlement, if either of them is variable, then they have to be classified as financial liability. But if the consideration payable under the contract is fixed and the number of shares issued on settlement is fixed, then it should be classified as equity instrument. Let's say, for suppose, I've issued compulsory convertible preference shares to my investor. My compulsory convertible preference shares were issued in the year 2020. I received an amount of 1 crore from the investors for which I issued them compulsory convertible preference shares. So 1 crore fixed consideration. My obligation is to deliver 10,000 equity shares of the enterprise at the end of 3 years under the CCPS, compulsory convertible preference shares. In such cases, it is a fixed for fixed test is being satisfied. So though they are preference shares, I will classify them as equity instruments only. But if I say I will issue equity shares after 3 years at 20% discount based on the market price after 3 years. I don't know what is the market price after 3 years. Whatever is the market price, I will issue those shares at 20% discount. Even that also I don't know. I don't know what is the market price. So what is the 20% discount price? I don't know. Therefore, I don't know what is the issue price per share. Therefore, the number of shares which are expected to be received under the contract are variable. In such case, even though I have a fixed consideration, since the consideration under the number of shares to be issued under the contract are variable, it should be classified as a financial liability. And this, in short, is the difference between an equity instrument and a financial liability, which is settled with the help of fixed for fixed test. If your consideration received under the contract is fixed and it is settled by delivery of fixed number of equity shares, then it is an equity instrument. If not, it is a financial liability. Clear? Yes, guys, I've given you the example of compulsory convertible preference shares where I told you about identifying it as equity or financial liability. It depends upon how the consideration of the contract is received and what is the number of shares being delivered under the contract. But remember, if the shares are not compulsory convertible, but instead they are optionally convertible, it is at the option of the holder. If he wants to receive cash, he will receive, or if he wants to deliver it in the form of shares, he wants the contract to be settled by delivery of shares, he will receive equity shares. In such cases, how do I consider it? Okay, in such cases, should I consider it as equity or should I consider it as financial liability? It is none, because it includes both components. It includes an obligation to pay cash if the holder requires it, and also it includes a right to convert into equity shares. When both of these coexist in one instrument, then these are called as a compound financial instrument. Their right to receive cash is a financial liability. Their right to receive equity shares on settlement is their right to conversion into equity share on settlement is an equity instrument. So therefore, there could be situations where one single contract can have both equity and financial liability together. You want more examples? I shall give you. Let's say I am talking about a convertible debt I've received in the form of a debt and it is convertible into equity shares upon settlement. A debt carries interest, right? So a periodic interest payment is a contractual obligation of the enterprise to pay cash. So such obligation to pay cash of the enterprise should be classified as a financial liability. But their settlement is by converting the debt into equity shares on settlement. So whenever they are converting into equity shares, there could be an equity component which is embedded into it. So therefore, we need to come across situation, or we do come across situations where there is a debt as well as an equity component which coexist. So it may not be a straight situation where we look at an equity or equity or financial liability, but there can be a situation where, second guys, you come across a compound financial instrument. What is a compound financial instrument? A compound financial instrument is where there is a financial liability and equity which coexist. A perpetual debt with fixed return. What is perpetual debt? No maturity. It will keep on continuing to come. So when there is no maturity, what is your obligation to pay cash? There's no obligation unless and until it arises on liquidation. So to discuss about this instrument, we come across a situation called as restriction from classification as financial liability. Your restriction from classification as financial liability are basically divided into four items. First one, puttable financial instruments. What is this puttable? Puttable means there is a right to put back the instrument to the company. The holder has a right to put back. What is a right to put back? Put back means redemption, as simple as that. So, the holder of the instrument has a right to demand redemption from the from the company. In such cases, where the issuer or the holder is holding a right to put back the instrument, then these are called as puttable financial instrument. They cannot be classified as financial liability. Let's say a company has issued an instrument to you and he said this instrument is for 3 years. It will be renewed continuously unless the company wants to pay the amount. Unless the company wants to pay the amount. Therefore, the redemption is at the option of the company. Whenever I want to redeem, I will redeem within a span of 3 years or thereafter. In such cases, they are called as puttable financial instruments and they should not be considered as a financial liability. Such financial liabilities, which are only payable at the time of liquidation, is also a puttable financial instrument. These are contracts which will be settled only at the time of liquidation of the company. Perpetual debt instrument. What is perpetual debt? It is a debt. You have to pay it. But when I will pay it, I will only have an obligation to pay such debt at the time of the liquidation of the company. In such cases, you will have to not classify it as financial liability, but instead they should be classified as equity instrument. Irredeemable preference share, classic example. Irredeemable preference shares also cannot be classified as financial liability because they will also be repaid only upon liquidation of the enterprise. Financial liabilities payable only on redemption, payable only on liquidation, guys, not redemption. At the time of liquidation of the company should also be classified as equity and should not be classified as financial liability. So what am I saying? If the company has a right to redeem the instrument when they want it, I will redeem the instrument when I wish. I wish to redeem the instrument today, I will redeem. If I don't want to redeem, I will keep on carrying forward the instrument. Then in such cases, they are puttable financial instruments excluded from the definition of financial liability. They have to be classified only as equity instruments. Such financial liabilities which are payable only at the time of liquidation of the enterprise. It is a financial liability, sir. It is purely debt. Debt means compulsory payment. But when is the payment arising? A payment is arising at an uncertain future date, which is at the time of liquidation of the enterprise. In such cases, they should not be classified as financial liability, but instead they should be classified as equity instrument. With the help of this restriction, you come across the situation like this. Let's say I have a preference share which is irredeemable. It should always be classified as equity instrument. But if it is redeemable and redeemable after a fixed maturity date or on a specific date, it is a financial liability. If it is redeemable at the option of the holder of the instrument, I hold the instrument, I can demand you for liquidation, I can demand you for payment at any point of time. Then it is a demand liability which should be classified as financial liability. But if it is redeemable at the option of the issuer, then it should be called as puttable financial instrument, which should be classified as equity instruments. With this logic, if I go, you might come up with logic saying that, sir, you cannot issue preference shares beyond 20 years. I understand. Again, I'm repeating, that is the restriction of your Companies Act in India. So do not apply the standard only in India. It is globally everywhere the standard should apply. Therefore, do not apply the logics of your Indian acts into the standard. Clear? Irredeemable preference shares cannot be issued. I know. Perpetual debts cannot be issued. I know. That is your Companies Act restriction. But the standard is applicable beyond your Companies Act and therefore should also discuss about certain events which are not as per your Indian Companies Act or Indian Income Tax Act. Now, if I talk about dividends on these shares, dividend on preference shares, if they are of cumulative nature, that means I have an obligation to pay whether I have sufficient profits or not. If I don't have sufficient profits, the obligation to pay does not go. It only gets transferred to subsequent years. So today, in the current year, I did not make sufficient profits. If it is a cumulative dividend, I will have an obligation to pay in the subsequent year. The next year also lost, what you will do? I'll carry forward to that next year. But my obligation to pay is not zero. My obligation to pay continuously keeps on arising. In such cases, it should be classified as financial liability. But my obligation to pay dividend on a non-cumulative preference share, in case I don't have a sufficient profits to pay the preference dividend or the management does not intend to pay the preference dividend, such obligation does not arise. Therefore, the obligation is only arising based on the option of the holder or based on the option of the company. Therefore, since it is at the option of the company to pay such dividend, it should be classified as equity instrument. It should be classified as equity and not a financial liability. Applying these principles into compound financial instruments where both equity and financial liability coexist, let us observe. Let's say I have a perpetual debt instrument. There is no redemption. Redemption will only occur at the option of the company or at the time of liquidation of the enterprise. Purely the case of puttable financial instruments, therefore should not be classified as financial liability, should be an equity instrument only. But they have a fixed returns every year. That means I have an obligation to pay the fixed amount of interest every year. That amount of fixed interest is a financial liability. The instrument as such is an equity, but the obligation to pay fixed returns is a financial liability. Redeemable instruments with discretionary returns, like your non-cumulative preference shares. When I talk about the amount of preference dividend is at the discretion of the company, equity, but they are redeemable after a certain period of time. Therefore, there is a financial liability. So, redemption is financial liability, discretionary returns is equity, both combined together in one single instrument should be called as a compound financial instrument. Instruments which have a fixed return and an option to convert. To the extent of option to convert, it is equity. To the extent of a fixed return, it should be considered as financial liability. So again, these are classic examples of a financial instrument, a financial instrument where both financial liability and equity aspect coexist. Whenever we come across these kind of compound financial instruments, we will have to separate the financial liability and equity. We will have to separate the financial liability and equity. This process of separation is called as split accounting. This process of separation is called as split accounting. Let's look at it. Let's say, for example, I have an OCD, optionally convertible debentures. Okay. Date of issue of these debentures, 1st April 2020. Okay. Term or tenure is, let's say, 5 years. The coupon rate that it carries, let's say, is about 8%. Value of OCDs, let's say, is about a lakh. At the end of 5 years, these debenture holders have an option to either receive cash of 1 lakh or they could convert themselves into equity shares. If I say that my effective interest rate EIR is 10%, what is your effective interest rate? Effective interest rate is nothing but the rate in market at which debentures are issued without conversion option. Without conversion option. Without an option to convert, if the market is issuing debentures at the rate of 10%, it should be called as EIR. EIR stands for effective interest rate. The rate at which the debentures can be issued without conversion option is an EIR. Now, let's say I'm solving this problem and I'm saying since there is an option to convert, it is a compound financial instrument. There's an obligation to pay debenture interest every year and also a liability to pay the debenture interest at the debenture value at the end of the redemption. That is also a financial liability, but there is an option to convert into equity shares. Such option is an equity instrument. If I have to solve this problem, I am applying the principles of split accounting. What is split accounting? Split accounting should be applied to divide the amount of equity instrument from the financial liability. How do I divide it? Remember, always in such kind of situations, my financial liability should be measured at fair value, while your equity part within the instrument should be measured in this way. Fair value of the instrument fair value of the compound financial instrument minus fair value of financial liability. Let's apply the principles of split accounting in this example and try to understand split accounting. First, I'm talking about measurement of financial liability in the instrument. Look at how I calculate. Here, cash outflows, discount factors at effective interest rate, finally discounted cash flow. Year 1 to 5, this fellow has a cash outflow which has to be paid to the extent of 8% on 1 lakh, which is 8,000. At the end of 5th year, since it is at the option of the holder of the instrument to demand for cash or to receive equity shares, since it is at the option of the holder, it is not puttable instrument, it is a financial liability. So they have a right to collect back cash of 1 lakh at the end of 5th year. Apply discount factors. Discount factors of 5%, PVF and PVF. Effective interest rate is how much? 10%. 10% for 5 years. Calculate. Answer is 3.79. I'm only taking 2 decimals. If I have to get PVF, this is 0.62. Multiply and get the values. 8,000 into 3.79 is 30,320. This is 62,000. Total is 92,320. This is the fair value of financial liability. If I have to identify the value of equity in this, equity is equal to, what is the fair value of the instrument? 1 lakh minus financial liability is 92,320. Therefore, I'll have to recognize this in equity component at 7,680. This is called as split accounting. Remember, instead of taking optionally convertible, if I have changed this to compulsory convertible, if I change it to compulsory convertible, then in such cases, even the last outflow should not be considered. Then in such cases, this last outflow should not be considered. In such cases, if it is a compulsory convertible debentures, if debentures are compulsory convertible or CCD, then in such cases, the value of my financial liability and equity will change significantly. Financial liability is equal to and equity is equal to. What is your financial liability then? The last cash flow does not arise. Therefore, it should only be 30,320. Therefore, the entire amount balance of the total should be considered as equity. 1 lakh is the total value of the instrument. So 9,69,680 should be considered as my equity component if the same debentures are considered as compulsory convertible instead of being considered as optionally convertible. Clear? So the classification even in your financial statements also, the equity portion should be classified under other equity. This should be classified under other equity. Within your shareholder funds, and this part of financial liability shall be classified under current and non-current. To the extent the payment falls due in next 12 months, should be current. Amount falling due after the next 12 months should be non-current. They should be classified as current and non-current liabilities depending on when they fall due. Clear? This is my concept regarding split accounting, which is applicable for compound financial instruments. I've shown you both the situations when it is optionally convertible debentures and also when it is a compulsory convertible debenture. Clear? So we have seen split accounting where a financial liability and equity will be separated from a compound financial instrument using the process of split accounting. Financial liability should always be measured at its fair value, and the difference between the fair value of the instrument and the difference between the fair value of the financial liability should be classified as equity. Let's come to the same thing. This is split accounting. Whenever I have a compound financial instrument where both equity and financial liability coexist in a single instrument, then I'll have to separate it between equity and financial liability. Financial liability should always be measured at its fair value. What is the fair value of a financial liability? It is the present value of cash flows arising from the instrument discounted at effective interest rate. What is effective interest rate? The rate at which similar instruments can be issued without a debt component in it. Without having a debt component in it, if there is an instrument issued, the rate at which I would have issued it shall be considered as effective interest rate. Clear? Now, whenever I talk about an equity instrument, an equity portion of that instrument should be the difference between the fair value of the instrument and the fair value of financial liability. Clear? Now, moving ahead from here, sometimes there could be a situation which can emerge where a financial liability can be classified as equity because of change in terms of the contract. It was initially a financial liability, but it has subsequently become an equity instrument, or the holder of the instrument has agreed to become equity at a later point of time. Initially, when I issued, it was an equity instrument, but subsequently, the holder of the instrument and the company have renegotiated so that they become financial liability. It was initially introduced as compulsory convertible preference share, purely an equity instrument, but subsequently, the holder of the instrument and the company got into an arrangement where the holder has been given an option saying that you can convert yourself into financial liability. So he has converted into financial liability. So instead of compulsory convertible preference share, it became a redeemable preference share. Whenever such event happen, you have to reclassify from a financial liability to equity or from an equity to financial liability. Whenever such reclassification happen, and let's talk about the first reclassification where a financial liability, it was initially a redeemable preference share, but later on the preference shareholders have accepted equity shares upon maturity. In such case, the financial liability became equity. In such case, it should always be reclassified at carrying value. So whatever is the carrying value of financial liability, I will take the same carrying value into equity instrument. There is no gain or loss which emerges in the case of this situation where a financial liability converts into equity. Initially, it was an equity instrument. That means it is a compulsory convertible preference share. But now the shareholders and the company have agreed to redeem the preference share after a fixed maturity date. In such cases, it gets classified from an equity instrument to a financial liability. Whenever such classification occurs, I will have to reclassify the equity into financial liability at fair value. So the measurement has changed. It was carrying as equity instrument on a particular value, but when it came to a financial liability, I have a different value altogether because it should be measured at fair value. That means there is a difference which emerges. That difference is a gain or loss. Such gain or loss should be transferred to other equity. That means it should be included within the reserves of the company itself. This is a very small, tiny concept that goes into reclassification of an equity instrument and a financial liability. And to sum up what we have discussed so far, we have covered aspects of Ind AS 32 only, where under the concepts of Ind AS 32, I have discussed about what is the importance of your financial instrument standard and what is the significant application of this standard in multiple places of your financial statements. Then we went into the definitions of financial instrument, financial asset, financial liability, and equity instrument. Then we have seen a fixed for fixed test to differentiate between a financial liability and equity when I have a contract which can be settled in entity's own equity instrument. So we have seen a fixed for fixed test there. Then we came across certain exemptions for instruments which should not be classified as a financial liability. Puttable financial instruments, where the company has a right to redeem the instrument at any uncertain future event or any uncertain future date, or the instrument is only redeemable upon liquidation of the company. There is no fixed maturity date. In such situation, they cannot be classified as financial liability. They should only be classified as equity instrument. That was a fourth aspect which I covered as exemptions or exceptions from being classified as financial liability. The last one, what I spoke about, is about compound financial instruments, where I apply split accounting to identify the concept of financial liability and equity which coexist in one single compound instrument. Lastly, I was talking about reclassification of financial liability and equity instruments when they get reclassified from equity to financial liability or financial liability to equity. And that will bring us to the end of discussion to a part of Ind AS 32. To a part. Because under Ind AS 32, we also have certain other aspects like offsetting your financial assets and financial liabilities. And also we have a discussion regarding hybrid instruments and embedded derivatives. I will park these two towards the end. So I will give a full stop to Ind AS 32 here or a comma to Ind AS 32 here. I will continue Ind AS 32 at a later point of time. Now I'll have to get into the aspect of Ind AS 109, where I discuss about the classification, recognition, measurement, derecognition, and the concepts of hedge accounting. Clear? Yes, guys. So let's get into the concepts of Ind AS 109 now. Guys, Ind AS 109 particularly talks about recognition and measurement of your financial assets and financial liabilities. So when I talk about this recognition and measurement, you need to first understand that recognition and measurement is depending upon the classification of financial assets and financial liabilities. Depending upon the classification of financial assets and financial liabilities, they should be recognized or they should be measured as on each balance sheet date in your financial statements. So that means the classification becomes the most important aspect. Without the classification, you cannot get into measurement or recognition aspects. So let's talk about classification. So I will break this classification into two parts: financial asset classification separate and financial liability classification separate. First, let's primarily talk about financial asset, which is a very detailed discussion that we go into. When I talk about classification of financial assets, you need to understand that the financial assets can be classified into three categories. First one is called as financial assets measured at amortized cost. Next one, financial assets measured at fair value through P&L. Third one, financial assets measured at fair value through OCI. These are the three fundamental classifications of a financial asset. So any financial asset in the enterprise should either be classified as financial assets measured at amortized cost, or they can be measured at fair value through P&L, or they can be measured at fair value through OCI. Now, how do you determine where each financial asset should be categorized? Should it be categorized as amortized cost, or should it be categorized as fair value through P&L, or should it be classified as fair value through OCI? This depends upon two basic tests. First test for classification is called as instrument level test. In an instrument level test, I'll apply something called as a test for the instrument. This test is called as CCPI, solely for payment of principal and interest. That means in a contractual cash, if the contractual cash flows arising from the instrument are in the form of principal and interest, if the contractual cash flows arising from the instrument are in the form of principal and interest, then you will basically say that the CCFC test or the contractual cash flow test is satisfied. This CCFC test, contractual cash flow test, is an instrument level test. That means every financial asset has to be first put into the instrument level test, which is called as CCFC test. Under the CCFC test, we will assess whether the instrument is deriving cash flows solely in the form of principal and interest. If it is deriving cash flows solely in the form of principal and interest, then we call such kind of instruments as debt instruments. We call such kind of instruments as debt instruments as per instrument level test. If your contractual cash flow test is not satisfied, that means the cash flows arising from the instrument are not solely in the form of principal and interest, then we will say that the contractual cash flow test is not satisfied and they should not be classified as debt instruments, but they in turn should be classified as equity instrument or a derivative instrument. So I am primarily saying under classification of financial assets, I'll first put them through an instrument level test. Under an instrument level test, I will have a test called as CCFC, contractual cash flow test, where the cash flows arising from the instrument are solely in the form of principal and interest. If this test is satisfied, they are debt instruments. If they are not satisfied, they are equity instruments or a derivative instrument. Clear? That is the first test that we apply for classification of financial assets called as instrument level test. The subsequent test after the instrument level test, after applying the instrument level test and classifying your financial assets into debt instruments or other than debt instruments, then I'll apply something called as business model test. This test is called as entity level test. So first one was instrument level test. Second one is entity level test. A business model test is called as a an instrument level test is called as contractual cash flow test, while your entity level testing is called as a business model test. Business model test. If I apply to a debt instrument, the business model test, then I will have to see whether the intention of the enterprise is to derive cash flows from this financial asset until maturity in the form of principal and interest only. My intention is to derive cash flows from this instrument in the form of principal and interest only. Then I will say that this business model test is satisfied. The other two instances which can emerge is where the business intention is probably to trade with this financial asset. A debt instrument which is held for the purpose of trade or which is held with an intention to sell. So that is a situation where the business model test is not satisfied. So based on these two tests, that is instrument level test and business model test, we will have to continue with classification of financial assets. Let's look at the classification then. Your classification of financial assets are predominantly into two tests. The first test is called as instrument level test, where we apply contractual cash flow testing. Second one is in entity level testing, which is called as business model test. First, when I apply instrument level test, I will see whether the contractual cash flows arising from a financial asset are solely in the form of principal and interest. Based on your instrument level test, I can divide the classification into two types of instrument, debt instrument and equity instrument. Coming down to entity level testing, which is subsequent test after the instrument level test, I will apply a business model test. Under a business model test, I will try to determine what is the objective of the enterprise to derive benefit from the financial asset. Do I want to derive benefit from the financial asset by holding it until maturity to derive the cash flows? Or do I have an intention to sell this financial asset to derive cash flows? Or is it a combination of both? That means I intend to derive cash flows until a particular point of time. Subsequent to that, I want to derive cash flows from sale of this. So that is a combination of both. So these two tests are significantly applied to any financial asset to help for the classification. Based on these two tests, the financial assets should be classified into three categories. Financial assets measured at amortized cost, your financial assets measured at fair value through P&L, and finally financial assets measured at fair value through OCI. Now, I'll look at the measurement at a later point of time, but look at here. If I have to classify the financial assets as amortized cost, then you have to make sure that as per the CCFT test, it should be a debt instrument only. An equity instrument cannot be classified as financial asset measured at amortized cost. So that means that financial asset should derive cash flows solely from the payment of principal and interest. And under business model test, it should be the intention of the enterprise to derive benefit from the financial asset hold it till maturity and receive cash flows in the form of principal and interest. That means if I apply CCFC test, then it is a debt instrument. That means it derives cash flows solely from payment of principal and interest, and it is the business intention also to hold it till maturity and derive cash flows in the form of principal and interest. Then you can classify this instrument as an amortized cost. I think this is a better way of representing. So first, a financial asset is put into instrument level test and we apply a debt instrument and other than debt instrument. The debt instruments then put into a business model test if they are expected to derive cash flows or if it is the intention of the enterprise to derive cash flows solely from principal and interest, then it can be classified as AC, amortized cost. But if your business model test is to derive a benefit from the financial asset as a combination of both, to receive principal and interest to a certain point of time and then subsequently sell the instrument, then you will classify this instrument as an FVTOCI. If it is neither of that, I neither have an intention to hold it for maturity, I neither have an intention to hold it initially and then sell it. That means my intention is predominantly to trade with this financial asset, then I will classify it as FVTPL, fair value through P&L. If applying an instrument level test, let's say a financial asset is no longer a debt instrument, that means it is not deriving cash flows in the form of payment of principal and interest and should be classified as other than debt instrument, then under other than debt instrument, there are two types of instrument. One is called as an equity instrument, other one is called as a derivative instrument. The easiest part is derivative instrument because there is no further application of entity level test. Whenever you say by instrument level testing, that is a contractual cash flow test, a particular instrument is a derivative, then the derivative instrument should always be classified as FVTPL. There is no chance of any other classification for a derivative instrument. But if it is an equity instrument, that means it is not deriving cash flows in the form of principal and interest. It signifies equity interest of another enterprise. For example, it is an investment in shares of Infosys. It is an investment in shares of Reliance. In such case, or an instrument of mutual fund, then in such case, I'll have to apply a business model test where I will see if it is held for trade. It is held for trading means what? My intention is to derive cash flows from sale of that instrument. In such case, it should be classified as FVTPL. If it is not held for the purpose of trade, that means you don't want to derive cash flows from sale of the instrument, then I'll apply the second level of testing where I will see whether it is designated as an FVTOCI. That means it is an intention of the management if they want to classify it as FVTOCI or not. If they want to classify it as FVTOCI, they can present that equity instrument as fair value through OCI. But if they do not designate it as FVTOCI, it should always be classified as FVTPL. That means an equity instrument can never be classified as amortized cost. An equity instrument should either be classified as FVTPL or should be classified as FVTOCI. When should it be classified as FVTOCI? I'll classify an equity instrument as FVTOCI only if it is not held for trading. It is not held for trading and it is specifically designated as FVTOCI by the management. Only such situation I will classify an equity instrument as FVTOCI. In any other situation, that is, an equity instrument is held for the purpose of trade or it is not designated as FVTOCI, I will classify such equity instruments as FVTPL. Clear? I'll repeat. I said a financial asset should be classified as amortized cost only if it is a debt instrument. No equity instrument in any circumstance should be measured at amortized cost. If a debt instrument has to be classified at amortized cost, then the entity level or entity's intention is to derive cash flows from this instrument from only in the form of principal and interest until maturity. Then you can classify the debt instrument as amortized cost. Best examples that you can give here is rental deposits, debtors, and cash in bank. These are having an intention to derive only principal and interest, therefore should be classified as amortized cost. But a debt instrument can also be classified as FVTOCI instead of amortized cost. When does that arise? When it is a debt instrument and the intention of the management is to derive cash flows from principal and interest initially, but with an intention of subsequent sale, then in such situation, I will classify such debt instrument as FET-OCI. An equity instrument should be classified as FET-OCI only if number one, it is not an equity instrument which is held for trade, and it is specifically designated by the management as FET-OCI. A debt instrument can be classified as FETPL if it can neither be classified as amortized cost nor be classified as FETPL, or it can be irrevocably designated at the inception of the arrangement itself as a FETPL. Irrevocably designated means as the instrument arises, it is a debt instrument and the intention of the management is to always carry it at FETPL. That is irrevocable. That means you cannot reshift it again. So it is designated at the inception as FETPL. An equity instrument can be classified as FETPL only if it is not specifically designated as FET-OCI or the equity instrument is held for the purpose of trading. Clear? Have a good look at whatever is being written out there in this particular slide, because this particular slide will give you a lot of inputs on when to classify each instrument either as FETPL or FET-OCI or amortized cost. It completely depends upon two tests, that is amortized, that is your instrument level test and your business model test. Yes, guys, so I'll repeat what I just said. I was discussing the concept of classification of financial assets, and I told you classification is the underlying principle which gives rise to your measurement and recognition. That's why we have to understand classification before we get into recognition and measurement. Under classification, I told you that we apply two types of tests. First one, which we apply, is called as instrument level test. Under an instrument level test, I need to apply or I need to understand what is the nature of the instrument. I need to understand the nature of financial asset. A financial asset, if it has a nature to derive cash flows solely in the form of principal and interest, then I will say that the CCFC test, contractual cash flow test, is satisfied. That is the instrument level test. Best examples to satisfy an instrument level test are debtors, bills receivable, your deposits, fixed deposit, your deposits, that is your rental deposits or fixed deposits, any advances given, all these are primarily applied to instrument level tests. Clear? So they are satisfying instrument level test. If your CCFC test is not satisfied, then I will call them either as equity instrument or can be called as debt instrument. But if some instrument satisfies the CCFC test, that means it derives cash flow solely from principal and interest, then it should be classified only as a debt instrument. Once I apply the instrument level test, the next level of testing or next tier of testing is called as entity level test. This is called as business model test. Under a business model, I'll test the intention of the enterprise. How does the enterprise expect to realize benefits from the financial asset? If I want to derive the benefit from financial asset by holding it till maturity, or do I expect to derive benefit by sale, or do I expect benefits to be derived from holding it for a particular period of time and subsequently selling it? In such case, I'll go with this particular classification. Financial assets, first by instrument level test, are classified into debt instruments, equity instruments, and derivative instruments. First, under debt instruments. Under debt instruments, first I'll apply business model test, and if it satisfies the business model test with the intention of the enterprise to hold the instrument till maturity and to derive cash flows only in the form of principal and interest, I'll classify it as amortized cost. If my intention of the enterprise regarding the debt instrument is to derive cash flows initially from principal and interest but subsequently from sale, I'll classify the debt instrument as FVTOCI. My instrument has no intention at all. My intention is neither to hold it till maturity nor to hold it initially for principal and interest and subsequently to sell. That means you have an intention to sell the instrument right up front. In such situation, I'll classify it as FVTPL. Instead of applying all these three classification, a debt instrument at the inception itself, the management can irrevocably designate it as FVTPL. Without applying a business model test, I have directly a benefit, or I have an option to basically designate it as FVTPL at the inception itself. These are the three possible classifications for debt instrument. However, when I come to equity instrument, they can either be classified as FVTPL or they can be classified as FVTOCI. For me to classify an equity instrument as FVTOCI, it should be an equity instrument which is not held for the purpose of trade, and it should be specifically designated as OCI. If the equity instrument is held for trade, it should be treated as FVTPL. Or if an equity instrument is not held for trade but not designated as FVTOCI, then it should be again treated as FVTPL, or it should be classified as FVTPL. A derivative instrument will not go through all this process. A derivative instrument should always be classified as FVTPL only. Clear? That is when I played you this slide, which gives me a holistic understanding of how each financial asset is being classified. An amortized cost can only be a debt instrument where the enterprise has an intention to derive cash flows until maturity only from principal and interest. While a debt instrument can be an OCI as well if the intention of the enterprise is to derive cash flows from principal and interest initially and to derive cash flows from subsequent sale. An equity instrument can be classified as a FVTOCI when it is not held for trade and it is specifically designated as FVTOCI. A debt instrument can be classified as FVTPL irrevocably at the time of inception, or if if the equity instrument can neither be classified as amortized cost nor being classified as FVTOCI. However, an equity instrument can be classified as FVTPL only if it is held for the purpose of trade, or if it is not held for trade but not designated as FVTOCI. Derivative instruments are always FVTPL. Clear? This is regarding my classification of financial assets into three categories: amortized cost, FVTOCI, and FVTPL. So in this process of classification, we have understood two types of testing: instrument level testing and entity level test. First is the instrument level test, where I apply CCFC test, contractual cash flow test, to identify the nature of the instrument. So by identifying the nature of the instrument, I classified it into three categories: equity, debt, derivative. Once I identified the instrument level test, that is CCFC test, I'll put it to a business model test. Under a business model test, I'll identify the intention of the management to derive cash flows from the instrument. Does the management intend to derive cash flows by holding it to maturity? Or does the management intend to derive cash flows from sale of the asset? Or does the management intend to derive cash flows from a combination of both? These are the two types of testing based on which I classify my financial assets into these three categories: amortized cost, FVTPL, and FVTOCI. Clear? Okay, now that we have understood the classification of financial assets, now let's look into the measurement of financial assets based on that classification that we have seen now. According to our discussion regarding classification, I told you that a financial asset can be either classified as amortized cost or can be classified as fair value through P&L or fair value through other comprehensive income, FET, OCI. So AC, FETPL, FET, OCI. Let's see now how do they measure these instruments based on their classification. When I go as per the classification, and my measurement model should go like this. If it is an amortized cost, then initially, whether it is amortized cost or FETOCI or FETPL, initial measurement of a financial asset should always be at fair value. Initial measurement should always be at fair value. It is a subsequent measurement that is on balance sheet date where the change actually occurs. According to your subsequent measurement on balance sheet date, if I have classified a debt instrument as amortized cost, then it should be subsequently measured at amortized cost using an effective interest rate. I will tell you what is this amortized cost using effective interest rate. I'll take the help of an example and I'll come up. Any debt instrument or an equity instrument which is either classified as fair value through other comprehensive income or fair value through P&L, both the cases it should be measured at fair value on each balance sheet date. That is, subsequent measurement should always be at fair value on balance sheet date. The change in fair value in the case a financial asset is classified as FET OCI, then the change in fair value should be recognized in OCI. But if there is a change in fair value for a financial asset classified as FETPL, the change in fair value should be transferred to P&L. The change in fair value is called as gain or loss. Any interest or dividend income on any financial asset should always be transferred to P&L. I'll repeat. Irrespective of your classification, you classify the financial asset as amortized cost, or you classify it as FETOCI, or you classify it as FETPL. Whatever is your classification, initially at the inception of the contract or at the beginning of the transaction, they should always be measured at fair value. The difference emerges only during subsequent measurement on balance sheet date. When I am subsequently measuring on balance sheet date, for a financial asset which is classified as amortized cost should be recognized or should be measured at amortized cost using effective interest rate. While the fair value through OCI or fair value through P&L, if a financial asset gets classified, they should subsequently be measured on balance sheet date only at fair value. However, the difference in fair value arising in a financial asset should be either transferred to OCI or should be transferred to P&L based on their classification. If it is classified as FETOCI, then the change in fair value should be recognized in statement of other comprehensive income. If it is classified as FETPL, then the difference in fair value should be transferred to P&L. Clear? The interest or dividend income on any financial asset, irrespective of their classification, should always be transferred to P&L only. Fine. What is this amortized cost? How do I measure amortized cost and how do I represent it at effective interest rate? Before I get into the concept, I'll have one small thing to talk about. When I talk about initial measurement, I said initially measure the transaction at fair value. Then my question is, can a transaction cost be considered as fair value? Is transaction cost equal to fair value? Answer is no. We have seen this as a part of Ind AS 113, where I said transaction cost need not be equal to fair value. Because transaction price at which you enter into a transaction is an entry price, but your fair value is an exit price, the price at which you can sell an asset or transfer a liability. Since I'm talking about financial asset, I'm talking about sale. So a fair value should be an exit price. So your transaction price need not be equal to fair value. Whenever there is a difference between transaction price and fair value, as per Ind AS 113, the difference should be transferred to P&L as per Ind AS 113, unless another standard proposes an alternative treatment. So this is the standard Ind AS 109, which proposes an alternative treatment whenever there is a difference between fair value and transaction price. So what does he say? On initial recognition, transaction price is generally equal to fair value. But if transaction price is not equal to the fair value, then the difference between the fair value and the transaction price should be either transferred to P&L or should be capitalized to the cost of financial asset. I will charge it to P&L if the fair value is a level 1 input. We have heard about this level 1, level 2, level 3 hierarchy under Ind AS 113. So if the fair value is determined as per level 1 input, then the difference between fair value and transaction price should be charged to P&L. But if in case the difference between fair value and transaction price, if the fair value is determined either as per level 2 input or is determined as per level 3 input, then it will give you an option of either charging it off to P&L or you can capitalize to the cost of the asset and amortize it over the period of the asset. What is all this? You are talking about fair value. You are saying sometimes transaction price is not equal to fair value. You are saying there could be a difference which could emerge. What is the treatment of the difference? And what is this amortized cost using effective interest rate? Let's you look at one simple illustration where we get a complete overview of the entire concept. I want to give you a complete overview of the entire concept with one single example. I'm taking the example of a debt instrument. Okay. Let's say this financial asset right now my financial asset is a loan to employees the transaction price, that means the amount of loan, for ease of calculation I'm taking 1 lakh, guys. Okay, this loan carries an interest rate of, let's say, 6%. Repayment in equal installment along with interest at the end of each year. For 5 years. Over 5 years, equal installment will be paid along with interest. Equal installment over 5 years for 1 lakh of a loan is 20,000. So 20,000 installment for payment of principal along with interest has to be paid. Let us say the effective interest rate, that is a rate at which these employees can borrow the funds from open market, is, let's say, 10%. Ease of calculations, so I'm taking 10%. Guys, keep calculating, okay? Keep calculating. I'll tell you how to calculate. So, first one, I'll talk about initial measurement. First measurement, initial measurement should always be at fair value. Let us measure this instrument at its fair value. How do I measure it at fair value? Based on your income approach. What is your income approach? Your income approach of determining fair value is to derive a present value of discounted cash flows arising from that instrument. Let's start. Here, cash flow, discount factor at effective interest rate, and discounted cash flow. 5 years, 1, 2, 3, 4, 5. Cash flows. Equal installment every year, 20,000 plus interest. Guys, first year, I pay interest on the entire 1 lakh at 6%. 1 lakh into 6% is 6,000 plus your principal repayment of 20,000. The cash flow is 26,000. Next year, the loan outstanding is not 1 lakh, it is 80,000. On 80,000, I'm paying 6% interest, that is 4,800 plus 20,000 of principal repaid, 24,800. Third year, the loan outstanding is only 60,000. On 6% rate of interest, I'll pay 3,600 along with 20,000 rupees of principal repayment, 23,600. Similarly, if I go for the next 2 years, it is 22,400 and finally last year 21,200. Effective interest rate of 10%. Find out discount factors and write down the discount factors, guys. 1 divided by 1.1, 0.909, 0.826, 0.751, 0.683, 0.621. Now you calculate what is your discounted cash flows. 26,000 into 0.909 is 23,624. 24,800 into 0.826. I'll round it off. 20,485. 23,600 into 0.751. 17,724. 22,400 into 0.683. 15,299. Lastly, 21,200 into 0.621. 13,165. Guys, I think your answer will come up to 90,927. 90,297. This is the fair value at which I have to initially recognize the transaction. So you tell me, what is the transaction date accounting? This transaction occurred, let's say, on 1st April. So how do I record this transaction? On 1st April, first I'll record the entry, bank loan account debit. Initially should be measured at fair value on the date of transaction, 90,297. But I paid to bank. How much amount did I pay as a loan to the employee? I paid a total amount of 1 lakh. That means this gives rise to a difference of balancing figure 9,703. This is a difference. What should I debit the difference to is the question. This difference which I identified here is the difference between transaction price and fair value. Now, according to this question, whether it is a level 1 input or a level 2 input or a level 3 input. If it is a level 1 input, then I'll have to take a direct quoted market price. Is this a direct quoted market price? No. I used income approach based on the effective interest rate where I discounted the cash flows. Therefore, 100% I did not take a quoted market price. Therefore, this is not a level 1 input. difference, the difference should either be transferred to P&L or should be capitalized to the asset. Since it is not a level 1 input, then in such situation, in either of these situations, what is the debit which I do? The debit should either go into P&L or should be treated as a deferred staff cost. It is treated as deferred staff cost. What happens to this deferred staff cost? This deferred staff cost should be transferred to P&L over 5 years. Deferred staff cost should be amortized to P&L, amortized to P&L over 5 years. Why? Because it is not a level 1 input. Therefore, the enterprise has an option either to charge off the entire 9,000 change, whatever 9,703 amount I got, directly you put it off to P&L in the same time, or you can capitalize it. That means you defer it and amortize it to P&L over the term or the life of the financial asset. That is what capitalizing to a financial asset means. Clear? Now, this is the first point which I wanted to drive, where in situations where the transaction price and your fair value may not be the same. Therefore, I'll have to give a treatment of the difference in the transaction price and fair value, because your financial asset should always be measured at its fair value on the date of initial recognition. What about subsequent measurement? If this is a financial asset, this is a debt instrument. I'm saying the staff loan, if I put it through an instrument level test, which is nothing but your CCFC test, it derives cash flow solely from principal and interest. Therefore, here it should be classified as debt instrument. Classified as debt instrument. Such debt instrument should be further classified into FETPL or FETOCA or amortized cost based on the entity level test. So therefore, this debt instrument will be applied to an entity level test. Entity level test, where under entity level test, I will check for the business model. Let's say the entity's intention is to derive cash flows until maturity. Entity intends to derive cash flows from principal and interest until maturity. In such situation where the entity intends to derive cash flows until maturity, it has to be classified as amortized cost. Initially measured at fair value. I've already got the fair value. The difference in fair value got treated. But subsequent measurement should be at at amortized cost using effective interest rate. So let us look at subsequent measurement then. Subsequent measurement. My subsequent measurement when I wanted to derive, I'll go like this. Here, opening amortized cost, I'm writing it as AC, effective interest, which is 10%, cash flow or repayment, finally get your closing amortized cost. Let's use here 1, 2, 3, 4, and finally 5. Opening amortized cost. What is the opening amortized cost? Opening amortized cost is 90,297. 90,297. What is the effective interest? 10%. At 10%, you add, this will become 9,030. What is the repayment? First year I paid 26,000 rupees. Apply. Add interest minus repayment, get closing. So what is the closing? Just check. 90,297 plus 9,030 minus 26,000 is 73,327. 73,327 at the beginning of first year. Add interest plus and minus. Plus interest is 7,333 minus repayment 24,800 is 55,860. Like this, if you keep on going, next year it will be 55,860 plus interest 5,586 minus repayment 23,600 will result in a total amount of plus 5586 minus 23,600, 37,846. Like this, if you go at the end of fifth year, your closing amortized cost should become 0. Each year when I'm required to pass the accounting entry, I will pass the entry like this. In year 1, when I'm passing the entry, I'll record finance. I'll record the entry. Staff loan account debit to interest income. Interest here is income because it is an asset for us. Interest income should be recognized at effective interest rate. Therefore, the amount should be, how much did we get? 9030. 9,030. Subsequent entry should be bank account debit for the amount which I received from the employee towards the staff loan to staff loan. Amount in the first year is 26,000. This entry I will record every year, just the amounts keep changing. Second year interest will be different. Second year repayment is 24,800. By this manner, I will always measure staff loan at closing amortized cost. So year 1 it will be measured at 73,327. Second year 55,860. Third year 37,846. This is my measurement principle of an amortized cost when it is measured at effective interest rate. Clear? This is exactly what I said. Initial measurement, of amortized cost at fair value, but subsequently measured at fair value through effective interest rate. When there is a difference between transaction price and fair value, it should be either charged to P&L, or if it is a level 1 input, but if it is a level 2 or level 3 input, then either you can transfer it to fair value or you can capitalize it to the cost of the asset. Here we got the difference. It was not a level 1 input. So I told you it is at the option. Either you transfer it to P&L now itself or transfer it to P&L over the next 5 years. Clear with the concept? Yes, guys. Can a business intention change subsequently? Yes, it can. I might initially intend it to be held to maturity, a debt instrument, but subsequently at a later point of time, I intended to sell it off. There is a definite change in the intention. When there is a definite change in the intention, then there has to be a reclassification as well, where a reclassification happens from a debt instrument which was held as amortized cost to a fair value through OCI or fair value through P&L. Similarly, the other way around is also possible. I initially intended to be held for a certain period of time, and then I wanted to sell it, but subsequently I intended to hold it until maturity. So an FET OCI can become an amortized cost. Sometimes I might not have an intention to hold it till maturity or hold it even until a particular point of time, but subsequently my intention changed. So when your business intention changes, even the classification changes. That is the reason why we have to look at reclassification of financial asset. So you can reclassify an initially classified FETPL into FETOCI or amortized cost. Initially reclassified FETOCI to fair value to FETPL or amortized cost, or initially classified as amortized cost to FETPL or FETOCI. Whenever such reclassification happens, it should always be reclassified at its fair value on the date of reclassification. On the date of reclassification, it should always be measured at its fair value. Then there will be a difference between the carrying value and the fair value. Yes, there can be a difference between carrying value and fair value, especially when it comes to the concept of amortized cost. Because under amortized cost, we are determining fair value using discounted cash flow approach. Therefore, there is a definite amount of difference which can emerge. Such differences should be either transferred to P&L or should be transferred to OCI depending upon their classification. If you are transferring an amortized cost financial asset to FET OCI, then the difference which emerges should be transferred to OCI. Clear? If it is transferred to FETPL, then the difference in fair value should be transferred to P&L. If it is classified to amortized cost, then the difference or gain or loss should be transferred to your P&L. This difference being transferred to OCI or P&L is depending upon this measurement out here. The gain or loss is being transferred to P&L in the case of amortized cost, transferred to OCI in the case of fair value through OCI, and transferred to P&L in the case of fair value through P&L. So depending on the classification on today's date, whenever there is a gain or loss arising due to subsequent reclassification, should be either transferred to P&L or OCI. So this discussion which we had is regarding financial assets. But now let's get into the concept of financial liabilities. Guys, under financial liabilities, there are only two classifications which are possible. Either it should be classified as amortized cost or should be classified as FETPL. That's it. No FETOCI. When should I classify a financial liability as FETPL? I will classify it as FETPL when it is held to maturity or the management irrevocably has designated it as FETPL. If it is held for trading purpose or if it is irrevocably designated as FETPL. If it is not in these two situations, that is, it is neither held for trading nor it is designated as FETPL, then it should be classified as amortized cost. And remember, there is no reclassification possible for a financial liability between FETPL to amortized cost or amortized cost to FETPL. Reclassification is not possible. Guys, what about the measurement then? Measurement will be the same. Amortized cost or FETPL should always be initially measured at fair value. Subsequent measurement on balance sheet date should be always at amortized cost at effective interest rate using if it is classified as amortized cost, but if it is classified as FETPL, then I have to subsequently measure on balance sheet date at fair value, and the difference of fair value should be transferred to P&L. It is the same thing that we have discussed here. If it is amortized cost or FETPL, initially measured at fair value. If it is amortized cost, then subsequent measurement is at amortized cost using effective interest rate. If it is FETPL, then subsequently measured at fair value. Any difference in fair value should be transferred to P&L. Clear? There is no difference. It is exactly the same as we have seen under financial assets. Now, let's get into the concept of impairment of financial asset. What is this concept of impairment of financial asset and how does it arise and how do I measure it? Let me tell you. Impairment of financial assets. Impairment of financial asset is discussed under para 5.5. This paragraph is one of the most important paragraphs because it uses the word expected credit loss. Be very careful with this word expected credit loss. If someone thought impairment in financial asset means a reduction in value of financial asset is a bad debt, then your answer is yes and no. Bad debt is an impairment. I agree. I'm not saying no. But bad debt is only impairment. No. There could be a situation where you could come across an impairment which is not a bad debt, but still there could be an impairment to financial asset. Then question comes up, how do you calculate this and why does this even arise? What is this expected credit loss? Okay, let us come. I'm using the word expected credit loss. What is this expected credit loss and why does it occur? Remember guys, this concept of expected credit loss is nothing but, let's say, I sold goods to X. For about 1 lakh. This transaction happened on 15th of Jan. The credit period allowed is, let's say, 30 days. That means the amount falls due on 14th of Feb. The amount falls due on 14th of February. But let's say it is a general tendency for X Limited to extend the credit. That means I am expected payment from X Limited is 90 days. That means what? He is utilizing an excess period of credit for about 60 days. Is the excess credit. Remember, this is a common scenario in any company that the debtor does not pay on time. A common problem for any company is this. Okay, especially for CA firms, it is even more because normally our credit period is 365 days. Current year tax audit fee he'll pay only in the next year tax audit time. Okay, so that is how it is. So whenever such kind of events occur, I will say that this 1 lakh is 1 lakh rupee on 14th of January. But I am expecting the payment to be received after 90 days. That is probably I am expecting the payment to be collected after 90 days. That is how much? 3 months, right? So let's say I am expecting the payment to be received on 14th of April. Then I am saying then that 1 lakh on 14th of February is not equal to the 1 lakh which I collected on 14th April. Apply the concept of time value of money. Time value of money is the underlying concept regarding this expected credit loss. So according to your expected credit loss, it says Because of the excess 60 days of credit which has been utilized by the customer, I have incurred a credit loss. It would have been 1 lakh had the money received on 14th Feb. But since I'm receiving the same 1 lakh on 14th of April, I am saying that 1 lakh which I received on 14th April is not the same value. So I'm saying on 14th April, this amount actually which I collected is 1 lakh into present value factor for 60 days. Therefore, it is definitely less than 1 lakh. So the difference between 1 lakh and the actual amount measured at fair value or present value should be considered as my expected credit loss. This expected credit loss is of two types: lifetime expected credit loss, 12 months expected credit loss. What is lifetime expected credit loss? My lifetime expected credit loss means over the lifetime of the enterprise, how much credit period is excess availed by the customer. That estimation is called as lifetime expected credit loss. If I make an estimate only based on the last 12 months, only seeing the last 12 months, I am estimating that the credit loss will be for 40 days or 44 days. That is called as 12 months expected credit loss. Clear? So there are two types of credit losses, which is called as expected credit loss over lifetime and 12 months expected credit loss. Remember guys, this credit loss is calculated based on something called as probability of default. Which is called as POD. Probability of default means nothing but it is calculated in days. How do I calculate in days probability of default? Which is nothing but the date of expected payment minus the due date of payment. The day on which the amount falls due for payment, this difference is called as probability of default. So by this logic, if I have to calculate expected credit loss, I'll go like this. Expected credit loss is equal to the value of financial asset multiplied by probability of default, how many days he will default, divided by 365 into effective interest rate, EIR as a percentage. Guys, EIR as a percentage, here EIR is based on assets. It is an asset based EIR. So what is the effective interest rate for an asset? Effective interest rate for asset is generally, that is, corporate deposit rate with bank. A corporate deposit rate with bank can generally be called as effective interest rate for an asset. Since I'm calculating it for asset, I will calculate it based on corporate discount rate with the bank and a deposit rate with the bank. And I'm saying it should be calculated as financial asset multiplied by probability of default divided by 365 days into effective interest rate. So this computation of effective interest rate uses the concept of time value of money to the minute extent possible. Why minute extent? At time value of money, you normally calculate it based on years, no? But here, what are you doing? You're not calculating based on years. You're calculating based on days. You're saying there is a definite delay which I see from my past experience, from the day the amount falls due up to the day when the amount is received. This date difference is called as probability of default. Based on this probability of default, I will calculate your expected credit loss using this formula. Clear? Now, my financial assets for the purpose of identifying expected credit loss, are classified broadly into two categories. One is called as my trade receivables. My trade receivables are nothing but my debtors and bills receivable, and other financial asset which is not trade receivables like deposits, advances. For a trade receivable, an expected credit loss should be always based on a lifetime expected credit loss. It should be based on lifetime expected credit loss. That means over the lifetime of the enterprise, what is your general tendency of loss on credit? The delay is over the lifetime. I see that it is 40 days. Over the lifetime, I see it as 42 days. That way, lifetime expected credit loss should be identified. If it is for other financial assets, then I will see whether there is a significant increase in credit risk. Significant increase in credit risk. When do I say that there is a significant increase in credit risk? I will say that there is a significant increase in credit risk if any amount is due for more than 30 days. If an amount is due for more than 30 days, then I will say that there is a significant increase in credit risk. If there is a significant increase in credit risk and your answer is yes, then I will go as per lifetime expected credit loss. But if the amount is due for less than 30 days, then I need not go for lifetime expected credit loss. Instead, I will calculate the expected credit loss based on 12 months expected credit loss. So based on the last 12 months, what is the estimated credit loss that you see for this financial asset? For this class of financial asset, last 12 months, last year, I only had a credit loss of 18 days. So there is no significant increase in credit risk. Therefore, I will only calculate the expected credit loss based on your 12 months expected credit loss. So that way, I will estimate based on your lifetime expected credit loss or your 12 months expected credit loss. This I will use in estimating my probability of default. Estimating probability of default, either I use lifetime expected credit loss or I use 12 months expected credit loss. Yes, guys. So what have we covered in yesterday's session regarding Ind AS 32, 109 and 107? Now these standards were relating to financial instruments. I started with the aspect of Ind AS 32 where I started discussing number one, what is the definition of the standard, right? What is the definition of financial instruments? What is the definition of financial assets, financial liabilities and equity instruments? Then I went to the aspect of the differentiation between an equity instrument and a financial liability. Then thirdly, we get into the concept of the compound financial instruments where I explained you the concept of split accounting. Immediately after these three, we also saw the concept of exclusions from financial liabilities. Certain instruments which should never be classified as financial liabilities, they are puttable financial instruments, and those financial liabilities which are only repayable at the time of liquidation of the company. What are puttable financial instruments? Where the holder has a right to demand, where the issuer has a right to redeem the instrument at his wish. So issuer, that is the company who is issuing the instrument, if he has a right to redeem the instrument, then they are called as puttable financial instrument. And also such instruments which are only redeemed at the time of liquidation of the enterprise. There is no maturity date for them. They should never be classified as financial liabilities. They should be called as equity instruments only. Clear? That was the aspect that we have covered, and we put a full stop to Ind AS 32 until there, and we came into Ind AS 109 where we discussed about classification. What did I say? Your financial assets should be predominantly classified into three categories: your amortized cost, fair value through other comprehensive income, and fair value through P&L, AC, FETOCI, FETPL. While your financial liabilities should only be classified into two types: FETPL and amortized cost. For this purpose of classification, we have applied two types of tests. One is called as instrument level testing. The other one was called as entity level testing. Your instrument level testing was called as contractual cash flow test, where you check whether the instrument gives or derives cash flows predominantly from principal and interest. That was solely from payment of principal and interest. That is your CCFC test, where you check whether the instrument is providing cash flows solely from payment of principal and interest. That is called as SPPI. Next one. Under entity level testing, we have applied a business model test to understand the intention of the enterprise to derive benefit from a financial asset. If the enterprise wants to derive a benefit from financial asset by holding it until maturity, or to hold it for a certain period of time and then subsequently sell it, or with an intention to trade. These were predominantly the things that we have discussed as per two levels of testing: instrument level test and entity level test. Based on these two tests, we have identified that financial assets can be broadly categorized into three parts, that is amortized cost, FETOCI and FETPL. Clear? Until here we have seen, and we've also come across the concept of reclassification. Wherever there is a reclassification, it is always because of a change in the business model. And the instrument's basic characters under instrument level testing, that is contractual cash flow test, will never change. It is what changes is the entity's intention to hold that instrument. Whenever there is a change, there can be a reclassification. Whenever there is a reclassification, such financial instrument should always be measured at its fair value. And whenever you have a difference between the fair value, it should be either transferred to P&L or it should be either transferred to OCI. And then we went into measurement of financial asset based on their classification. Whenever I have amortized cost or FETPL or FETOCI, initial measurement was always at fair value. Subsequent measurement for amortized cost, it should be on balance sheet date at amortized cost using effective interest rate. But for the other two financial assets, FETPL or FETOCI, my subsequent measurement on balance sheet date should always be at fair value. The difference in fair value, if the instrument is classified as FETOCI, the difference in fair value should be transferred to OCI, other comprehensive income. But if a financial asset is classified as FETPL, then the difference in fair value should be transferred to P&L account. We have seen until here, and then we get into the para 5.5, which is the most important paragraph, where I discussed about your impairment to financial asset. Under impairment to financial asset, we discussed about a concept called as expected credit loss. And I said your impairment to financial asset is not limited to bad debts or a provision for bad debts. Your expected credit loss is a significantly better interpretation of your bad debts, because here he is not just talking about bad debts, he is talking about the delay in receiving the money from the day it falls due. The difference between these two dates in determining expected credit loss was called as probability of default. Probability of default is equal to the number of days of difference between the date it falls due minus the day on which the payment is actually received. So based on which we calculated what is the expected credit loss or impairment of financial asset. Now, the same things we are looking at: financial instruments definition, financial asset definition, financial liabilities and equity definition. Your difference between for equity and financial liability explained through something called as fixed for fixed test. Yesterday we have taken examples to discuss this. Restriction from classification as financial liability. And then we went into compound financial instruments. where we have seen split accounting to differentiate between liability and equity part. And then there's a reclassification of equity and financial liability. And then we came into the classification, looking at instrument level testing and entity level testing. Based on that, we looked at measurement, the classification explained in a better format, and initial recognition. Sometimes the transaction price is not equal to fair value. What should be the treatment that we give? And then we get into reclassification, classification of financial liability, and impairment. Until here, we have already seen. Let's look at subsequently what is there. Subsequently, we talk about recognition of financial instrument. When I talk about recognizing a financial instrument, there are two alternate methods of accounting which is suggested. Two alternate methods. That means you can either adopt one method or the second. The first type of accounting is called as trade date accounting. The second type of accounting is called as settlement date accounting. First one is called as trade date accounting. Second one is called as settlement date accounting. What is the significant difference between both of them? What is a trade date accounting and what is a settlement date accounting? And how do you differentiate between these two? Let's take a small example and let's understand. Let's say for suppose on 15th of January, I entered into a transaction for purchase of $1,000 at 72 per dollar. This is nothing but a forward contract. I'm entering it on today's date with an intention to settle it on a future date. So I entered into a forward contract. Why I have taken a forward contract is because the trade date and settlement date of a forward contract is generally a little too far. In any other case, sometimes the trade date and settlement date fall on the same place. So therefore, there might not be any change. So to explain you the difference, I am basically taking a forward contract. Now let's say this forward contract for purchase is exercisable on 15th of April. Now, there are three exchange rates that he gave. Exchange rate on 15 Jan, exchange rate on 31st of March, balance sheet date, and exchange rate on 15th of April, settlement date. Let's say my exchange rates initially were 72 rupee per dollar, but it subsequently increased to 75 per dollar. On settlement date, this was 73 per dollar. I've randomly taken some rates, guys. So these are the exchange rates existing on each of these dates. Let's try to record the entries if I'm trying to bifurcate between a trade date accounting and settlement date accounting. Let me have both the columns. Trade date accounting. Settlement date accounting. With the name, if I go, I understand that trade date accounting, the accounting should start on the day on which the transaction has occurred or the agreement was already made. Settlement date accounting, I'll only record the transaction on the date of settlement. So let's say I'm starting it from the date of 15th of Jan, the date on which he entered into the transaction. Remember, under trade date accounting, I'll have to recognize the transaction on the date of transaction itself, which is 15th of Jan. So therefore, I will record forward asset account debit. What is forward asset here? Forward asset is nothing but my, one second guys, I think the space will not be sufficient if I keep writing like this. Forward asset is nothing but my dollar which I will receive. My entity has a right to receive dollar financial asset. I'm recording it as a forward asset, which is a dollar account debit to forward liability. Your forward liability is your liability to pay a repeater. How much? $1,000 at 72 rupees. So this transaction will be entered in for 72,000. But as far as my settlement date is accounting is concerned, I'm not going to record any transaction on the date of transaction. I'll only record the transaction on the date of its settlement. Let's look at balance sheet date now, because before the settlement, I got a balance sheet date, 31st March. Guys, forward contracts are derivatives. If you remember the classification, it should always be classified as FVTPL because it is a derivative instrument. Derivatives have only one classification. They have to be compulsory treated as FVTPL only. So the change in the fair value should be considered as a change in P&L. Now look at it. The exchange rate has increased to 75. The amount which I pay for purchasing these dollars will be standard, will be 72 only. But the value of dollar which I will receive, my value of forward asset has now increased by 3 rupees. So therefore, 3,000 rupees of increase in forward asset. There is no change in forward liability. I will still pay 72,000 rupees only. So record the entry. Forward asset account debit, which is nothing but your dollar receivable. Calculate. How do you calculate? Total, I had $1,000 of receivable. Today, the rate is 75. Earlier, when I recognized the transaction on transaction date or trade date, it was 72. Therefore, I have a gain of 3 rupees per dollar. So, in total, my gain is 3,000. This change in fair value or increase in fair value of forward asset is a gain for me. Such gain, because it is a FVTPL asset classified as fair value through P&L, the value should be transferred to P&L. It is a gain which should be recognized in P&L. Then, what about settlement date accounting? You did not recognize the forward asset or forward liability on the date of transaction. I agree. But as far as the gain is concerned on 31st March, he will definitely have to record that particular entry. So even though I'm not recording the transaction, I'm recording the entry because on 31st March, all increase or decrease in the values of assets and liabilities should be measured using FVTPL. So this entry, which we have already recognized under trade date accounting, I'm repeating it here under settlement date accounting. However, if you look at under trade date accounting on balance sheet date, I would have represented a forward asset of 72,000 plus 3,000. I would have represented a forward asset of 75,000. But under settlement date accounting, I would have represented the forward asset at only 3,000 in value. Clear? Now let's look at 15th of April. That is my settlement date. On the date of settlement, I will receive dollar. I will pay the liability. First, let's settle the liability first. My forward liability account debit to bank. How much will I pay? I agreed to pay 72 rupees per dollar. I will pay the same amount of 72,000. But now I receive the value of forward asset. Receive the value of forward asset now. So what is the forward asset received? Dollar. So this dollar is nothing but cash in dollars account debit. What is the value of the dollar on today's date? On today's day, on settlement date, the dollar value is 73. So therefore, I received $1,000. Calculate 1,000 into 73 rupees, which is 73,000. But remember, you already recognized a forward asset for 75,000. Now that forward asset should be cancelled to forward asset in dollars, which is 75,000. If you observe, there is a loss in the value of dollar. Earlier, I claimed that my forward asset is of 75,000 value. But when the settlement actually happened, I could realize only a value of 73,000. Therefore, I incurred a loss of 2,000. This loss of 2,000 should be transferred to P&L, since this derivative is always fair value through P&L. Because your dollar fell down from 75 to 73 as on settlement date, I incurred a loss of 2,000. Now, if I come to the settlement date accounting, I never recorded a forward asset, I never recorded a forward liability. So I'll have to directly record this transaction. Look at the transaction, how I'll record it. I received dollars, cash account debit in dollars. What is the value of dollars that you received? 73,000. Correct? To bank. I paid in rupees. How much did you pay in rupee terms? 72,000. But don't forget, before you say that there is a gain of 1,000, don't forget you have already recognized a forward asset here, which should be derecognized. So derecognize the forward asset. Forward asset. $3,000. Therefore, the difference should be transferred to P&L because it is a loss which I will get, and the loss as usual is 2,000. This is what we got even under trade date accounting as well. So if you look at fundamentally towards the end on the date of settlement, both the entries would have a similar effect in my books of accounts. There is no significant difference as far as the books of accounts are concerned. You will find the similar effect of both the transactions or both accountings of the transaction in your books of accounts. There is no significant difference as such. But the only thing that we have to remember here is this is an option given by the standard to the enterprise to either adopt trade date accounting or settlement date accounting. These two, trade date and settlement date accounting, would only make sense if there is a difference between the date on which the transaction has occurred and the date on which the settlement has occurred. If both transaction and settlement have occurred on the same day, then this transaction or this accounting will not create any significant impact. Clear? Now, sir, derivatives, I agree, sir. 3 months later, the settlement date occurs. But can you tell me any other case where there is a difference between trade date and settlement date? Look at any transaction done through NSDL, National Security Depository Limited, which is the main entity for you to transact in any BSE or NSE. On your Sensex and Nifty, when you're trading any share, it is the NSDL which gives you the settlement, because it is the entity which is holding your shares in a dematerialized form and will actually facilitate in transfer of shares. So remember, whenever you do a transaction through NSDL, it generally takes T plus 2 days for settlement. That means, let's say for example, we have done a transaction on 1st of April, then my transaction will be settled on T plus 2 days. That means it will only be settled on 3rd of April. This is how there could be a difference between trade date and settlement date. I did not take that example because the difference between trade date and settlement date is just 2 days. In most of the situations, their transaction date itself could be a settlement date. Therefore, that is the reason why conveniently I've taken an example where the trade date and settlement date are quite distinct from each other. Clear? That's only to help you understand what is this trade date and settlement date accounting. What is the trade date accounting? Recognize the transaction when it occurs. That means on the date on which the transaction has occurred. Settlement date, recognize the transaction when it is settled. Gain or loss should be recognized on each reporting date by marking it to market. So remember guys, even though I'm adopting a settlement date, on each reporting date, I'll have to mark it to market and recognize the gain or loss. What is mark to market? That means measure at what is the current market price or at the fair value. Clear? Now let's get into the concept. These are recognition. When to recognize? How to recognize? We have already seen. When we said we have to recognize it as per amortized cost or measured as per FETPL or FETOCI, all those logics are fine. Now let's get into the most important concept, because this might look very simple but has to be understood with a lot of common sense. Derecognition of financial assets. What do you mean by derecognition? Derecognition means such financial asset which is already existing in my books of accounts, it no longer exists. Or give me examples of financial assets. Bills receivable, debtors, advances. How do you recognize? Or equity investments in Infosys, equity investment in Reliance, investment in debentures or bonds of Tata Steel. These are all financial assets. Now, when do you derecognize them? Debtor, when do you derecognize? When he has settled the liability or settled the amount due. I have no further right to obtain any benefit from that particular asset. No further cash flows will generate from that asset. Or if it is a bill receivable, I can either collect the bill at the maturity date in such a way that I have no further right to collect any other cash flows from that particular asset, or I could have discounted the bill with the bank. So I gave it to the banker and I said, this is your bill now. You give me how much ever you can. He deducted the amount of discount or the discount charges and he gave me the remaining. That way also the bills receivable get derecognized or discharged from my books of accounts. Endorsed to creditor. I called up a creditor. I said, this fellow has given me a bill. You take this bill and you ask him the payment. I am away from this. So this is also a settlement which I have done. So therefore, I can say that I will derecognize a debt instrument like a debtor or a bill receivable, proper debt instrument applying a CCFC test. Their debt instrument, I will derecognize them if I have no further right to obtain any cash flows from the asset. I have no further right to obtain any cash flows from the asset, or I transferred the asset. I transferred my right to receive cash to some other party. So discounting of bill with bank, endorsement of bill to creditor. I have transferred my right to receive cash flows to another party along with all the significant risk and rewards of the financial asset. All significant risk and rewards of financial asset. So what did I say? I'm saying I have no further right to receive cash flows. I'll derecognize the financial asset. Or that financial asset, my right to obtain cash flows has been transferred to a third party. And along with the transfer of the financial asset, I also transferred all risk and rewards incidental to that financial asset. So tomorrow if there is a default, then don't come to me. I've already transferred all my risk and rewards. What about equity instrument? In an equity instrument, there should be a transfer of the equity instrument along with a risk and rewards on the financial instrument. So I transfer the share along with all the risk and rewards of the instrument. In such cases, I will say that it is a transfer of an equity instrument where it should be derecognized, or the holder of the instrument is no longer having a right to obtain cash flows even upon liquidation of the enterprise. Let the company liquidate also, You have no right to receive cash flows. In such cases, I'll derecognize the financial asset. Clear? Now, I want to concentrate, but I want to help you with an example. I'm dealing with derecognition. I want to help you with an example out here. Let me tell you frankly that derecognition is not as simple as it looks, especially when I bring up the concept of bills received. Whenever I receive a bill, I record the entry as bills receivable account debit to debtor. Generally, this is the entry which I receive and record because I received the bill from the debtor. This bill has significantly three ways of being used. The first way of using this bill is to hold it till maturity, where I will only receive the proceeds or cash flows from the bill, and therefore there is no entry necessary to be recognized. But sometimes there could be a discounting with bank. Whenever I discount a bill with a bank, then I will recognize the entry as bank account debit. Remember, fundamentals here, this is discount account debit or discount charges account debit to bills receivable. I hope everyone remembers this entry. The third way is to endorse to a creditor. When I endorse the bill to a creditor, then in such situation, I'll record the entry as creditor account debit to bills receivable. Now, if you look at fundamentally these two situations where I am derecognizing the bill, I want to further concentrate and discuss only about this aspect where I am derecognizing the bill under discount to a bank and endorse to a creditor. Only these two I'm talking about because I credited the bills receivable. When I credited bills receivable, that means I'm derecognizing the bill. In either of these situations, if the bill is honored, then there is no problem. I have no issue if the bill is actually honored. My issue arises when the bill is dishonored. So what happens if a bill is dishonored? If the bill is dishonored, then the banker will take the entire money from you. So therefore, again, I will have to record the entry as no reverse entry. Instead of bills receivable, bill is already gone, it is dishonored. So I'll bring back the debtor account debit to bank because the banker has taken from my bank account the entire money of the bill. Sometimes he takes additional money also because of notary charges. Similarly, in the creditor situation, if bill is dishonored, even if it is endorsed to a creditor and the bill is dishonored, in such situation also I'll have to record the entry as debtor account debit to creditor. I am bringing back the receivable. I am also bringing back the payable into my books of accounts. Now my question is, when these entries were recorded, when you discounted the bill with the bank or endorsed to a creditor, you derecognized the bill. You credited the bills receivable. But if you remember just now what we have discussed, in the presentation, what was the discussion that we had? If I have to derecognize a bill, then I should transfer my right to receive cash flow. Yes, when the bill is discounted to the bank, then my right to receive derived cash flow from the bills receivable, I have transferred it to the bank. If I endorsed it to a creditor, my right to receive cash flow has been transferred to the creditor. But have I transferred risk and rewards? Absolutely no. The risk of dishonor or the risk of default in payment is still lying with me. That means it is still lying with the enterprise. Therefore, in both these situations, you cannot cancel the bill received. So therefore, let me tell you what we have to do. In both these situations where you credited the bill receivable, the credit should not be to bills receivable. Your crediting bills receivable is not appropriate, since bill should not be derecognized. Why it should not be derecognized? Because the liability of default is still on the company. Liability or risk of dishonor, default or dishonor is not transferred is not transferred to either the bank or the creditor. Therefore, it is not appropriate for us to derecognize the bill. Clear? So either in this case where I wrote bank, where it is discounted with bank, or in this case where it is endorsed to creditor, both cases this statement will hold good, that the bill should not be recognized. The risk of default or dishonor is not transferred to the banker or creditor. Then what is the entry that I will record? Instead of writing this entry as credit to bills receivable, I'll record the entry like this: bank account debit, discount charges account debit, to liability for bills discounted. My liability comes in only if the party has defaulted in payment. Same way, under endorsed to creditor, I'll record the entry as creditor account debit to liability for bill endorsed. It is liability for bill endorsed. What do you mean by this? That means I am not derecognizing the bill. If I look at the balance sheet immediately after this entry, in the balance sheet on the asset side, I will still find the item of bills receivable, and on the liability side, I will find the item of liability for bills. Both the amount should be for the same price. There is no difference in the amounts, but both these items should appear. Just because both are appearing doesn't mean that I cancel off bills receivable and liability for bill. Clear? Why? Why can't you set off these items? Offsetting a financial asset and financial liability can only be possible if such an offset is legally permissible and the entity expects to set off or offset and settle the transaction on net basis. Here, can you settle the transaction on net basis? Your liability of bill will appear only if your bills receivable is not collected. If your bill is not collected, then only your liability arises. If the bill is already paid, there's no liability at all. So therefore, it is not appropriate for us to basically present these items as net amounts. They cannot be set off or offset because the enterprise does not intend to settle this on net basis. Clear? The same thing, I'll represent it in the better form. We call this as discounting of bills with records and without records. What is this with records, without records? Let's see. Whenever I discount a bill, there are two types of discounting. One is with records, the other one is without records. What is with records? When I say with records, that means the risk of default in the bill is still with the enterprise. You have, if there is a default of the bill or a dishonor of the bill, then it will be the entity's responsibility to pay it to the banker or to the creditor. But when I say when there is without records, that means I have transferred the risk and rewards of the bill receivable directly to the other party. In such cases, I can derecognize it because I did not just transfer the right to receive cash flow, but I also transferred along with that the risk and rewards which are attached to that particular bill. Clear? So with records, I transferred the rewards on the bill, not the risk. Without records, I transferred the bill, the risk, the rewards. Everything transferred, derecognized. With records, if there is a dishonor, he'll come back to me. I will not derecognize the bill. Clear? Now, any doubts till now on recognition and derecognition? Guys, it is very common on today's day to come across something called as hedging. Why do people normally hedge? People in general sense hedge because you need to understand that there is a significant risk in how holding certain items. Let's say I have a foreign currency borrowing. My foreign currency borrowing has to be repaid in that foreign currency. In future, if the foreign currency appreciates, we have seen this concept as a part of India's 23. If you remember, we came out with the logic under India's 23 called as para 46A. Whenever there is an increase in the value of foreign currency, then the value of the borrowing increases, results in an exchange loss. That exchange loss under para 46A of AS11 can either be charged to P&L or can be capitalized to the cost of the asset. That is your para 46A of India's or AS11, which we have dealt with as a part of India's 23 as well. I am trying to pick up on a very similar logics out here. And I am saying if I have a foreign currency borrowing, then my enterprise is subjected to risk of increase in the value of foreign currency. If there is an increase in the value of foreign currency, then I will sustain loss. Why will you sustain loss? Because there is a loss. Because of the excess amount which I will have to pay. I borrowed $1,000 at 70 rupees. By the time of settlement, dollar became 78. So when I have to repay $1,000, I should not be repaying only 70,000, but I'll have to repay 78,000. So that 8,000 extra which I paid is because of appreciation in the value of a dollar. That is nothing but your exchange loss. These are generally happening. You do come across this concept of exchange loss whenever we talk about a foreign currency borrowing or a foreign currency receivable. But let's say, for example, during the pandemic time or before the pandemic time, I've taken a borrowing, and this borrowing was a fixed rate of interest. But due to pandemic, the borrowing rates have come down very significantly, that today the borrowing rate has come down to only 8% or 9%. When I initially took it at fixed rate, then it was almost at 12% fixed rate. Had I taken floating rate, I would have saved 4% in interest cost. But I did not. I took a fixed rate. That means it is also subjected to risk. What is a risk? The risk that the value of interest will fall in such way, because I have taken a fixed rate of borrowing, I am subjected to a risk of paying an excess interest. If I take floating interest, then there is always a risk that the interest rate might go up tomorrow. If the interest rate goes up tomorrow, then definitely I have a risk of paying an excess interest. So certain instruments, when they are held by an enterprise, it is always subjected to risk. Such items are basically assessed and hedged. Such items are basically assessed and hedged. The item which has a risk is called as hedged item. The instrument with which I reduce the risk, or I negotiate the risk, or I nullify the risk with a particular instrument, such instrument is called as hedging instrument. The instrument which has a risk is called as hedged item, and the instrument with which I reduce this risk is called as hedging instrument. Clear? Now let's look at it. Let's say, for example, I have a dollar receivable from a customer X for, let's say, about $200. On today's date, my exchange rate of dollar is, let's say, 70 per dollar. But I'm expecting that the dollar will depreciate. Therefore, what is happening? Therefore, I understand that there is a risk. There is a risk of fall in dollar or in value of dollar. Since there is a risk of fall in value of dollar, this item receivable of from a customer in US dollars is called as a hedged item. This is called as hedged item. To reduce this risk, to reduce the risk, enterprise entered into a forward contract, entered into a forward contract to sell dollars at a future rate. To sell dollar at rupee 71 per dollar on future date. So at some future date, whenever I expect to receive this money, I've entered into a forward contract to sell the dollar whatever I get at 71 rupees. I will receive dollar, I will sell dollar. Ultimately, the dollar fluctuation is not going to affect my business because I already freeze the dollar rate at 71 rupees. So therefore, this forward contract, with the help of which I've reduced the risk of this hedged instrument or of this hedged item, is called as hedging instrument. Hedging instrument. Now, if you ask me, why did you enter into this hedge? I will tell you, because the value of cash flow which I derive from the foreign currency dollar receivable is subjected to change because of the change in exchange rate. Therefore, This is a risk in cash flow. Since this is a risk in receiving the cash flow of future, this is called as cash flow hedge. This is called as cash flow hedge. Why is it called as cash flow hedge? Because you are trying to hedge the risk of fall in the value of a dollar, which will affect the cash flows of the company. This will affect the cash flows of the company. Therefore, I am entering into a transaction in this way. Now, this is called as cash flow hedge. Very similarly, just like we are talking about cash flow hedge, there can also be something called as a fair value hedge. What is a fair value hedge? Let's say I have an inventory. This inventory is of particular type that there is significant change in the value of inventory, like metals. Let's say I am Khajana jewelry or Malabar jewelry or Joyalukas or Josalukas, whatever jewelry store you want, name it, you name it. My inventory, which is held in the form of a gold. What is the risk that you have? I have a risk that there is a fall in the value of inventory. So the fall in the value of inventory is basically your risk. Therefore, the inventory is a hedged item. This inventory, which is a hedged item, I will have to basically hedge it with by entering into a forward contract to sell the gold at a particular rate, sell the metal at a particular rate. That particular forward contract to sell gold at a particular rate is called as hedging instrument. What did you hedge? Did you hedge your cash flow? No, I hedged the value of inventory. This hedging of fair value of inventory is called as fair value hedge. So my hedge can either be cash flow hedge or a fair value hedge. Cash flow hedge is generally applicable for items which are received in a fixed sum of money. Debtors, bills receivable, loans, all these are cash flow hedge. But whenever I am trying to hedge the fair value of an item, then it is called as fair value hedge. Best example I could give here is inventory. Inventory, there could be an increase in the value of inventory or decrease in the value of inventory. So therefore, it is a risk of decrease in the value of inventory. I am basically reducing the risk by entering into a forward contract. That forward contract is called as hedging instrument to reduce the risk in the fall in the value of inventory. These kind of hedging instruments are called as fair value hedge. The last hedge is basically called as hedge of investment in foreign operation. This foreign operation is what we have discussed as a part of India's 21, my foreign subsidiary, my foreign branch. All these are called as foreign operations. Such a foreign operation which is established outside India, I have certain investment in that foreign operation. My investment in foreign operation is subjected to change, subjected to risk of a change. That risk of a change, if I reduce the risk with the help of any other instrument, then it should be called as the hedge of net investment in foreign operation. So in total, I have discussed about three different types of hedges. The first type is called as cash flow hedge. The second type is called as fair value hedge. And finally, the last one, which is called as a hedge of net investment in foreign operation. Clear? Now, whenever you categorize the hedge based on the nature of the hedge, let's look at what is the accounting treatment. In simple sense, let me put it like this. Whenever I hedge, there are two things which I have to consider. One is the change in the fair value of the hedged item and also the change in the fair value of hedging instrument. So I'm saying whenever I'm accounting for hedge, I'll always look at two things. What is the change in the hedged item and what is the change in hedging instrument? Remember guys, I'll always call it as an effective hedge if an increase in the value of hedged item should reduce the value of hedging instrument. If there is a reduction in the value of hedging instrument, hedged item, then there should be an opposite direction increase in the value of hedging instrument. Then only you can say that the hedge is effective. Whenever you talk about these concepts, I can say that sometimes a hedge can be ineffective as well. Now you will say, sir, why is a hedge ineffective? I'll tell you. Let's say my dollar receivable is equal to 942. $942 receivable can happen. But my forwards in dollars are always in denominations of $100. My forward in dollars is only in multiples of 100. Then what happened? I could come across a situation where either I go for $900 of forward or I can go for $1,000 of forward. I cannot exactly take 942. That means what is happening? If I take $1,000, the hedge is effective only up to 942. If I've taken $1,000 or I've taken $900. If I take $1,000, then to the extent of $942, it is considered to be effective. To the extent of the other $58, it is considered to be ineffective. Similarly, if I have subscribed only for $900 of forward, in such cases, to the extent of $900, it is effective. But I am still exposed to a $42 of balance, to the extent of which it can be considered as ineffective. That's why I'm saying always remember, you can have an effective hedge and also an ineffective hedge in a hedging instrument. Don't always believe that exact amounts are applicable, exactly entire amount is effective. Not necessary. You do practically come across situations where the hedge may not be 100% effective. Let's see. What is the accounting treatment when the hedge is effective, when the hedge is not effective? First, I'll start with cash flow hedge. Under a cash flow hedge, whenever there is a change in the value of the hedged item is the item where there is a risk. Such item, whenever there is a change in the value, I will transfer the change in the value to a reserve called as cash flow hedge reserve. I'll transfer the balance to cash flow hedge reserve to the extent of the lower of change in hedged item and change in hedging instrument. That means to the extent it is effective. Lower of change in hedged item or the change in hedging instrument, that means only to the extent it is effective. They are trying to transfer the balance into a reserve called as cash flow hedge reserve. To the extent of the hedging instrument, to the extent it is effective, I'll transfer it to OCI, but to the extent it is ineffective, I'll always transfer it to PL. Irrespective of your hedge, cash flow hedge, fair value hedge, or hedge of net investment in foreign operation, ineffective hedge should always be transferred to P&L. To the extent the hedge is ineffective, it should always be transferred to P&L. There is no doubt regarding that. Clear? Under a fair value hedge, the change in the value of the hedged item should be transferred to fair value reserve. To the extent the hedging instrument is effective, I will again transfer to fair value reserve, but to the extent it is ineffective, I will directly transfer it to P&L. Similar is your case with net operation and net investment in foreign operation, where the hedged item, the change in the value of hedged item should be transferred to FCTR. We have seen this word as per Ind AS 21. Under hedging instrument, To the extent effective, transfer it to FCTR. To the extent ineffective, I'll directly put it into P&L. Clear? So this is how the hedge has to be accounted for. I tried to give you the basic fundamentals of what is a hedge and how the hedge should be identified as effective and ineffective. I've also told you when it is a cash flow hedge, when it is a fair value hedge. If it is a hedge of net investment in foreign operation, you will observe because he will hedge on the investment. Clear? Let's say I have a loan which carries a floating interest rate. What do you mean by floating interest rate? That means the interest rate changes periodically. When the interest rate is changing periodically, how will you come and establish that this is exactly your interest rate or effective interest rate at which the loan should be measured? It is very difficult because the loan rate keeps on changing every year. That is the reason why floating interest rate becomes very interesting, because your value of loan or the value of effective interest using amortized cost using effective interest, you don't know which rate to apply. Last year it was 11 and a half. Current year it has come down to 9.8. So automatically there is a change in interest rate. There should be a change in amortized cost. Does this require me to change the value every year? Does it require me to change in the value every year? Absolutely no. Absolutely no. So that is what he is trying to say, that whenever you have taken a loan at floating interest rate, your effective interest rate amortized cost calculation should be based on the interest rate applicable at the beginning of the transaction. At the beginning of the transaction, that means at the date on which the loan has been taken. But what if the loan changes? Even if the loan change, the amortized cost will still be calculated based on the initial interest rate itself. Sir, but interest cost will have to change. Yes, the interest cost in your P&L will only be recognized to the extent of floating interest rate. Look at what I say. Whenever I take a loan using a floating interest rate, my initial recognition should be at amortized cost using prevailing interest rate. But my subsequent recognition, if there is a change in the floating interest rate, then the amortized cost should not be changed. Straightforward, recognize the finance cost using prevailing market rate. But your amortized cost calculation should still be following the same prevailing interest rate computation. Clear? This is the concept regarding floating interest rates. Clear? Now let's come to the concept of a derivative. What is a derivative first of all? What do you understand by a derivative? Remember guys, a derivatives are nothing but forward contracts. They are futures, options. All these are derivative instruments. Now remember, a hedging instrument is generally a derivative instrument. I'm not saying compulsory. I'm saying it is generally a derivative instrument with which we normally hedge. Now, what is the fundamental characteristics of a hedging instrument? For what is the fundamental characteristics of a derivative? For me to call something as a derivative, there are three fundamental characteristics that it should hold. Number one, it should have a future settlement date. Number two, it changes in value because of a change in the underlying asset. It changes in value because of a change in the underlying asset. A derivative, like a forward contract to sell dollars, a forward contract to sell dollars changes in its value because of the change in exchange rate. An interest rate swap changes in value because of the change in interest rate. So any forward contract or any interest rate swaps that you enter into, they always change in value because of the underlying asset. Let's say I enter into a forward contract which is in a commodity index. In the commodity index, let's say a particular commodity like nickel has been traded. A commodity of nickel, which is a metal, if I am entering into a forward contract, that forward contract changes in its value or the derivative changes in its value because of the change in the value of the metal nickel. Clear? So I said any derivative should always change in its value because of the change in the underlying asset, and it should always be settled on a future date. Another most important characteristic of a derivative, is that the initial transaction cost to enter into a transaction is very minimal or sometimes even zero. It is very minimal or sometimes even zero to enter into such kind of transaction. Clear? So these are generally the concept of derivative. Remember guys, whenever I say derivative, these derivatives should always be treated as fair value through P&L. You have no other classification for a derivative. They should always be treated as FVTPL, be it a financial asset or be it a financial liability. It should always be FVTPL if the instrument is of a nature of derivative instrument. Clear? Now, let's get into this. It changes in its value with respect to a change in the underlying asset. There is a very low or minimum initial investment or sometimes no initial investment, and it is always settled at a future date. Such a derivative is always held for trading purpose. Therefore, it should always be designated as FVTPL unless it is a hedging instrument. If it is a hedging instrument, we have seen hedge accounting. But if it is not a hedge instrument, then it should always be treated as fair value through P&L. Clear? Now, why did you explain me this concept of derivative instrument? I will tell you. I explained you this concept of derivative instrument to help you understand with another concept called as hybrid instruments. Why is B capital? Even I don't know. Hybrid instruments. I'll write it like this. What is a hybrid instrument and what does it have to do with a derivative? A hybrid instrument is a host contract which has an underlying derivative. The host contract, the host contract is generally non-derivative. There is a non-derivative host contract which has a derivative instrument which is embedded into it. This derivative instrument which is embedded into it is generally called as embedded derivative. It is a derivative instrument which is embedded into a host contract which is a non-derivative instrument. Sir, what are you talking? Nothing I understood. Example. A contract to sell inventory to a customer in US in dollars. Guys, here the host contract is a contract to sell. This contract to say a contract of sale is generally a non-derivative instrument. A contract of sale is generally a host contract which is non-derivative, but that sale contract is denominating values or my currency in dollars. So therefore there is a change in the value because of the change in the value of a dollar. Therefore the dollar exchange rate should be considered as exchange rate or ER is considered as derivative. I'll take one more example. Issue of bonds by an enterprise in, let's say, pounds. So there are two things here. One is a bond. Bonds are basically long-term loans. They are loans which are purely non-derivative in nature. It is a host contract which is non-derivative. But because this bond is denominated in dollars, this dollar is denominated in a foreign currency, that is a pound. Here the pound exchange rate becomes a derivative instrument. Therefore, whenever you have such kind of situations, you come across a case where the host contract is not non-derivative, but it is increasing or decreasing in value because it has an underlying embedded derivative. It has an underlying derivative instrument which changes the value of the host contract. Whenever I come across these kind of concepts where there is a hybrid contract where I have a host contract and also a derivative which is attached to the original contract, in such cases I'll have to understand what is the accounting approach. My accounting approach for hybrid contracts is given like this. Whenever I have a hybrid contract, always try to identify your hybrid contracts in two ways. I'll use both the examples which I have given. Where the host contract is also covered under Ind AS 109. Under Ind AS 109. That means it is also a financial instrument, or sometimes where the host contract is not covered under Ind AS 109. Guys, go back to your earlier examples. The two examples which I gave you, first case where it is a non-derivative host contract or non-derivative contract to sell, this non-derivative contract of sale should be as per Ind AS 115, which is contracts with customer. But whenever you talk about bond should be covered under Ind AS 109, because bonds are nothing but financial instruments. There is an obligation of the enterprise to pay, and whenever there's an obligation to pay cash, it has to be called as a financial liability. So therefore, bonds are covered under Ind AS 109, while your contracts to sell are contract with customers. So revenue from contracts with customers is dictating that. So that should be as per Ind AS 115. Therefore, both the examples fall under each category. Host contract covered under Ind AS 109, which is nothing but the bonds which were issued in pounds. Host contract not covered under Ind AS 109 is your contract for sale denominated in dollars. Whenever I have the situation where the host contract is covered as per Ind AS 109, in such cases, classify the entire contract as FETPL. That means a change in fair value should always be transferred to P&L. Whenever I have a hybrid contract where the host contract has an embedded derivative, but the host contract is also a non-derivative contract which is covered as per Ind AS 109, I will classify the entire hybrid contract as FETPL. But if the host contract is not covered under Ind AS 109, like I gave you the example of contract of sale, in such cases, I'll further divide it into two parts. Where the first part I'll talk about where the derivative can be separated from host contract, or sometimes where a derivative cannot be separated from host contract. If a derivative can be separated under the first instance, in such case, host contract should be accounted as per their respective standard. Here, in the case of contracts with customer, I'll have to dictate or I'll have to decide the host contract as per Ind AS 10115, while the derivative which is embedded into the host contract should be as per FETPL, should always be measured at fair value through P&L. But if the derivative cannot be separated from the host contract, then in such instances, entire contract is FETPL. You cannot separate it, no separate treatment. I will enter the entire contract as FETPL. So in the second case, where I issue the bonds in pounds, it is a non-derivative host contract of a bond where there is an embedded derivative of a pound. But since bonds are also covered under Ind AS 109, pound is a derivative instrument. Therefore, both combined should always be treated as FETPL. But if I go as per the first concept, where I talk about a contract to sell inventory to a customer in US in dollar, then it is a non-derivative host contract where the exchange rate is a derivative instrument. So therefore, the contract to sell should be as per Ind AS 115, and your dollar, which is a derivative, should be classified as FETPL. Let's take a particular example here. Example. On 15th of Jan, I entered into a contract with X to sell goods for $1,000 on 15th April. Contract to sell is a non-derivative host contract covered under Ind AS 115, but denominated in dollars. Therefore, there is an embedded derivative of exchange rate in dollars, which should be covered as per Ind AS 11. It should be covered as per Ind AS 109. Clear? In such instances, I'll come with a logic now. You see. First, I'll have to make sure that since it is not covered, I'll have to separate the host contract and I'll have to separate the derivative. I will separate host contract and derivative. When is the sale expected to occur? On 15th of April. That is exactly 3 months from the date of transaction. On the date of transaction, let's say a 3-month forward rate of dollar is, let's say, rupees 70 or 72 per dollar. Therefore, the contract for sell should be separated. So how will I separate? Or in this instance, the contract of sale is equal to, measure it. What is the value? $1,000. When is it expected to occur? 15th April, after 3 months. 3 months forward rate is 72. Therefore, the value should be 72,000. Let's say in this case, on 31st of March, (15 days forward rate) 15-day forward rate of dollar is 73 per dollar. Guys, the value of the derivative has increased. The dollar rate, which was initially 72, today has become 73. That means I'm expected to receive excess value of another 1000 rupees. In such case, I'll record an entry like this. Derivative asset account debit, gain on change in the value of the asset. Since it is FETPL, I'll have to transfer it to P&L. I'll record 1000 rupees. Let's say on the date of transaction, that is on 15th of April, the dollar spot rate has become 71 per dollar. It has become 71 per dollar. Then how do you record it? Then I'll have to record it like this. First, I'll have to basically record the derivative loss because the derivative instrument should always be measured at FETPL. As on the balance sheet date, I measured the derivative of dollar at 73 rupees, but now it is 71 rupees. Therefore, there is a loss in value of 2 rupees per dollar. So P&L account debit to derivative asset, which I already recognized is gone. There is no derivative asset. Instead, there is a derivative liability. Why is there a derivative liability? Because your loss is 2 rupees, not 1 rupee. So my loss is 2000, which I debited to P&L. I'll credit derivative asset to the extent I debited earlier on 31st of March, and the balance I will transfer it to derivative liability. On this date, the transaction has occurred. So let's record the transaction. Sale to customer. Sale to customer. It is a non-derivative instrument. That means the sale should always be measured at the same rate which I decided earlier. I decided earlier that my contract of sale should be measured at 72,000. So I'll have to record the entry like this. Bank account debit to sales. My sales is a non-derivative instrument, fixed value. This is 72,000. But how much did I receive in dollars? I received $1,000 at 71 rupees. $1,000 into 71. I only collected through bank 71,000. What about the balance 1,000 rupees? This balance 1,000, I parked it into my derivative liability. In the previous transaction, I recognized a derivative liability. That derivative liability of 1,000 will be recognized. So the derivative liability which was credited in the earlier entry is now debited so that the derivative liability gets closed. So this way, the value of sale, that is 72,000, has never changed. These are non-derivative host contracts and they should be separated from the derivative instrument. So for separation, I use the 3 months forward rate and I made sure that the host contract is separated from the derivative contract. This is what we have learned here. Whenever the host contract is not covered as per Ind AS 109 and the derivative can be separated, then the host contract should be recognized as per the respective standard, while the derivative should always be treated as FETPL. And this is the example that I've given. Now let's look at the presentation that we look at. A hybrid instrument is a host contract which together exists with an embedded derivative. And these host contracts are generally non-derivative instrument. If the host contract is also covered under Ind AS 109, then the entire contract should be classified as FETPL. But if the host contract is not covered under Ind AS 109, then the derivative instrument should be separated from the host contract, where the host contract should be dealt as per the respective standard, while the derivative should always be classified as FETPL. If the host contract is not covered under Ind AS 109, but the derivative also cannot be separated in absence of sufficient information, the entire contract by itself will be classified as FETPL. This is the concept of derivatives and hybrid contracts, where we use the logic of embedded derivatives and where we try to separate from the host contract. Guys, we generally come across one small last aspect which is related to corporate debt restructuring. What do you mean by this corporate debt restructuring? Corporate debt restructuring appears because sometimes, probably because of situations that we have just come up with, like COVID, a company may not be in a position to service their debt. The operations were so significantly affected that they are not in a position to service the debt. So I go to the banker, I sit down with the banker and I explain him that today the situation of the company is not in such a way that your debt can be serviced. That means your EMI can be paid as per periodical time limits. It is not possible. There is an outstanding so much of interest which I have to pay along with the existing principal. It is not possible for me to basically pay the loan in this particular structure. So what you do is, I propose that I am changing my operations. I am trying to refine my operations in such a way that tomorrow I can make sufficient profits. I expect you to do is waive off the existing interest. Whatever outstanding interest is there, you waive it off. And even in the existing loan, or let's say 50% you waive, the balance interest you add it to the term loan and give me 1 year of moratorium period for which you will not collect any interest during that 1 year period. So this further negotiations which I do to the with the bank during the period of a loan where the loan has already been taken is called as a corporate debt restructuring. Very common phenomena, guys. Today you come across situations where Kingfisher is also gone into a bad debts or basically a non-performing assets. So these kind of loans, they normally should be given an opportunity to restructure them. They should be given a fair opportunity to restructure. I am not representing Kingfisher by any chance, but I'm just saying these are genuine business losses. Kingfisher Airlines was not doing good. That is the reason why they have incurred a loss. So it is a right of the person to basically get a restructured debt. So this restructuring is basically called as corporate debt restructuring. What happens in the case of a corporate debt restructuring? Whenever I have a corporate debt restructuring, I will have to first measure what is the amortized cost of the existing liability. The existing liability, if I measure it at effective interest rate, I will call it as part A. I will discount the restructured cash flows after the corporate debt restructuring process using the effective interest rate, and I'll call this as part B. The existing loans and the restructured loan, if I see a difference between both, and if such amount of, there is a difference. If there is no difference, there is no CDR. There is a CDR, definitely there is a difference. So if there is a difference between the effective interest rate amortized cost of the original borrowing and the amortized cost of the restructured borrowing using effective interest rate, then the difference between both the amortized cost, if it is at least in excess of 10% of the remaining cash flows or your part A, if it is at least 10% of part A or more than 10% of part A, then I will treat it as a new liability itself. The existing liability I'll de-recognize. I will give rise to a new liability if the difference is more than 10%. But if the difference between both the restructured cash flows using amortized cost and effective interest rate is within 10%, that means less than or equal to 10%, then the existing liability will not be changed. It will only be modified. It will only be modified. The difference between both these loans should be charged off to a P&L or can be amortized. Can be amortized over the remaining period. Clear? So either you treat it as extinguishment of earlier loan and treat it as a new loan which is emerged, or you treat it as a modification to the existing liability. It depends upon what is the amount of difference between A and B. That is that A is your existing loan discounted at effective interest rate, or the restructured loan which is discounted at effective interest rate. Both the amortized cost you compare. If the difference is at least or greater than 10% of part A, then you treat it as a fresh liability. If it is less than or equal to 10%, then it should be only treated as a modification to the existing liability. And that will bring us to the end of discussion regarding this concept of Ind AS 32, 107 and 109. I did not touch 107 particularly because 107 was only a disclosure standard. So we have done a detailed discussion of both Ind AS 32 and 109, which particularly deals with financial instruments, which include financial assets and financial liabilities. So let's now discuss about the most interesting standard of all, and I would say one of the most recent standard because the application started only from 1st April 2018. And this standard is about revenue from contracts with customers. Now, this standard in logical sense or in the language that it uses plainly a simple language, but don't compare it with AS9. AS1, AS9 was too plain a standard. Guys, understand that there was a definite requirement for a change in the standard. Now, if you'll ask me, sir, AS9 was already there. Why did Ind AS 115 come in? Why did Ind AS 116 come in when Ind AS 17 was already talking about leases? Even when we came into Ind AS, AS9 was again broken down into Ind AS 18 and Ind AS 11. So these standards were already there. What was the requirement? Basically to bring about a new change and to include Ind AS 115. I'll tell you. Today, the nature of transactions have significantly changed. Today, I'm saying on today's date, there is a significant change in the nature of the transactions which have occurred. Let me give you a brief idea of how there is a change in the nature of transaction and why does it require a change in the standard. Let's say, for suppose, I hope everyone has ordered food on Swiggy, right? I hope everyone has at least ordered food on Swiggy at least once. I'm not going to tell you how to order the food. I'm just telling you what is the nature of transaction which occurs. Customer places an order with the Swiggy. Now, list of restaurants are being displayed, and among each restaurant, there's list of products that are being sold or dishes which are being sold. The customer selects the order of a particular restaurant, and he communicates it to Swiggy that this is my requirement. Swiggy, after that, will communicate the same thing to the restaurant. The restaurant is communicated with the order. The restaurant then sends an acceptance to Swiggy. That means they are accepting the order. Swiggy informs the acceptance to customer. This is how it happens, right? You place an order, it'll say the restaurant has accepted the order. One notification comes up. Restaurant is preparing the order right now. Once the order is prepared, he will inform it to Swiggy saying that the order is ready for delivery. Now, once I say that the order is ready for delivery, then the restaurant is basically done with its duty. Then again, Swiggy will come into picture. Delivery executive will come into picture. And this restaurant gives it to the Swiggy delivery person. Swiggy delivery person gives it to the customer. Order is delivered. So this basically is a peculiar nature of how the transaction happens. So there is a pickup by the delivery executive from the restaurant. The delivery executive comes and gives it back to the customer. Now this is in a simple sense how the order happens on Swiggy. Correct? Everyone agrees on this? Let's say the order is placed for 100 rupees. I pay whom? I pay Swiggy 100 rupees. Swiggy received 100 rupees, but once the restaurant has completed its service, Swiggy pays to the restaurant only rupees 75. He will deduct 25 rupees as commission and he will pay the remaining amount to the restaurant. Swiggy, again for the purpose of delivery, has charged me an additional of 20 rupees. Now, if I say, in essence, Swiggy collects 100 plus 20 rupees of delivery charges, that is total 120. He gives back to the restaurant 75 rupees. That means, in essence, Swiggy has received about 45 rupees from the transaction. Now, my question is, when should this 45 be recognized by Swiggy? Let me tell you. Swiggy is entitled to receive 25 rupees on the total order from the restaurant as a commission income. Now, when is the commission income arising? When Swiggy informed the order to the restaurant, there itself Swiggy's responsibility is over. Once the order is accepted, Swiggy says, yes, I am now entitled to receive that 25 rupees of commission which I have to receive from the restaurant. My obligation towards the restaurant is over. My arrangement with the restaurant is that whenever customer places the order, I will forward you the order. Once you accept the order, I am entitled to receive a commission because I gave you a new customer. So therefore, Swiggy will recognize revenue to the extent of 25 rupees once the restaurant has accepted the order. Restaurant has to recognize a revenue to the extent of 75. When do they recognize? They need not wait until the customer receives the delivery. Restaurant's obligation is completed once the delivery executive has picked up. Once I have picked up from the restaurant, the obligation of the restaurant is complete. So therefore, restaurant recognizes revenue immediately at the point when the Swiggy delivery executive comes, picks up the order. Over. My responsibility is finished. Now it is the delivery responsibility to make sure that the customer receives that particular order. Swiggy has 20 rupees of additional revenue in this perspective. This 20 rupees of additional delivery, they will only recognize as revenue when the order is delivered to the customer. Now you will say, sir, it is Swiggy to whom I place the order. It is Swiggy's responsibility to make sure that the order is delivered to me. So entire thing is an obligation of Swiggy only. Absolutely no. To make sure that it is not Swiggy's responsibility, at the end of the delivery, customer gets 2 ratings. Rate the delivery, rate the restaurant. He will give you 2. He never says rate the transaction. So he is giving you a rating for the delivery. He is asking you for a rating of the delivery. Also asking you the rating for the restaurant. So that means what? He is categorically hyphenating him. He is removing his responsibility, saying that restaurant is not mine. The restaurant is owned by so many other people. Domino's, KFC, McDonald's, or any other restaurant is owning it. So the delivery of the product is my responsibility. The quality of the product is the restaurant's responsibility. So therefore, in this particular instance, if you look at Swiggy, Swiggy in essence is recognizing a revenue of 45 rupees. Out of this 45, I will recognize 25 initially when the restaurant has accepted the customer's order, because it is my commission which I am supposed to receive from the restaurant for transferring the order to the restaurant. 25 immediately recognized. But additional 20 rupees I will recognize as revenue when the order is delivered to the customer, because this 20 rupees of obligation is for delivery of goods to the customer. That is how we basically hyphenate between these two logics. Clear? Look at the restaurant's perspective. Restaurant, though you might have ordered 100 rupees of an item, restaurant is not actually recognizing revenue to the extent of 100. Restaurant will only recognize the revenue to the extent of 75. That is because he is only getting 75 rupees from Swiggy. And that also, he will say that I will recognize the revenue not when the order is delivered to the customer, but immediately when the order is picked up by the delivery executive. Because delivery is not my responsibility. Somewhere on the way, the delivery executive have actually spilled the entire goods. They're packed properly, accident he met, entire goods were spilled off. It is not the restaurant's responsibility. It is Swiggy's responsibility, because the obligation of the restaurant is completed immediately after he handed over the packed goods to the delivery executive. So therefore, the transaction on today's day have not been simple. They are multi-party contracts or counterparty contracts which they have been entered in. Any good which is ordered on Amazon is delivered to you by a delivery partner called as eCart. eCart and Amazon, they are collectively taking the responsibility of making sure that the product is delivered to the customer. That is a collective counter ability of both the parties to make sure that the obligation towards the customer is met. If there is a problem with the delivery, I don't contact eCart. I directly contact Amazon. So that means Amazon is taking the responsibility of the delivery, but with the help of another counterparty to the contract called as eCart. So therefore, you need to understand that the transaction on today's day have become so complicated that you find that there's a significant difference in the way that the transaction should be looked at, or in the way that the transactions today actually occur. You find Redbus, you find Ola, you find Uber, you find Swiggy. So many people who are basically acting as mediators. There are multiple point of revenues being recognized. So that is a reason why one has to understand that recognizing revenue is not simple or not easy in general terms. So for the purpose, you need to come up with this concept of Ind AS 115. What is Ind AS 115 actually talking about? And when it came in, what were the earlier standards which got replaced? Out of the earlier standards which got replaced by the introduction of Ind AS 115, they can be divided into 5 parts. Ind AS 115 was only with effect from 1st April 2018. It's a direct, as it is copy paste of IFRS 15. IFRS 15 was applicable from 1st January 2018. So I started the application of Ind AS 115 starting from 1st April 2018. 3 months of a gap, that's it. At that point of time when IFRS 15 was introduced, IFRS 15 basically replaced in your IFRS 15 with your standards which are replaced are IAS 11, which in our Ind AS is called as Ind AS 11, Ind AS 18. 11 talks about construction contracts, 18 talks about revenue. Apart from this, they've also replaced SIC 31. This SIC 30, one second guys. Yes guys, so they have replaced all this. So they have replaced it with SIC 31, which is barter transactions in advertisement, where I place my advertisement in your website, you place your advertisement in my website. This is the transaction which is involving a barter transaction which was dealt under SIC 31. IFRIC 13, IFRIC 15, IFRIC 18. IFRIC 13, IFRIC 15, IFRIC 18. These are the three IFRICs which were also to be read together with Ind AS 18, now no longer applicable after the introduction of Ind AS 115. What were these three talking about? 13 talks about customer loyalty program. You go to Shopper Stop or Lifestyle, they'll give you some points. These are for recurring customers, they can actually redeem those points. These are called as customer loyalty program. IFRIC 15 talks about real estate transaction. They are generally of typical nature because they are having a longer period than a normal contract. And lastly, transfer of an asset to the customer. This is dealt in the form of consideration payable to the customer. Guys, consideration should move from the customer, no? Why should consideration be paid to the customer? We will discuss about this. There are some situations where there is a consideration paid to the customer. You buy Boost, you get a bat free signed by Sachin Tendulkar or signed by Virat Kohli. So this is a consideration which I paid to the customer. So all these transactions put together, they got replaced with IFRS 15 or Ind AS 15. Clear? Now, when I read the word customers, because the standard uses the word contract revenue from contract with customer. Who is a customer? A customer is a party who has contracted with the entity to receive goods and services which are an output of entity's ordinary activities. Which is an output of entity's ordinary activities. What do you mean by this language? I'll tell you. A person is a customer only if he has contracted with an entity to receive an output of their entity's ordinary activities. Let's say the enterprise had a sale of a fixed asset. I've given an advertisement for a sale of a vehicle on OLX. A customer has approached me and now I have a contract with this customer for the sale of my fixed asset. Can I call him as a customer under Ind AS 115? Is that contract covered under Ind AS 115? No. Because a customer is only a party who has contracted with the enterprise to receive goods and services which are an output of entity's ordinary activities. That sale of car is not your ordinary activity output. Therefore, even if there is a sale of car, the customer who is buying that car shall not be considered as a customer covered under Ind AS 115. To be covered under Ind AS 115, that customer should have contracted with an enterprise to obtain goods and services which are an output of entity's ordinary activities and always in exchange of consideration. That means distribution as free samples will never come under the aspect of Ind AS 115. There should always be a consideration which is attached to such contract where there is a transfer of goods and services to the customer. Clear? So a party who has contracted with the enterprise to obtain goods and services which is an output of entity's ordinary activities in exchange of consideration is called as a customer. Counterparties are not customers. What do you mean by counterparty? Counterparties are basically two parties who together perform a function or together perform the obligation. They share the risk and rewards in discharging the obligation or in performing the obligation. Amazon and eCart. I book a product on Amazon. Amazon packs the products and gives it to eCart. eCart is responsible for safety handling the product and delivering it to the customer. So both Amazon and eCart are taking enough responsibility in delivering the product to the customer. So they share obligations, they share risk and rewards in delivery of obligation to the customer. Therefore, these counterparties among each other cannot be called as customers. Among each other, they cannot be called as customers. Restaurant and Swiggy, they together share risk and rewards in performance of an obligation towards the customer, to a person who has placed the order. They cannot be called as customers to each other. So Swiggy and restaurant are counterparties to the contract. Their customer is completely different. Clear? What does the standard actually deal with? What is the objective of the standard? The objective of the standard is to recognize revenue and to discuss when to recognize the revenue and how to recognize the revenue. When to recognize the revenue? I will recognize the revenue in the manner in which the goods are transferred to the customer. The manner in which the goods are transferred to the customer, that is when I recognize revenue. How do I recognize revenue? To the extent of consideration which an entity expects to receive in exchange of goods and services from the customer. So, what is the objective? The objective of the standard is to recognize revenue. While the scope of the standard deals predominantly with two questions: when, how. When when is answered by this: recognize revenue in the manner in which the goods are transferred to the customer. How? The consideration which the entity expects to receive as an exchange for the goods and services transferred to the customer. Clear? This is fundamentally what the standard talks about, or what is the scope of the standard, what is the overall perspective of the standard. Now, to recognize the revenue, I will undergo 5 steps. First step is to identify a contract with customer. Second step is to identify a performance obligation in the contract. Third step is to determine what is the transaction price. Fourth step is your step 3. Transaction price should be allocated to performance obligations identified in step 2. Allocation of transaction price identified in step 3 to each performance obligation identified in step 2. Finally, step 5, to recognize revenue. I recognize revenue as or when the entity satisfies the performance obligation. As or when means what? I'll recognize as the entity performs obligation. That means over a period of time, I'll keep on recognizing revenue. When the entity satisfies performance obligation, at a point of time, I'll recognize the revenue. So, at a point of time, over a period of time, two types of revenues are recognized as per Ind AS 115. So, what are my steps in revenue recognition process? First, identify the contracts. Second, identify performance obligations in this contract. Third one, determine what is the consideration in the contract, which is a transaction price. Step 4, this consideration has to be allocated to each performance obligation which I identified in step 4. To each performance obligation identified in step 2. That is just step 4. Finally, recognize revenue at a point of time or over a period of time based on when or as the entity performs its obligations under the contract. This is, in short, the brief outline of what the standard talks about. Yes, I agree that these 5 steps have to be detailed and understood in step-by-step manner, but in essence, this is what the standard has. The entire contents of the standard, if I put it up in one slide, then this is particularly the slide which I want. Now, so we have seen 5 steps in recognition of revenue. First one is the step 1, where we try to identify a contract with a customer. We have seen who is a customer, a party who has contract with an enterprise to receive an output of entities' ordinary activities in exchange of some consideration. We have seen the customer part. But what is a contract? A contract is an arrangement. A contract is an arrangement between two or more parties to create legally enforceable rights and obligations. It is an arrangement between two or more parties to create legally enforceable rights and obligations. Now, that is in essence what is a contract. But is that sufficient? I need something more. I need certain criterias for an arrangement to be called as a contract. An agreement can be called as a contract only if it satisfies 5 criteria. First one, the contract should have a commercial substance. What do you mean by commercial substance, guys? Any idea what is a commercial substance? Commercial substance means the transaction should be of financial nature. It is in my best finance interest to sell the product at a particular price. That is my commercial nature of transaction. I am distributing it as samples. I am donating the samples due to COVID relief. Now that cannot be considered as a commercial substance. Only if there is a commercial substance, that is considered to be a contract. So the first important criteria for identification of a contract is the essence that there should be a commercial substance to a contract. Number 2, both the parties to the contract have approved the contract. Approved means they signed it. You said okay, even the customer said okay. They're committed to perform the obligations under the contract. What is the commitment to perform obligations under the contract? The seller is committed to produce such goods which the customer requires and to deliver the goods. That is my obligation. What is the customer's obligation? The customer's obligation is to pay consideration for the goods which are delivered. So both the parties, the seller and the customer, have approved the contract and they are committed to perform their obligations under the contract. Clear? Third one, each party has identified their rights and responsibilities in the contract. Number 4, they identify payment terms. 50% advance, 50% within 30 days from the date of delivery, 100% advance, 100% payment within 60 days from date of delivery. These are payment terms within the contract. Lastly, it is probable that the entity will collect consideration from the contract. It is probable that the entity will collect consideration from the contract. Now, what do you mean by probability that the entity will collect? Is it not certain? Probability can be established if the customer has an intention to pay. If the customer has an intention to pay, then only you can say that the fifth condition is satisfied, that there's a probability that consideration will be received under the contract. Let's see. A contract is an agreement between two or more parties which create legally enforceable rights and obligations. What is the criteria for identification of contract? First thing, that the agreement should have some commercial substance. Number 2, the parties to the contract have approved the contract and they are committed to perform their obligations under the contract. It is a supplier's obligation to deliver goods and services to the customer. It is the customer's obligation to pay consideration to the supplier under the contract. So these are their respective obligations which each of the party is committed to perform. Third thing, each of the parties know what is their rights and responsibilities under the contract. A supplier has a right to receive consideration. The buyer is having a right to receive the delivery of the required good and service which has been communicated to the supplier. Number 4, they identify the payment terms. That means they know what is the amount received and what is the duration within which the amount should be paid. Lastly, it is probable that the entity will collect the consideration from the contract. When do you say that it is probable? Only when the party has an intention as well as an ability to pay. I have an intention to pay, but I don't have an ability to pay. You cannot say that the consideration is probable to be collected. Clear? Now, Sometimes there happens to be a situation where there is an executory contract. What are executory contracts? India is 37. India is 37 excludes executory contracts unless they are of onerous nature. What is an executory contract? An executory contract in simple sense means a contract in which both the parties to the contract have performed same amount of obligations, or neither of the parties have done any obligation, have performed any obligations under the contract. I neither delivered the good, the customer neither gave me the amount. These are executory contracts. So I'm talking about such kind of executory contracts or wholly unperformed contracts. If either the customer or the seller has a right, unilateral right. What do you mean by unilateral right? That means the seller, without consulting with the customer, or the customer, without consultation with the seller, can cancel the contract. They can cancel the contract without payment of damages to the other party. I can cancel the contract without payment of damages to the other party. Then you can say that it is excluded. Such contracts are excluded under Ind AS 115. What did I say? Where either of the party to the contract, that means either the supplier or the customer, have a unilateral right. Means what? Without communicating to the other party, I myself have taken a decision to cancel this contract. And such unilateral right to cancel does not have any obligation to pay damages to the other party. Then you can say that such contracts are not included within the definitions of Ind AS 115. Those contracts will not come under Ind AS 115. Clear? Now, sometimes there happens to be a situation where two or more contracts are entered at the same time or near the same time. What is at the same time or near the same time? At the same time or near same time basically means that that in a sense that these contracts are either entered together. Let's say one contract A has been entered on 1st April and the other contract B was also entered on 1st April. That means they are entered at the same time. What do you mean by near the same time? Near the same time means one contract entered into on 1st of April, other contract entered into on 4th of April. They are near the same time. When two contracts are entered into almost at the same time or exactly at the same time, there is a possibility for you to combine these contracts. Now my question is, when should I combine the contract? Let me tell you. Let's say the contract is for it's a development of 2000 square yards land. The contract involves construction of 3 towers. The contract involves construction of 3 towers. All 3 are residential towers. There is a tower A, there is a tower B, and there is a tower C. I've entered into an agreement for tower A on, let's say, 1st April 21. Similarly, I also entered into construction of tower B contract on 4th of April 2021. Even the tower C agreement was also drafted on 15th April 2020. So that means these agreements are entered into near the same time. Such contracts, can I combine them? I can combine these three. They can be treated on combination basis, or I can treat all these three contracts as combined into one single contract if they are negotiated as a single package. What do you mean by negotiation as single package? Negotiation as single package means there is no chance, there is no chance that the customer could have given the agreement for tower A without taking up the construction of tower B and tower C. My company X Limited has received the contract of tower A alone. Tower B and C were allotted to some other party. Then you cannot say that they are negotiated as a single package. They are negotiated as a single package only when all the three contracts are necessarily to be done by the same party. It is not possible to basically grant part of the contract to one party and the remaining parts of the contract to another party. Then you can say that they are negotiated as a single package. First condition. So, first condition I was talking about, I said they are negotiated as a single package. Next one. Second condition, the price of one contract is based on or influenced by the price and performance of the other contract. The price of performance is influenced by other contracts. I have given you contract A. Therefore, at the time of contract C, I requested you for 8% discount. Why did you offer me a discount? Because anyways, you are only doing tower A, you are only doing tower C. There's a significant added advantage to you. So I'm expecting you to make sure that the same rates of tower A are taken, but you give me a discount of 8%. So the price and performance of one contract influences the price and performance of another contract. Lastly, they signify a single performance obligation. All three together, they should signify a single performance obligation. What do you mean by they signify single performance obligation? That means the customer will benefit only if all the three are produced or constructed together. I construct A, I don't construct B and C, the customer cannot take the benefit. The customer can only occupy A, B or C only when they are performed or constructed together. Therefore, it is simplified, it signifies a single performance obligation. So whenever I talk about combination of contracts, I'm saying that if contracts are entered into at the same time or near the same time, they can be combined only if, number one, they are negotiated as a single package. Price and performance of one contract is depending or influences the price and performance of other contracts. The goods and services under all these contracts represent a single performance obligation. If these three conditions together are satisfied, then you can say that they can be treated as a single contract. But if they are not satisfied, then you have to treat it as a separate contract. Clear? Clear? So this is a very simple understanding. I gave you an example and I told you. Now, I'll go back to the previous example itself and I'll do some small modifications. I wanted you to construct additional work. What additional work? I wanted you to construct a park. I wanted you to construct an overhead tank. I wanted you to construct a small clubhouse where a gym facility and other facilities are also included. These contracts I gave you subsequently. Initially, I gave you ABC, but subsequently, I've done some modifications to the contract to include few more items into the contract, like a park or a tank or a clubhouse or any other things. Or let's say, for example, I said you can use any sort of paint, but later on, I told you you have to use only Apex Ultima from Asian Paints. I said you can use vitrified tiles for your flooring, but later on, I told you I want only a marble flooring. This way, I might have given you multiple contracts. This way, I might have actually added or modified the contract. Can this modification on the contract be treated as the same contract, or these additional assets should they be treated as a new contract? I will treat these modifications as a new contract only if these assets are distinct from the other assets. These assets or modifications which happened are distinct from the assets which are already negotiated in the original contract. Park, tank, clubhouse are distinct from the towers of A, B, and C. They are distinct in their function, they are distinct in their construction, they are distinct in everything. And the price or modification which happened in the contract is almost equal to the standalone selling price of these contracts. If they have not been given to me, but they have been given to someone else, even he would have charged the same amount. That means they represent a standalone selling price of these items. In such cases, we can classify them as a separate contract. So I'm talking about something called as modifications to the existing contract. If the modification represents distinct goods and services from original contract, here park, clubhouse, water tank, all these are distinct from the original contract, and the change in the contract price is the standalone selling price of the modification. In such case, the modification should be treated as a separate contract. In any other situation, it should be treated as a modification to the original contract itself. Here, so we have seen regarding combination of contracts for contracts which are entered into at the same time or near the same time. We have also seen modifications in contract where a particular change in the contract can be treated as a separate contract, or should it be treated as a change in the original contract. Now let's get into step 2. What is a performance obligation? What do you mean by a performance obligation first of all? Okay. So what do you mean by performance obligation? So we are looking at step 2. We have already done with step 1, identifying a contract with the customer. Now you tell me, what do you think about a performance obligation in a contract? The supplier has an obligation to deliver the goods and services as requested by the customer. The customer has an obligation to pay the consideration as agreed upon. So therefore, every contract has an obligation. There is an obligation of the supplier. There is also an obligation of the customer. Now here under step 2, I am only talking about the obligations of the supplier. I am not talking about the consideration which the customer has to pay. So I am only talking about what is the obligations which the supplier has to perform under a particular contract. Let's say a customer has purchased an AC from Amazon. Okay. The Amazon executive came one day, has delivered the AC. Did the AC by itself give you any benefit? You have delivered the AC, I plugged in the AC, did the AC work? No. The AC has to be installed. There has to be an outdoor unit which has to be kept outside. There should be an indoor unit which is placed. So many things are there. So therefore, by the delivery alone, the customer did not benefit from the good. Therefore, the obligation of the supplier is not restricted to just supplying that particular equipment. The obligation of the supplier is to install that equipment and make sure that you test run it, saying that yes, I can find that the AC is working. I put my hand up and I check whether there is a cool air which is blowing or not, and I say yes, supplier's obligation is complete. Yeah, I take examples which are easy for you to see in your room. In your room, you can find all these examples which I'm talking about. Construction of towers, wherever I gave you the example, as simple as that. Any locality you look at, you find so many towers coming up. All these I'm taking examples which you can see right here. In front of you, you can see these items. So that's why I take these kind of examples so that it will be easier for you to relate to it. So that's why I gave you the example of an AC. Why? Forget about AC, even television set, even TV set also, it has to be wall mount. So what you do? You take the delivery of the TV and you wait for it. The next day you get a message that the consultant is going to reach you and he is going to install the TV set. So he'll drill some holes, he will hang the TV onto the wall and he'll say that installation is complete. So therefore my purchase of that particular equipment had an obligation to the supplier, not just for the delivery of the item, but also certain additional conditions attached to it. Certain additional conditions which are attached to it. So therefore, the obligation under a contract to the supplier, which is called as performance obligation, is a promise. What is your promise? Supplier's promise to deliver distinct goods and services within a contract. It is my promise to deliver distinct goods and services within a contract. If they are distinct, then each obligation will be treated as a separate performance obligation. If they are not distinct, then they should be treated as one single performance obligation. So my promise in the contract to deliver distinct goods and services under a contract, or a series of distinct goods and services where each of such good also satisfies performance obligation. They have a same pattern of transfer to customers. So let me see what is performance obligation. It is a promise in the contract to transfer goods and services or a bundle of goods and services which are distinct. What is this distinct? I'll tell you. Or a series of distinct goods and services which are substantially same and have a same pattern of transfer to the customer. I will park this aside. I will discuss about what is a series of distinct goods and services which are substantially same, have a same pattern of transfer to the customer. I'll park this part aside. I'll first deal with the first part. What is he saying? A promise to transfer goods and services or a bundle of goods and services which are distinct. When can I say that there are multiple goods and services in the contract which are distinct from each other? I will say that the contract has multiple goods and services which are distinct only if such goods and services in the contract can benefit the customer by itself. By itself, the good can give a benefit to the customer. Let's say, for example, I have delivered you a tube light. A tube light was delivered to you. So, when a tube light is delivered to you, I assume that you already have a light holder. So, you go and place this tube light there, automatically the light starts glowing. This is a distinct good. The good by itself generates some benefit to the customer, either by itself or with other resources which are readily available. What is the other resource which is readily available? The tube light holder. When I say readily available, that means something which the customer already owns or something which the customer can buy from the open market. It need not be only from me. He can buy it from any person. It is readily available in active market. Then you can say that it is a distinct good. A distinct good or service either gives a benefit to the customer by itself or can give a benefit to the customer with resources which are readily available. Readily available resources are those resources which the customer already owns or he can buy it from open market. I went to a supplier for a tire of my vehicle. I gave him what is my tires. He delivered the tires and he said, sir, take, go. Did the tire by itself give me any benefit? No. But it will give me a benefit with a resource which is already existing with me, which is my car. So they can be called as distinct goods and services. I can also call a good or a service distinct. I can also call a good or service distinct if they are separately identifiable. What do you mean by a good or service which is separately identifiable? It is not dependent, it is not highly dependent and interrelated with other goods and services supplied within the contract. There is no significant integration which happens with other goods and services supplied in the contract. And there is no significant customization which happens with other goods and services supplied within the contract. Then you can say that they are separately identifiable. That they are separately identifiable. What do you mean by distinct good or service? A customer benefits from the good or service alone or together with other goods and services which are readily available. What do you mean by readily available? Such good is already owned or such good will be sold separately. Or they are separately identifiable. They are not highly dependent or interrelated. There is no significant integration. There is no customization which occurs with other goods and services which are supplied within the contract. Then you can say that these goods and services which are supplied as a part of the contract are distinct from each other. Each such distinct good or service should be treated as a separate performance obligation. For example, I have a mobile phone which is purchased. A supplier of the mobile phone has supplied me the mobile phone. In addition, when I was checking out, he said you can add your RAM from 64 GB to 256 GB by paying an additional price, so and so additional price. Number one. Number two, the cover of this mobile phone, so that it avoids any breakage when there's a fall. This cover is additionally provided at 500 rupees. Okay. Now these additional goods and services, are they distinct or should they, all the things could be combined together to be considered as one single performance obligation? Now look at it. When I increased my RAM or my mobile memory from 64 to 256 GB at the time of purchase, the additional money which I pay, can that particular increase in the RAM can be offered even by an external person? Is it possible? No. Then the increase in the RAM should be considered as a same good as the mobile phone is. But this mobile cover which I am purchasing from the supplier, I can purchase it from anywhere else as well. There are so many websites which offer services for purchasing these mobile phone covers. Therefore, this particular mobile phone cover can be considered as a distinct good cannot be combined with the mobile phone by itself. Clear? So these are goods and services which are distinct. That means they benefit the customer by themselves or they benefit the customer with other resources which are readily available. What do you mean by readily available? They can be sold separately or they are already obtained by the customer, or if they can be separately identified. This was my first part where goods and services are distinct. But look at the second one. There are series of distinct goods and services. That means you are not delivering one single good or service. Multiple times you are delivering a distinct good or service. But they're substantially same. They're very much the same. And they have the same pattern of transfer to the customer. Best example that you can take here is your newspaper. Each day newspaper, the newspaper on 1st April is irrelevant or distinct from the newspaper given on 2nd of April. It is distinct from the newspaper delivered on 3rd of April because the news that it carries are significantly different and is only relevant for that particular day. Today's newspaper, tomorrow's waste paper. So what is happening? There are series of distinct goods and services, but substantially they are same because they deliver that day's news and it is generally printed in the same format. There is no significant difference in these items. They are substantially same, but they are distinct goods and services. But last part I'm talking about, they have the same pattern of transfer to customer. What do you mean by this word? They have the same pattern of transfer to the customer. Now this word has to be explained. When I use the word same pattern of transfer, each such distinct good or service which is supplied as a part of performance obligation, they should meet the criteria of performance obligation. And secondly, a same method is applied to measure the entity's progress towards the completion of performance obligation. What do you mean by this? I have supplied 10 days of newspaper out of your 365 days of subscription. Out of your 365 days of subscription, I have completed 10 days of delivery. What do you mean? What happens here? That means my measurement of performance obligation completion is 10 by 365. I've completed 150 days of delivery out of 365 days of subscription. So 150 by 365 is my obligation which is completed. So a same measure or same method is applied towards the entity's progress on completion of performance obligation. This is same pattern of transfer to customer. So a promise in the contract to transfer a good or a service or a bundle of goods and services which are distinct or a series of goods and services which are substantially the same have a same pattern of transfer to customer. Clear? This is my second part, that is identification of performance obligation. First part we identified a contract. Second part we identified performance obligation. Now we'll have to move into step 3 where we determine transaction price. Now that we have understood the first two parts, the first one which was relating to the identification of contracts with customers, and the second one which was relating to our performance obligations which are embedded into a contract. We have seen what is a contract, what is the performance obligations in a contract, and I told you that in a contract there could be multiple performance obligations. There could be a delivery of multiple distinct goods and services, or there could be a series of distinct goods and services which are substantially same, but they're delivered to the customer and there's the same pattern of transfer to customer. Now we have seen these first two steps. The third step in determination of revenue is to determine transaction price. What do you mean by a transaction price? What do you understand by this term transaction price? Transaction price is nothing but consideration, right? What is this consideration paid for? This consideration is paid for the exchange of goods and services by the supplier. So that means I'll define it like this. A consideration is a consideration, a transaction price is the consideration which an entity expects in exchange for the goods and services transferred under the contract. What is the consideration that the entity expects for the exchange of goods and services under the contract can be called as transaction price. However, your transaction price specifically exclude amount collected on behalf of third party. What is this amount collected on behalf of third party? Let's say I'm selling a product, but towards the end I said delivery by within 1 day. Aeroflight delivery within 1 day, 49 rupees. Normal delivery within 2 days, 20 rupees by DHL couriers. So like this I have mentioned, these are not supposed to be included in the transaction price because these are the charges which are collected on behalf of a delivery service. GST is collected on the service. This GST is collected on behalf of the department. Therefore, it cannot be considered as my revenue. It cannot be considered as my transaction price. So my transaction price is only limited to the consideration which is receivable by the supplier for the exchange of goods and service under the contract. The consideration which the entity expects for exchange or delivery of goods and services under the contract, and it will definitely exclude all amounts collected on behalf of third party. Now, this transaction price should have adjustments. What adjustments should you do? I should perform the adjustments regarding valid expectations of any discounts or price concessions offered. It is always adjusted by certain discounts and price concessions which are offered. I generally offer as a business practice a discount of 5% on my goods. Today you find Ratnadi, More Supermarket, Bajaj Supermart, everyone displaying 5% off on bill. That's a general price rebate. So therefore, from the transaction price, such valid expectations of discounts should be reduced. However, the customer risk of credit, that means the customer may not be able to give me the value at the end of the when the amount falls due. He might become a bad debt to me. These are credit risk of customer. Such credit risk of customer should not be adjusted in determining of transaction price. While determining transaction price, there are particularly certain adjustments which we have to look at. What are the adjustments which I have to look at? I have to look at the adjustment of first one regarding variable consideration. What is variable consideration means? If the supplier completes the project within a specified time limit, they are entitled to receive 10% bonus. Variable consideration. It depends upon future event. So these are variable consideration which can increase the transaction price. Same way, there can be a penalty if the time period taken by the supplier is beyond a particular time. So this will reduce the transaction price. They are in short called as variable consideration. Second adjustment. Constraints in variable consideration. What do you mean by this constraint of variable consideration? Constraint of variable consideration means I will recognize revenue under variable consideration only to the extent, only to an extent where it is not possible or where I don't expect a significant reversal of revenue in future. I don't expect the revenue to reverse in future. To such extent, I will recognize revenue. That is the second adjustment called as constraint in variable consideration. Third one is the involvement of time value of money into transaction price. If the transaction price is estimated to be received after a particular period of time, then that amount is called as time value of money. Fourth one is non-cash consideration. So sometimes consideration may not be collected in the form of cash, but it might be collected in the form of other than cash. Certain exchange of products, barter system. So that is non-cash consideration. Sometimes for a delivery of a product, I might receive securities of the company. I might receive bonds in the company. I might receive equity shares in the company. That is non-cash consideration. Number 5, any amount of consideration payable to the customer. Sometimes a consideration payable to the customer. Earlier discussed as a part of SIC 18. Now here we are discussing as a part of adjustments in transaction price. How many adjustments we have seen? 5 adjustments. So let us recap what we have seen. So I'm saying number 1, that adjustments are variable consideration. Number 2, constraint in variable consideration. Number 3, time value of money. Number 4, non-cash consideration. Number 5, consideration payable to customer. What is the transaction price? A consideration which the entity expects to receive in exchange of goods and services which are transferred to the customer under the contract. I am entitled to receive a certain consideration for the exchange of goods and services under the contract to a customer. Such consideration is called as transaction price. Should exclude any amount collected on behalf of third party. It should be adjusted for a valid expectation of rebates and discounts or price concessions, but should not be adjusted for credit risk of customer. Whenever there is a credit risk of customer, I'll have to apply your Ind AS 109 para 5.5. Clear? Where we talk about impairment of financial assets. Moving on. Now we'll talk about each adjustment separately. First adjustment regarding variable consideration. Variable consideration is where a part of the promised consideration is dependent or contingent upon an uncertain future event. I expect to complete the project within 15 months. If I complete the project within 15 months, I am entitled to receive a bonus of 10%. I am expected to complete the project after 18 months. If I complete the project after 18 months, I'll have to reduce my transaction price by 10% of penalty. This is a part of the consideration which is contingent upon the uncertain future event. Or sometimes the facts and circumstances of the entity intends to offer a price concession. Now, whenever you want to determine a transaction price under variable consideration, your consideration can be 100 if you complete within 18 months. If you complete within 15 months, your consideration could be 110. Your consideration could be 90 if you complete after 24 months. So this way, multiple outcomes are possible. Whenever there are multiple outcomes possible under variable consideration, for me to determine transaction price, it will be the price which represents the entity's expectation of collection for transfer of goods. What do I expect to receive? Now, how do I identify my expectation to receive? There are 2 ways of determining transaction price under variable consideration. One is called as most likely amount. Other one is called as expected value. I will apply the transaction price identification by most likely amount under variable consideration if there are only 2 possible outcomes. Either the outcome should be 100 or the outcome should be 110. Which one should I select? Most likely amount should be selected. So either A or B. But if the number of outcomes are not 2, but there are 3 or more than 3, Yes, guys, we abruptly stopped, unfortunately. So let's continue from where we stopped. I was talking about variable consideration, guys. I'm sorry. Yeah, I was talking about variable consideration, where a part of the consideration is contingent upon an uncertain future event, and the facts of the circumstances have indicated that there is a price concession. Whenever there's variable consideration, I'll have to determine the transaction price based on the expectation of the enterprise. Now, how do I determine transaction price based on expectation? There are two ways in which he has determined transaction price. Number one is expected value. Number two is most likely amount. Most likely amount can be used for determination of transaction price when there are only two possible outcomes. I complete the contract within 15 months, I will get 110 rupees. If I complete within 18 months or 24 months or any thereafter, I will get 100 rupees. Only two possible outcomes, 100 or 110. In such cases where there are only two possible outcomes, I'll go along with the concept of most likely amount. That means either it is 100 or it is 110. Either it is A or it is B. But when the outcomes are more than two, that means three or more outcomes are possible. In such case, you cannot use the concept of most likely amount to determine the transaction price. In such case, I will use the concept of expected value. How do I determine expected value? As per expected value, transaction price is equal to a sum of all the outcomes into their probability. So where there is more than two outcomes possible, I will apply the formula of expected value. That means wherever the transaction price has more than one outcome or more than two outcomes, I will sum all the possible outcomes into their multiplied by their probability to determine the transaction price. But remember, guys, we have a concept called as conservatism. Yes, do you remember the concept of conservatism? You cannot recognize a probable revenue unless and until it is actually certain. Unless there is a certainty, I cannot recognize a probable income. Same application of conservatism concept, if I put into variable consideration, it is called as constraints on variable consideration. Look at the language that he uses. The language used under constraint of variable consideration is revenue should be estimated only to an extent, or revenue should be estimated to the extent of transaction price in such a way that the reversal of revenue is highly improbable. It is not highly probable that there will be a reversal of revenue. Only to such extent I will recognize a revenue based on transaction price. That means you should not include such amount of revenue which is not probable to come. So if I recognize revenue on 110 today, that is including the bonus which I will receive, but if I'm not able to complete the project within the specified time period, then I'll have to reverse to the extent of that additional revenue recognized. That is the concept of variable consideration and the constraint in the variable consideration. So what is he talking about under constraint of variable consideration? Recognize revenue only to the extent it is highly probable that there will not be any significant reversal in future. Only to the extent it is highly probable that there is no significant reversal of revenue in future, only to that extent I will recognize the transaction price. So my determination of transaction price should be to the extent where it is only highly probable that there will not be a reversal in future. Clear? So that is my application of variable constraint on variable consideration whenever the consideration is variable upon uncertain future events. Clear? Now, what are the factors which could actually influence the likelihood of reversal? My experience on that particular contract is very limited. My experience on that particular contract is very limited. I might assume that I will be entitled to receive the bonus or additional payment on the transaction, but it is limited because I don't have so much of experience. In such cases, I will only limit my transaction price to the extent I will receive the consideration irrespective of the time limit of completion. I will not include the bonus. Number two, multiple prices and discounts of similar product have been available. This product, I sold it at 95, I sold it at 98, I sold it at 110, I sold it at 120. I don't have one determined price. In such cases also, your constraint on variable consideration becomes applicable because you will have to recognize revenue only to the extent it is highly probable that there will not be a reversal of revenue in future. There is a lengthy period of uncertainty. I'm entitled to receive bonus, but when I'll receive after 5 years, if I'll receive, if the number of defects during these 5 years are limited to only 10. Now, when will you get that bonus? After 5 years. So there is a lengthy period of uncertainty whether I will be actually eligible to get that additional payment or not. There also, I'll have to apply this constraint on variable consideration. Sometimes there are factors which are not within my control. It is beyond my control or beyond the enterprise control to get that particular bonus. I am into supplying windmills or energy through windmills. The customer said, if your energy supplied through windmills has increased or is reaching a particular limit, you're entitled to get some additional bonus. But it completely depends. It is not only within my control of the enterprise. I have established the windmill, but it also depends upon natural forces to determine whether I will be entitled to receive the bonus or not. Therefore, these are factors which are beyond my enterprise control. So under these circumstances, I'll have to apply the concept of constraint on variable consideration, where I will recognize revenue only to the extent it is highly probable that there will not be any significant reversal in future. For example, let's say I'm entitled to receive bonus if I complete the project within 18 months. I've been working on similar projects for the last 20 years. And over the last 20 years, similar projects I've completed within 15 months itself. In such cases, I need not apply constraint on variable consideration because it is not influencing the variable consideration, or it is not, the likelihood of reversal is not probable because I already have enough experience to show that there is always a significant, I could complete the contract within a particular time limit where I am entitled to receive bonus. Clear? Moving forward into this concept of time value of money. Now, what is this time value of money and why does it actually emerge? I will actually come up with this time value of money when I am expecting that there is a significant delay from the time I deliver the goods and from the time I receive the payment. I'm saying that sometimes generally my credit period is 30 days. Generally, my credit period is equal to 30 days. But in a particular transaction with X Limited, I sold goods on sale or transfer of goods is on 1st April, but the amount will fall due. But my due date of payment, the consideration is expected to be due only on 1st October. That means the difference between these two dates is 6 months or 180 days. This 6 months is beyond normal credit terms. Since it is beyond normal credit terms, is greater than 30 days or significant difference exists, therefore I will say that there is an inherent factor of time value of money included in this. According to the concept of time value of money in determining the consideration or the transaction price, I will say that the transaction price should be divided into two parts. My transaction price should be a combination of two things. First one is relating to goods and services which are transferred. and the other part of transaction price will be relating to finance income. Because there is an extended time period, there has to be a finance income. Guys, this is very similar to the concept that we have discussed under Ind AS 16, 38, 40 and Ind AS 2. When the payment is deferred beyond normal credit terms, the value of the asset should only be determined based on normal credit terms. The difference between both the prices, transaction price and the price under normal credit terms, should be treated as finance charges. Their finance charges, here it is finance income. That is the only difference. Otherwise, significantly both are same. But remember guys, this concept of time value of money will emerge only if there is a significant delay between the day on which I deliver the product and the day on which I expect to collect the money or collect the consideration. If it is beyond normal credit terms, we get the concept of time value of money. But remember, sometimes even though there is a delay, it shall not be considered as a time value of money included in it. Sometimes even though there is a delay, time value of money concept is not considered to be included. What are those situations? Number one, where the delivery of product is delayed on buyer's request. The buyer came up to me and said, you hold the delivery, you don't deliver the goods to me. When should I deliver? After 6 months you deliver. In such cases, I will not consider that there is a time value of money. Number two, a situation where, in number two, where the amount which I am withholding, I am not transferring a certain amount only because I want to safeguard my interest. This is called as retention money. This is called as retention money. For example, let's say I'm a contractor. My contract is for a period of 5 years. At the end of each quarter, I will bill upon my customer. My customer is withholding 10% of my invoice. So that is called as retention money. And he said he will pay this money only at the end of the contract, that is 5 years. This 10% money which is withheld is only to safeguard the interest of the customer. The customer does not have any intention to delay the payment. It is only withheld to safeguard the interest of the customer. In such cases, you cannot consider time value of money. In most of the construction contracts, you come across this concept of retention money and it is very common, but there is no time value of money which should be considered to be included under this concept of retention money. Number three, where sometimes it is not within the enterprise control. Sometimes the delivery of the good and the payment are delayed due to some other abnormal factors. In such situation, those factors which are not in my control, I don't expect that there is a time value of money. The transaction price and the time value of money is divided into two parts, where a revenue for goods and services and a finance income should be separated. It is only possible when the transaction price is more than the cash price. That means the delivery of the good and the date of expected payment is beyond normal credit terms, beyond normal length. There is no significant time value of money or finance element if the transfer of good is delayed at buyer's request or the amount is withheld for safeguarding the interest on non-performance like retention money. And consideration is variable upon factors which are beyond the enterprise control or the customer control. This is the third adjustment which we are looking at in transaction price. First one was variable consideration. Second one was with respect to your constraint on variable consideration. Third one is with respect to time value of money. And now we come to the fourth one, which is non-cash consideration. Whenever you have this case of non-cash consideration, remember, I will always recognize or measure the transaction price with respect to the fair value of the consideration received. Whenever there is a non-cash consideration, I transferred good A, I received service B. I transferred good A to the customer. Customer gave me a service B in return. There is no cash consideration here. In such case, the transaction price should be measured at fair value of the consideration received. That is the service B received. If the fair value of the service cannot be determined or the good received is not determinable, If you cannot identify the fair value of the consideration received, in such case, the transaction price should be measured at the fair value of the consideration transferred. What is the value or fair value of the good or service transferred? It is a standalone selling price at which a similar good or service would have been transferred to the customer for cash. The price at which a similar good or service can be transferred to the customer at cash should be considered as a standalone selling price or the fair value of goods and services transferred. I will apply the fair value of good and service transferred only if I cannot determine the fair value of consideration received. Otherwise, generally, transaction price is equal to fair value of consideration received. If fair value of consideration received cannot be determined, then I'll apply fair value of goods transferred. Fair value of goods transferred is equal to standalone selling price. That is the price at which a good or a service is normally, similar good or a service would have been normally transferred for cash. So this is the fourth one which I'm looking at. Non-cash consideration. Lastly, I'll come to the concept of consideration payable to customer. What is this consideration payable to customer? Let's understand. When I come to the last adjustment of transaction price regarding consideration payable to customer, one has to understand that this concept is very simple. For example, I went to Lifestyle for shopping. Okay, I've shopped for 10,000 rupees. He gave me a voucher of 1,000 rupees which can be redeemed on the next purchase. If the next purchase is at least 5,000, if you're billing 5,000 in the next purchase, he is giving you a discount coupon of 1,000 rupees. So on today's day, when the 10,000 rupees of billing has happened, they have given me a voucher of 1,000 rupees. This is called as a consideration payable to customer for a similar good or a service. For example, he has given the same Lifestyle have given me a voucher which can be used in any eatery, any food joint. I will get 50% off on the next purchase. Then this is called as a distinct good or a service. So consideration payable to customer could be of similar goods or could be of distinct goods. I purchased Boost. He has given me a bat signed by Virat Kohli free of cost. Distinct good. I purchased Boost. He said on the next purchase of Boost, you'll get 10 rupees off. Similar good. So whenever there is such kind of consideration transferred, I'll have to first bifurcate the consideration payable to customer into two parts. Such consideration payable in similar good or service, such consideration payable in distinct goods. If it is paid in similar goods, I have a different treat. If it is paid in distinct goods, I have a different treat. What is the treat? If it is paid in similar good, then the value of consideration paid to the customer, should be reduced while recognizing revenue. It should be reduced in recognition of revenue. That means 10,000 purchase on Lifestyle, he gave me 1,000 rupees voucher. That 1,000 rupees will be reduced in recognizing revenue. So I'll record bank account debit to revenue, bank account debit 10,000 which I collected, to revenue 9,000, to deferred revenue 1,000. Why is the 1,000 not recognized now? Because I will recognize this 1,000 when subsequently he will purchase the product on a future date. Let's say this voucher is valid for 1 year. Any time within the next 1 year, if he comes up and bills 5,000, I'll give him 1,000 rupee discount. He'll pay me only 4,000. So therefore, in such case where I received only 4,000, I'll record the entry like this. Bank account debit 4,000, deferred revenue 1,000, to revenue 5,000. This is the case where I have a similar good or a service. Let's say, for example, I have a distinct good, a bat given for Boost. They are distinct goods. Whenever there is a distinct good, revenue should be recognized for the entire transaction price. To the extent of consideration transferred to the customer or payable to the customer, I will recognize it at expense for the cost of that particular item. Bat, I purchased it from an outside vendor for about 40 rupees. And Virat Kohli, I paid him a certain amount. Amortized to this, but each bat is 20 rupees. 40 plus 20, 60 rupees should be recognized as expense in my P&L. But my revenue will be recognized for the entire amount. Let's see what he's talking about. If it is for a similar good or the service, then reduce the consideration payable from transaction price. Recognize revenue when the customer utilizes the benefit or when the benefit expires. Within 1 year, the supplier never came back on. He did not use the 1000 rupee coupon. 1 year expired. Now what you'll do? That expired coupon I recognize as revenue now. So I'll write the entry as deferred revenue account debit to revenue 1000 rupees. If it is a distinct good, recognize revenue irrespective of consideration payable. The consideration payable should be recognized as expense at cost to the customer. At cost to the company. Clear? These are 5 adjustments which we have seen as far as your transaction price is concerned. What are the adjustments? First one was variable consideration. Second one, constraint on variable consideration. Third one, non-cash consideration. Number 4, time value of money. Number 5, consideration payable to customer. With this, we come to the end of step 3, determination of transaction price. So out of total 5 steps, I've completed 3 steps. Number 1, I've completed what is a contract, identification of contract. Second one, I completed identification of performance obligation under contract. Third step I completed is determination of transaction price. Now I'll come to step 4. Now, what is your step 4? Your step 4 is basically allocation of the transaction price which you determined under step 3 to each performance obligation identified under step 2. So what am I doing out here? I'm doing something like this. Under step 1, I identified a contract. Okay. Under step 2, I determined or I identified multiple performance obligations in the contract. PO1, PO2, PO3 is multiple performance obligations in the contract. Like this, I identified. Then I moved into step 3. Under step 3, what I did was, I determined my transaction price. Second, guys. Step 3, I determine my transaction price. Then what is your step 4? Your step 4 is allocating this transaction price to each of the performance obligation. This is my step 4. My step 4 is allocation of transaction price to each performance obligation in the contract. How do you allocate? This allocation of transaction price in the contract, allocation should be based on standalone selling price. Based on standalone selling price. Of good or service transferred to customer under each performance obligation. Under each performance obligation, if you remember the definition of performance obligation, it includes a distinct good or a service transferred to the customer. So each performance obligation has a distinct good or a service. Such distinct good or a service which is transferred to the customer, it should be, we have to identify what is their standalone price. The allocation of transaction price should be based on The proportionate standalone selling price. What do you mean by this concept of standalone selling price? The price at which such good or service can be sold separately by the enterprise. A price at which such good or service is generally sold separately by the enterprise should be the standalone selling price. Always remember, my top priority, my first priority in determining standalone selling price, to determine standalone selling price, my top priority is price at which similar good or service is sold by enterprise. Separately. If I would have sold separately this good and service, if I have already sold it, then based on my past experience, at what price did I transfer the good or service? That should be the proportion of standalone selling price. But the company never had a separate sale of good or service. It's always on a combination basis. A contract always included these separate POs. Then in such cases where you cannot determine what a price at which the customer or the company normally sells these goods separately, in that cases I come to my second priority. Under my second priority, I can apply either of three techniques. I can apply either of three techniques. What are these three techniques? First technique, adjusted market assessment approach. Adjusted market assessment. What do you mean by market assessment? If a similar good or a service was sold separately by another enterprise, then what price did he sell? Sir, he was selling it at 100. My product is much more high quality, 120. So market assessment of a similar good or a service added by some adjustment or deducted by some adjustments. Number 2, cost plus method. What do you mean by cost plus method? In general, I add 25% of margin. The cost of this good which was delivered is 100. Therefore, as per cost plus method, the value of this, the standalone selling price of this product is 125. Residual method. This residual method can only be applied for one performance obligation in the contract. Where under residual approach, he will say that you identify the standalone selling price of each performance obligation. You identify for PO1, you identify for PO2. You can apply residual approach for PO3. How will you apply? PO3 is equal to transaction price minus standalone selling price of PO1 and PO2. If you know the standalone selling price of PO1 and standalone selling price of PO2, then PO3 is nothing but total transaction price minus standalone selling prices. So these are three techniques that I can adopt if I cannot determine the standalone selling price by the entity's expectation of the goods. The entity has never sold the goods and services separately. You cannot use your first priority. Then come to the second priority, which applies three techniques. Any three techniques you can use. Adjusted market assessment. What is the similar if the similar product is sold by any other company, at what price is he selling separately? Take that and adjust it. Cost plus approach. Generally, I add 25% margin. The cost of this product is 100 plus 25%, 125 is your standalone selling price. Residual approach only can be applied if there's only one PO in the contract which is pending. In such cases, total transaction price minus the value of standalone selling price of all other performance obligations under the contract can determine the performance obligation price, standalone selling price by residual approach. Clear? Step 4, allocation of standalone transaction price in the proportion of their standalone selling prices. What is your standalone selling price? Determined either by a similar transaction by the entity, or if you cannot determine by priority 1, come to priority 2. Adjusted market assessment, cost plus margin, and finally residue. So these 3 approaches, any one you can use in determining your standalone selling price. And that will bring us to the end of discussion on step 4, that is allocation of transaction price to each performance obligation. If there is a variable consideration or a discount under variable consideration, should I allocate it in the same manner? Answer is yes, you can allocate it to each performance obligation such amount of variable consideration or discounts in the proportion of their standalone selling price. Or otherwise, the company can arbitrarily say that the bonus or the discount is applicable only to this performance obligation and not to other performance obligations. Discounts and variable consideration can be allocated in the proportion of standalone selling price, or alternatively, they can only be allocated to certain performance obligations if they can be demonstrated. I'll come to step 5. The last step in recognition of revenue is step 5, where I recognize revenue when or as the entity satisfies performance obligation. At the beginning already I told you the recognition of revenue when the performance obligation is satisfied means at a point of time, as the entity performs obligations is over a period of time. So that is what he's mentioning. Recognize revenue when or as the goods and services are transferred to customer. When means at a point of time, as means over a period of time, I'll recognize revenue. What do you mean by transfer? Transfer is transfer on the control of goods. The control over the goods are transferred to customer. When you say that the customer controls the good now, or the supplier or the company has transferred the control over the good, I will say if the physical possession is transferred, title is transferred, risk and rewards incidental to ownership of the asset are transferred, customer has accepted the good, and the customer is entitled to receive benefit from the good. If these 5 conditions are satisfied, then you can say that the good or service has been transferred to the control, or the control has been transferred to the customer. Now, how do I say, when should I say that I have to recognize revenue at a point of time or over a period of time? To demonstrate that, look at what he is giving. The customer controls the asset as it is created or enhanced. The contractor is constructing a building in my land. The land belongs to me. It is my title. He constructed a wall. First, he constructed a wall so that the material is not lost. Constructed a wall and put a gate to me. I can control the gate because it is in my premises. So I control the asset as it is created or enhanced. He started laying the flooring. He completed the first floor. As it is created or enhanced, the enterprise can control the asset because it is on my land. At a point of time, if I say get lost from here, the contractor cannot pick up whatever he constructed and cannot take over. So therefore, in such cases, the control is transferred over a period of time and I can recognize revenue over a period of time. But or the customer receives or consumes a benefit as the entity performs. Newspaper example. What did we say? Each day I put a newspaper, you're consuming the benefit of newspaper. It has the same pattern of transfer to the customer, though it is a distinct good, but is substantially the same. In such case, every day the newspaper got delivered, the customer took a benefit of it. Every week the magazine was delivered, the customer took a benefit of it. In such case, the control is transferred over a period of time. Therefore, recognition of revenue should be over the period of the contract. The asset has no alternative use. The asset has no alternative use. That means the asset which the supplier is actually creating or the company is creating cannot be sold to anyone else. It is only to the customer. And even to the extent of part performance, they are eligible to receive consideration. Then the control is transferred over a period of time, because if I complete 30%, I'm eligible to receive 30% consideration. I complete 70%, I'm eligible to receive 70% consideration. So therefore, if the asset does not have an alternative use, it has to be supplied to the customer only, and the entity has a right to receive payment until that date. Then you can still say that the control is transferred over a period of time. Asset has no alternative use. It has to be used only by that customer only. I am preparing, I am customizing only for that customer. No other customer can requires this item. But part performance, I am not eligible to receive payment. Therefore, consideration is not eligible to receive unless and until you complete the entire product. Therefore, consideration control is transferred only after the entire completion, that is only at a point of time. Clear? For recognizing revenue, I have to reasonably measure the progress of the entity towards the completion of the contract. To measure the entity's progress, whenever I'm talking about control being transferred over a period of time, recognize revenue over the period of contract, on 31st March, I'm exactly in the middle of the contract. How do you estimate how much amount of revenue should be recognized? You said recognize revenue over a period of time, right? Over the period of contract, I can recognize. 31st March, I have to close my financials. You tell me how much revenue I should recognize. That amount to be ascertained, the enterprise can use either output method or input method. Input method is what was given earlier under your AS7. Under your AS7, we used a particular formula called as proportionate completion method. It was applicable even under Ind AS 11 as well. Now it is removed. It has come into Ind AS 115. So to measure it, you can do it as per input method, where you take the cost which has been incurred by the enterprise till date divided by total cost expected to be incurred to complete the contract into 100 to identify how much of percentage of contract has been completed. In that way, I can measure the enterprise progress reasonably in completion of contract. Output method means I will use what is the amount of output rather than the cost incurred, how much has been output been delivered. The total contract is for construction of 5 floors. 4 floors completed, 80% completed. That is output method. So this way, you will have to make sure that you are reliably measuring the progress of an enterprise in satisfying the obligations under the contract. Sometimes, either input method you use or output method you use, I cannot reliably measure the progress. I could not measure the progress either by applying input method or output method. In such cases, I will recognize revenue only to the extent of cost which is eligible to be reimbursed by customer. I incurred 100 rupees. I expect the customer to reimburse 85 rupees even if the contract stops now. Then 85 rupees is revenue. No profit shall be recognized in such instance where you cannot reliably measure the progress of the enterprise in satisfying performance obligations. Clear? Now, the cost incurred to satisfy performance obligation are generally incurred in two types. Certain costs which should be always charged off to P&L because it is not related to the contract, like general administration cost, wasted resources, they'll anyways be charged to P&L. But certain cost is eligible to be capitalized. This cost I will recognize in P&L by matching concept. To the proportion of revenue I recognize, that proportion of cost I will recognize in P&L. What is this cost eligible to be capitalized? Direct cost of contract, cost to enhance resources, and expected cost which I expect to recover from the customer. These are costs which are eligible to be capitalized. This cost which is capitalized should be charged to P&L or expensed in P&L in the proportion in which I recognize revenue. As I keep satisfying the performance obligation, I keep on recognizing revenue. in the same proportion in which the revenue is recognized, even such cost should be transferred to P&L. Clear? Impairment of cost. This is onerous contract. That means if the contract cost capitalized exceeds the revenue to be recognized, then the contract is onerous. That means there is a expected future loss from the contract. Whenever there is an expected future loss in the contract, these are called as onerous contracts, which we have already dealt under Ind AS 37. There also I gave you the same example. If the cost incurred to complete the production of a material is more than the estimated selling price, in this case, the cost incurred in completion of the contract is greater than the estimated remaining revenue under the contract, then there is an expected future loss. Such expected future losses, applying the concept of conservatism, should be charged to P&L immediately. And that will bring us to the end of discussion on Ind AS 115. The 5 steps that we have seen as far as measurement of revenue is concerned or recognition of revenue is concerned were identifying the contract, measuring the performance, identifying performance obligations under the contract, measurement of transaction price, allocation of transaction price to performance obligation, recognizing revenue as or when the entity performs the obligation. That is, as or when the transfer over the control of good is to the customer, where the control is transferred to the customer. Depending on that basis, I'll recognize revenue either over the period of the contract or at a point of time in the contract. Yes, guys. So let's get into the topics of Ind AS 115, where we talk about revenue from contracts with customers. So here we are typically talking about certain nature of transactions which are related to revenue recognition contracts and how they have to be dealt with according to the change in the standard or the new paragraphs added as per ICA. So now let's look at certain transactions as such. The first such transaction that I will talk about is sale with a right to return. What do you mean by sale with a right to return? Now, sometimes it so happens that I sell a good and the customer has a right to return the good within a particular time period. These are sale on acceptance or return basis, right? So these are common transactions like how you sell goods on Myntra, right? So basically the customer has a right to return the good which he purchased on Myntra within a period of 30 days from the end of the day on which within 30 days from the end of the day on which that particular transaction has occurred. So these are common. So my question is, whenever we have such kind of transactions which are sale on return basis, then my point is, if the seller at the time of return is charging certain cost. Now, what is a cost that he'll normally charge? Think from a seller's point of view. If you are a seller, what is the general charges that you expect a customer to pay you? I'll say, I have sent the goods to you, right? And these goods which I've sent to you had some packing involved in it. There was some courier charges which are involved in it. I have to pick up the goods from you, repack the goods and sell the goods probably at a discounted price because you might have actually damaged the good. So whenever these kind of costs are incurred and the seller is expecting certain costs to be reimbursed by the customer in case there is a return. Myntra 100% credit, I agree. But what if the seller says, I'll deduct 5% of the total consideration or the transaction cost if you return the good within the time period? Quite possible. Now, in such kind of transactions, how do I recognize the transaction? Let's look at it. Let's say, for example, there is a seller X and there is a customer Y. Okay. I'm saying, for suppose my transaction involves 100 units to be sent out at the rate of rupee 50 per unit. Okay. And I am saying Y has a right to return. Y has a right to return. He can exercise his right to return, but at the time of right to return, the customer pays 10% of transaction price. Let's say, for suppose X expects, let's say his expectation is 95% acceptance. And let's say this transaction actually occurred on 6th of March 2021. On this particular date, such a transaction has occurred between X and Y, where X sold 100 units at 50 rupees per unit to the customer Y. Y has a right to return, and if he returns, he pays 10% of the transaction price to the customer. That means at the time of refund, I will not refund the entire 50 rupees, but I will only refund you 45 rupees. Clear? Now let's say if the transaction has occurred on 6th March in the books of Y, or in the books of X, seller, what is the transaction to be recorded? The transaction goes like this: bank account debit. How much did I receive? I received 100 units into 50 rupees, which is nothing but, how much is the amount? 100 into 50 is 5,000. But can I recognize the entire amount as revenue? So to sales, I cannot recognize the entire 5,000. The entire 5,000 is not possible because I am reasonably expecting that there is a chance of return. So therefore, 5,000 is not to be recognized. Then how much revenue should I recognize? I will split it into two parts. First part, on 95% of goods which I am expecting they should not be returned, I'll recognize full revenue. Plus, on the balance 5% of the goods which are expected to be returned by the customer, I'm saying that I'll still collect 10% of the transaction price. That is 5 rupees. So what is the cost? 95 into 50 plus 5 into 5 is 25. 95 into 50 plus 25. So I will recognize the revenue only to the extent of 4,775. Then what about the balance? There is still a balance of 225 rupees, which has to be recognized as a credit. Then what is the amount to be recognized as a credit? This balance credit I will recognize as a liability. Liability of return. Let's say, for example, he has actually returned about 2 units. Okay. Let's say, for example, the actual return within 30 days is 2 units. That's it. Not more than 2. Just 2 units got returned by the end of 30 days. That was the time limit offered for return. Then in such case, I will go on like this. I'll say debit the liability of return. Liability of return. How much did I debit earlier? Or how much did I credit earlier? 225 rupees. The same 225 you debit it now because 30 days is over. Now I have to recognize this transaction of return. How will I recognize the transaction? 2 sales. How many did he return? 2. How much did he not return? 3, right? Because I said 5% of the goods are eligible or expected to be returned. Out of 5, only 2 got returned. So the balance 3, I'll have to recognize a sale. 3 units. I have already recognized 10% of the transaction price as revenue, because I said that is the amount which I expect or which the customer shall pay even in case of return. Therefore, I'll only recognize 45 rupees as sale. The balance amount which I refund, I'll write it like this. Back. How much will you refund? I will refund for 2 units. 45 rupees is what I'll return. So what is the amount? Amounts to be recognized 135 and 90. This is exactly the new nature of transaction which got involved as far as Ind AS 115 is concerned. So what am I saying? Whenever there is a right to return, I will recognize the transaction only to the extent it is probable to occur. To the extent it is not probable, here I said 95% of the transaction will occur. There is a 5% chance of return. So such 5% chance of return, I recognize revenue only to the extent of the transaction price I will receive in the case of return. Here I said 10% of the transaction price will be held by the supplier even in case of return. So for the 5% of the goods which are expected to be returned, I recognize 5 rupees as revenue on the date of transaction itself. But within 30 days, since he did not return the goods, I'll recognize like this. To the extent of 2 units that he actually returned, I will refund 45 rupees directly to the customer. But for the balance 3 units, where I recognized only 5 rupees of revenue expecting him to return the good, I'll recognize the balance 45 as sales. Now let's start looking at what is given out there. I'll go back to the PDF. Yes, now what did he say? Entity sometimes charges a restocking fee when the product is returned. This fee may be levied by entities to compensate the cost of repacking, shipping, reselling the item at a lower price to another customer. Restocking fees for goods is expected to be returned will be included in the estimate of the transaction price at the contract inception and recorded as revenue when and as the control of the good transfers. For example, the entity enters into a contract with a customer to sell 10 units of the product at 100 rupees per unit. The customer has a right to return the product, but if he does so, he will be charged 3 rupees as stocking fee. That is 3 rupees, 3% as stocking fee, which is 3 rupees. The entity estimates that 10% of the goods sold will be returned upon transfer of control of those 10 units. Now, how much will the enterprise recognize as revenue? Out of 10 units, 10% are expected to return, that is 1. So on the balance 9 units, entire 100 rupees of revenue can be recognized on the date of transaction at the inception of contract itself. So 9 into 100, 900 plus on the 1 unit which I expect the customer to return the good, I am still expecting 3 rupees to be paid for that particular good. So 1 unit into 3 rupees is 3. Therefore, 900 plus 3, 903 will be recognized as revenue on the date of transaction or on the date of commencement of the contract. Clear? The balance 97 rupees of the transaction price, which is the liability for return, should be recognized separately. If the good gets returned, I will refund it in bank. If the good does not get returned, then the balance 97 rupees as liability will now be recognized as revenue. This is a very new concept coming out called as restocking fees. Clear? Now, how much revenue should the customer or should the enterprise recognize? Goes with the simple concept under Ind AS 115. To the extent it is probable that the revenue recognized will not be reversed. This logic was constantly repeated in Ind AS 115, continues to be active even now. Clear? Yes, guys. So let's start looking at this topic of license of intellectual properties. Now, license of intellectual properties is a very, very interesting concept because your Ind AS 115, for the purpose of recognizing revenue from license of intellectual properties, has divided the entire principle of licenses into two types. A license which gives access to intellectual property throughout the license period, and a right to use intellectual property as it exists at a point of time. Now, I hope no one understood even a sentence what I said, but let's try to understand it with the help of certain examples. So when I said license of intellectual properties, what do you mean by intellectual properties? Any intangible asset. A software which I own, a movie which I produced, a music which I composed, a book which I have written. All these are intellectual properties. Intellectual properties arise when there is any patents or copyrights or trademarks are registered. In such case, I will come across this concept called as intellectual property. So if you want me to give you certain examples, I can give you examples like music, videos, scripts which I have written, or could be even in the case of a particular software which is developed, etc. Just leaving it there. There are multiple other intellectual properties. I don't want to name each and every one of them. Giving an understanding of what intellectual property is the main objective out here. So I'm saying whenever there is a license of intellectual property, for the purpose of recognizing revenue, I will divide these licenses into two types. What are these two types? First, is the license of intellectual property. I'm writing it as IP. Over the period of license. I'll explain what this is. The other one is license of intellectual property as it exists at the point of time when the license is granted. How are these two significantly different? License of intellectual property over a period of license of intellectual property as it exists at the point when the license has been granted. Now you tell me, what do you understand from these two statements and how are they so significantly different? I'll tell you. I hope all those people who are watching us right now have either had an Amazon Prime membership or a Netflix membership or any other OTT platform membership. When I subscribe to the membership of an Amazon Prime or Netflix for a period of 1 year, it gives me a right to access whatever content is uploaded on Netflix or Amazon Prime, existing at that same point of time, existing exactly on the day on which such license has been given. At the same time, it also gives me access to view content which gets uploaded over the period of my license of 1 year. A new movie released right now, It got uploaded in Netflix 4 months later. I hold a membership for 1 year. I have an eligibility to view even such content which is uploaded into Netflix, not at the point when I took the license, but during the period of the license. So during the period of the entire 12 months, whatever content Netflix actually provides or whatever content Amazon Prime actually uploads on its platform, I will be entitled to view the content. That is called as license of intellectual property for a particular period of time, let's say 1 year. But license of an intellectual property as it exists at a point of time, I'll tell you. Think from the perspective of the movie producer. Movie producer has the license right of that particular movie which he produced. Let's say I'm talking about a grand scale movie like a Bahubali. So the producer owns the entire right of that particular intellectual property, which is the video which he has, which is in 2 parts of 3 hours each and probably 6 hours of content. That 6 hours of content, I'm leasing it out to Amazon Prime. I'm giving it on a lease to Amazon Prime. Now what happened? Amazon Prime has subscribed to the lease and has taken up the lease for a period of 3 years. Over 3 years, Amazon has a right to display the content which they have taken from me on license. Now, will I produce another movie? Or will I make Bahubali Part 3? Not possible. So, as the intellectual property exists on today's date, which is in the form of 6 hours content, that 6 hours content, I'm giving a right to Amazon Prime to play the video. So in this case, the license of intellectual property, which is a movie, which the producer is giving to Amazon Prime to display it on his OTT platform, it is a license of intellectual property as it exists on the day when the license is granted. Amazon Prime is not expecting me to develop any further content over that period of 3 years. He's saying whatever content you have, that I am taking a right to play this content for a period of 3 years is what I'm saying. These are two types of intellectual property. A license of intellectual property over a period of time, a license of intellectual property as it exists at a period of time. Nowadays, you have pay-per-view. Pay-per-view movie means you go to the platform like Zplex or anything. You basically click on the movie, you pay that certain amount of 49 rupees or 99 rupees for the movie, and you can watch that particular movie. Such movie, let's say I've granted you a license to watch that movie if you made the payment once for a period of 1 year, I said. Will the movie change over a period of the year? Absolutely not. Will the climax change? Ultimately, the villain wins and the hero loses? That is not going to happen. So the movie content is going to be the same. The day on which I bought the license to watch that particular movie, whatever content was there, it will be the same content which will exist even at the end of the 12th month as well. So that is the second part where I said license of intellectual property as it exists at a point of time when the license is granted. Now, when I look at license of intellectual properties in this manner, look at this. Any license of intellectual property which has been paid over a period of for a period of license, over the period of license, I'm paying it. So something like your Amazon subscription. In such case, revenue should be recognized over a period of time. Why over a period of time? Because as the contents get uploaded onto the OTT platform like Amazon Prime or Netflix, the control of that particular content is given to the subscriber of the license who have paid for that 1 year of license. So therefore, here the satisfaction of your performance obligation is met over the period of the license of 12 months. I cannot say you subscribed on 23rd of February 2021. So you are entitled to only watch the content which is existing as on 23rd February 2021. Not possible. Your license which you have subscribed on 23rd of February 2021 is existing until 22nd of February 2022. So whatever content exists at the point of subscription and whatever content is uploaded during this particular period of 1 year, the viewer or the purchaser of the license is entitled to view the content. So therefore, the performance obligation is not met at a point of time, but it is met over a period of that year, period of the license. Let's go to the second part. It is a license of intellectual property as it exists at a point of time when the license is granted. At a point of time when I granted the license, this is the content. I've shown you the content. You want the license for 12 months or 3 years, I'll give it to you. So the person has actually subscribed to the license of intellectual property. Here, the content did not change. Therefore, performance obligation is met as soon as I granted the license. Therefore, in this case, revenue is recognized at a point of time. What do you mean by over a period of time here in license of intellectual property? Over a period of time means the period for which the license was granted. Period for which license is granted. License is granted for 1 year, then recognize revenue over that period of 1 year. License is granted for 3 years, then recognize revenue over 3 years period. If I look at this logic at a point of time, then in the case of at a point of time, I would say the point of grant of license. As soon as I granted the license, I can start recognizing revenue because the content is not new. It is going to be the same content which is made available to the subscriber of my license over a particular period. Since the license does not change or the content does not change, it shall be considered as a revenue recognized at a point of time. That is the point when the license was granted. This is particularly a very peculiar theory which has emerged. So what did I say? I'll sum it up. And I'll say, in the case of license of intellectual properties, I will divide the licenses into two types. First one, where the license has been granted for a period of time. Or I said, I'll go back to the PDF. Yeah, look at here. A right to access intellectual property throughout the license period, which results in revenue that is recognized over a time, and the right to use intellectual property as it exists at the point at which the license is granted, which results in revenue to be recognized at a point of time. I've given you example. What is the example which I've taken? I'll come back to the example, guys. I said there is a movie producer. This movie producer has intellectual property of videos or the movie that he has produced. And then there is an OTT platform. And there is ultimately a subscriber of OTT. Here, what is happening? The content is static for the movie producer. Movie producer has produced a particular movie. The movie is not going to change. It is the same movie. So once the license is granted to the OTT platform, then in this case, there is a license to display content as it exists. There's no change. As it exists, the same content will be shown in the OTT platform. But when OTT platform gives the subscription or license to the subscriber, then this license is to display content over the period of license. Generally, annual subscriptions. Therefore, whatever content that it displays over the entire 1 year, the entire content is subscribed or is available to the subscriber to watch. In this case, I am saying where I gave you the situation of license to display content as it exists at the point of time. So I will recognize revenue at a point of time. Who will recognize revenue at a point of time? The movie producer. Because it is the movie producer who owns the intellectual property. So he will recognize revenue at a point of time when the license is provided to the OTT platform. But in the other case, where OTT has given the right to subscriber to watch the content on the platform over the period of license, then in such cases, I'll recognize revenue over the period of license. Or over a period of time. Who will recognize revenue over a period of time? The OTT platform which has received the subscription money from the subscriber shall recognize revenue over the period of license. Clear? So this was the classic example which I have given, because I took this example because both the type of licenses get covered in this particular example. I know your ICA has come out with completely different examples. They are also easy to understand, but this is one example which I thought is actually covering both the types of licenses in one single example. And you understand exactly what is the difference in both the licenses. Clear? So let's see what the what examples did the ICA give and what are certain illustrations based on these topics. Yes, guys. So let's look at licenses for intellectual property and certain examples and illustrations given as per your ICA study material. Right to the example that is given, starting with Pogo has created a popular television show called as Chota Beam. Very popular, TV series, and especially with those toys that he has given. Pogo grants a 3-year license to a toy manufacturer for the use of the character Chota Beam and on its toys. As per the contract, Pogo will continue to produce the show and popularize the character and carry out marketing activities. The toy manufacturer produces and sells Chota Beam toys, and in this case, the license provides access to Pogo's intellectual property rights. Pogo will undertake activities that significantly affect the intellectual property by production and marketing of the show and development of the character. Toy manufacturer is directly exposed to any positive or negative effects of Pogo's activities. That is how the show is received by the kids and their parents. These activities are not separate performance obligations, as they do not transfer good and service to the toy manufacturer separate from the license. Therefore, Pogo shall recognize such revenue over period of time. Because though it is a 3 years contract, it is not just the license to use Chota Beam's character, but also Pogo has an obligation to develop the character, market the character in such a way that the popularity of the character stays intact for 3 years. So since Pogo's obligation is not just to give the license, but also to perform other activities to keep the popularity of the character up. Therefore, it is a performance obligation which is not transferred at a point of time but over the entire 3 years. Therefore, the license revenue will be recognized by Pogo over the entire 3 years period of time. Right to use. In contrast, the license represents a right to use the intellectual property as it exists at a specific point of time, and the customer gains control over the intellectual property at the beginning of the period for which it has the right to use the intellectual property. Then the timing may differ from when the license was granted. Clear? Look at the question he has given or the illustration that he has given. An entity, a music record label, licenses to a customer a 1975 recording of a classical symphony by a noted orchestra. The customer, a consumer products company, has a right to use the recorded symphony for all commercials, including television, radio, and online advertisement for 2 years in a country A. In exchange of providing the license, the entity receives a fixed consideration of 50,000 rupees per month. The contract does not include any other good or service to be provided by the entity. The contract is non-cancelable. Determine how the revenue will be recognized. So first thing that we will fall to a trap of is that 50,000 rupees is being remunerated per month basis over the entire 2 years of the contract. But you need to understand what is the license given for. The license is given for a music or a particular synchrony by a noted orchestra. So as on the date the license was granted, this orchestra or this music which has been already created is existing. As it exists, the customer is basically ready to accept it. So there is no new development which is emerging over next 2 years. There is no other obligation for this entity which is a music record label. Look at the statement that he has made. The contract does not include any other goods and services to be provided by the entity. Therefore, as such, it is only the license of intellectual property as it exists on the day when the license was granted. So even though the consideration is paid by the entity over the period of time, you need to understand that this is a revenue which has to be recognized at a point of time. Look at the statement. The solution for this: the entity assesses the goods and services promised to the customer to determine which goods and services are distinct in accordance to para 27 of Ind AS 115. The entity concludes that the only performance obligation is the grant of the license because there is no other transfer of goods and services. The entity does not have a contractual or an implied obligation to change the license recording. The license recording has a significant standalone functionality, and therefore the ability of the customer to obtain the benefit of the recording is not substantially derived from entity's ongoing activities. The entity therefore determines that the contract does not require and the customer does not reasonably expect the entity to undertake any activities to significantly affect the license recording. Consequently, the entity concludes that the nature of promise in transferring the license is to provide the customer with a right to use the entity's intellectual property as it exists at a point of time when it is granted. Therefore, the promise to grant license is a performance obligation satisfied at a point, and the entity recognizes all the revenue at a point when the customer can directly use or obtain substantially all the remaining benefit from the licensed intellectual property. So therefore, here we are saying that this license contract will be recognized as revenue as and when the license is granted to the customer. Clear? Moving on. A software company X licenses a software to company Y. Under the agreement, X will provide updates and upgrades on a when and if available basis. Y chooses to install them. Y expects that X will undertake no other activities that will change the functionality of the software. So what is he saying? He's saying that I'll give you a software. If in case there is a necessary change, which if any, that means there is a change. Let's say I give you an accounting package. Okay. There is a change in the GST forms. So what happened? Such GST forms have been embedded into the software itself. In such case, whenever there is a change, I will make sure that the software is made available to you or the change is made available to you. However, Y expects that X will undertake no other activities that will change the functionality of the software. In such case, here it is satisfied at a point of time. There is no satisfaction over a period of time. There is no commitment of X. There is no commitment of X to develop this particular software over the license period. It can leave it as it is and Y cannot question it. If any it is available, if any there is a change necessary, then X will undertake and give it to Y. However, there is no obligation. Since there is no obligation, the only obligation in this entire contract is the license of use of software. The license of use of software, when it is transferred, then the performance obligation is complete and you can recognize revenue at a point of time when the license is granted to entity Y. Read the solution. Based on the facts given in the question, it is concluded that although the updates and upgrades will change the functionality of the software, they are not considered in determining the nature of entity's promise in granting the license. The activity of X to provide updates and upgrades are not considered because they transfer a promised good or service to Y, that is, upgrades are distinct from the license. Therefore, the software license itself provides a right to use the intellectual property which is satisfied at a point of time. Now, both the illustrations that we have seen have given us the same kind of feeling that both cases the revenue was recognized at a point of time. Let's see certain revenues which are expected to be satisfied over a period of time. Film Studio C grants a license to customer D to show a completed film. It's a completed film. C plans to undertake significant marketing activities that it expects to affect the box office receipts for the film. The marketing activities will not change the functionality of the film, but could affect the value, determine the nature of license. I produced a movie, and this particular company D has taken the license to showcase the movie, like an OTT platform, just like a Netflix. But C plans to undertake significant marketing activities which could affect the box office receipts of the film. However, these marketing activities will not affect the functionality of the film, but could affect the value of the film. Guys, in this case, if you look at here, what you're saying, it is a standalone functionality and they do not significantly affect the D's ability to obtain benefit. So I will still say that this is a license which is transferred or intellectual property transferred at a point of time. C probably concludes that the license provides a right to use the intellectual property. Therefore, it is transferred at a point of time. There is no expectation that C will undertake activities that will change the form or functionality of the film. However, the intellectual properties are significant standalone functionality. C's marketing does not affect D's ability to obtain benefits from the film, nor will they affect the intellectual property available to D. Therefore, the revenue should still be recognized at a point of time. I'm still waiting for an illustration where we get over a period of time. Look at question number 16 then. Sports team D enters into a 3-year agreement to license its team name, logo to apparel manufacturer M, like how India is now using Byju's. Okay, so basically a particular apparel making company is making the license to use the sports team name D. The license permits M, that is an apparel manufacturer, to use the team name and logo on its product and display products in its advertising and marketing material. Determine the nature of license in the above case. Modifying the above facts, sports team D has not played games in many years, and the licensor is a brand collector B, and the entity has acquired IP such as old team or brand names or logo from defunct entities and those in financial distress. B's business model is to license the intellectual property and obtain settlements from entities that use intellectual properties without permission, without undertaking any ongoing activities to promote or support the intellectual property rights. Would your answer be different in this situation? Two situations he has given. In the first case, it's an active team which is using it. An apparel manufacturer M has obtained the license to use the team name and logo for its products and display for its advertising and marketing material. What if the team does not perform well? Suddenly the performance of the team dips and they are not performing any well at all, and most of the fans are really disappointed with it. If I ask you to buy a bat which is signed by a player who hasn't scored a run in the last 10 innings, will you still buy it? I'll say that person is not even performing. What is the point of even buying such a bat or a t-shirt which is signed that by such an artist? Therefore, the intellectual property which has been obtained by the apparel manufacturer M is significantly affected by the performance of the sports team D. If it performs better, then the apparel manufacturer will start selling more. If the performance of the team dips, then it is not possible to basically extract so much of economic benefit from the intellectual property. Therefore, in this case, even though it is just to use the team name and to use their logo, however, the performance obligation will depend on the performance of the team, and it will significantly define or determine the value of the product. Therefore, this is a case where it will be satisfied over a period of time. Look at it. The nature of D's promise in this contract is to provide M with a right to access the sports team's intellectual properties, and accordingly the revenue will be recognized over time. In researching this conclusion, D considers the above facts. M reasonably expects D to undertake activities that will support and maintain the value of the team name, logo, and by continuing to play games and fields a competitive team throughout the license period. These activities significantly affect the intellectual property's ability to provide benefit to M, because the value of the team name and logo is significantly derived from and dependent on these ongoing activities. The activities directly expose M to a positive and a negative effect, that is, whether D plays games and fields in a competitive team, which directly affects how successful M is going to sell its products featuring the team name and team logo. These ongoing activities do not result in a transfer of goods and services as they occur. That is, the team playing games do not transfer any good or service to M. But what is the second one? They are defunct teams. But if someone who copies a copyright or an intellectual property, they want to sue them and extract money. That is the intention. So they are already a defunct team. Here, based on B's circumstances, apparel manufacturer M probably does not expect B to undertake any activities to change the form of intellectual property or to support and maintain the intellectual property. Therefore, it is probable that to conclude that the nature of promise to provide M with the right to use the intellectual property as it exists at the time when the license is granted. Therefore, in this case, the revenue shall be recognized with respect to these intellectual properties of a defunct team. In the second point, if it is a defunct team, then I don't expect you to play any ongoing games, or I don't expect you to play in a competitive manner. It is not going to determine the value of the license. Therefore, it as it exists at the date of grant of license, the intellectual property is undertaken. Therefore, in the second case, it is a revenue which is recognized at a point of time, that is when the license is granted. Clear? So this question is even more comprehensive because we have seen both the cases where it will be recognized over a period of time, and also where it will be recognized at a point of time. Yes, guys. So let's see furthermore additions as far as your Ind AS 115 is concerned. They are included in your study material recently. So let's see these questions. These should be the most important ones. Ind AS 115, question number 17. An entity G has entered into a contract with customer P for the sale of a machinery for 20 lakhs. P intends to use the machine to start a food processing unit. The food processing industry is highly competitive and P has a very little experience in that industry. P pays a non-refundable deposit of just 1 lakh at the inception of the contract and enters into a long-term financing arrangement with G Limited. To pay the balance 19 lakhs of the consideration, they are entering into a long-term financing arrangement with the vendor, who is J Limited, for the remaining 95% of the agreed consideration, which it intends to pay primarily from the income derived from the food processing industry, as it lacks any other major source of income. The financing arrangement is provided on a non-recourse basis. What do you mean by non-recourse basis? He further explains, which means that if P defaults, then G Limited will repossess the machinery and cannot seek further compensation from P Limited even if the full value of the amount owed is not recovered from the machinery. The cost of the machinery for G Limited is about 12 lakhs. P obtains control of the machinery at the inception of the contract. When should G Limited recognize revenue for the sale of machinery to P Limited in accordance with Ind AS 115? The first paragraph that I will test as far as recognizing revenue is, should I consider this particular contract as as a contract with customers? So first of all, when I use the the heading of Ind AS 115 revenue from contract with customer, there are certain parameters to be met to be called as a contract with customer within the subject of Ind AS 115. There are 5 parameters to be met. First one, both the parties to the contract have agreed to the contract either orally or in written form. Both the parties have understood their rights and obligation with respect to goods and services which are supposed to be delivered in the contract. Third one, the contract has a commercial substance. Fourth one, the parties have identified a transaction price within the contract. Last one, there is a high probability that the consideration will be received for the goods and services transferred within the contract. When do I say that it is probable to be received? When the customer has an intention and ability to pay. Now, putting the fifth one to test, where the consideration is probable to be collected. That means the party or the customer has both an intention as well as an ability to pay the consideration under the contract. Look at here. Number one, the amount or the balance 19 lakhs of consideration, which is supposed to be collected from the customer, is primarily paid out of income derived from the food processing industry, and there is no other major source of income to P Limited. First indicator to say that it is not convincing enough that the consideration will be received. Furthermore, collaborative evidence, if I have to add, I'll read the first paragraph which says P has a very little experience in the said industry. Furthermore, collaborative evidence I'll take on saying that it is on a non-recourse basis. That means if P Limited fails to pay the amount, G has a right to repossess the machinery but cannot seek P for any extra payment even if the machinery was not meeting or was not sufficient to cover the amount outstanding from P Limited. So this gives us sufficient evidence that the contract is not meeting the definition of Ind AS 115 or the ambit of Ind AS 115. Therefore, revenue cannot be recognized and on the date on which the contract has been entered into, because the consideration supposed to be collected from the contract is not probable, even though P Limited has an intention to pay, but they still lack the ability to pay the amount. First thing, what about the 1 lakh? What about that 1 lakh which I have received initially as a non-refundable deposit? Can I recognize that as income? Any amount collected as a part of consideration in the contract can be recognized as revenue in 2 cases. Number 1, there is no further goods or services to be delivered as a part of the contract. Number 2, where the contract is terminated and the amount collected so far is non-refundable. Even this condition also cannot be satisfied because the contract is not terminated and the goods and services are supplied within the contract, I am not really convinced about it. Therefore, I may not say that that 1 lakh also should be recognized as income. So therefore, the income recognition in this particular case in question number 17 will obviously be deferred. Deferred until when? Until it is deferred, I will show this amount as a liability. I'll show it as a liability. So I'll write it as customer P Limited to a liability. I will recognize this liability as income only when the condition number 5, where the consideration is probable to be received, is crystallized. Once I understand that the condition number 5 is satisfied, that P Limited is in a position that they will meet the consideration as per the contract, then I will start recognizing the income. But until then, the income from the contract should be deferred. Clear? Let's look at question number 18 then. Entity I sells a piece of machinery to the customer for 2 million payable in 90 days. Entity I is aware that at the contract inception that the customer may not pay the full contract price. Entity I estimates that the contract will pay at least, the customer will pay at least 1.75 million, which is sufficient to cover the entity's cost of sale, which is only 1.5 million, which the entity I is willing to accept because it wants to grow its presence in the market. Entity I has granted similar price concession in comparable contract. Guys, whenever there is a past trend of price concession, then there exists a variable consideration in the contract. Whenever I have variable consideration in the contract, I will recognize only revenue only to the extent of revenue to which the reversal of revenue is uncertain, or reversal of revenue is not highly probable. Where is the reversal of revenue not highly probable? To the extent of 1.75, which is likely to be received, the reversal of revenue recognized is not highly probable. Therefore, the enterprise I or entity I can recognize revenue to the extent of 1.75. Clear? What is the transaction price? It is only 1.75. Question number 19. Entity K sells electric razors to the customer, to the retailers at C is a currency, guys, 50 per unit. The rebate, the coupon is included inside the electric razor that can be redeemed by the end customer for 10 per unit, whatever currency it is. Entity K estimates that 20 to 25% of the eligible rebate shall be redeemed. Guys, out of all the customers, to every customer whom I sell it at 50, I'm saying that there will be a consideration which is paid to the customer in the form of a coupon. That coupon rebate is about 10. And I'm not expecting everyone to use that particular rebate. Only 25% of the eligible people will be using that rebate, 20 to 25. K concludes that the transaction price shall incorporate an assumption that 25% rebate redemption, as which the amount is highly probable that a significant reversal of cumulative revenues will not occur if the estimated rebates change. How does K estimate determine the transaction price? So when I actually recognize the revenue, I will recognize revenue to the extent of 50 minus 10 rupees, out of which only 25% is eligible or is generally redeemed. So 25% of 10, which is 2.5. Therefore, for each razor sold, the enterprise will recognize only a revenue of 47.5. The balance 2.5 which I collected from the customer, I'll put it as a liability until the rebate is actually utilized or the rebate lapses. If the rebate is utilized, then I'll cancel it against the subsequent revenue. And if the rebate is no longer eligible, that means it is expired, then in such cases, such liability will be recognized as revenue at a later point of time. So initially when I recognize the transaction, I'll write the entry as bank account debit 50, to sales 47.5, to liability for coupon is 2.5. If it is further utilized at a later point of time, then I will write liability for coupon 2.5 to sales. The same way, I will also recognize revenue only when the liability has lapsed or the rebate has or the coupon is terminated. Clear? Okay, so let's continue to look at question number 20 then. A manufacturer enters into a contract to sell goods to its retailer for 1000 rupees. The manufacturer offers a price concession whereby it will reimburse the retailer for any difference between the sale price and the lowest price offered to any customer during the following 6 months. This clause is consistent with other price protection clauses offered in the past, and the manufacturer believes that it has an experience with a predictive which is predictive of this contract. The management expects that it will offer a price decrease of 5% during the price protection period. The management concludes that it is highly probable that a significant reversal of cumulative revenue will not occur if estimate changes. How should the manufacturer determine transaction price? Guys, if you remember transaction price, a price at which the goods and services are sold under the contract, or the consideration collected for goods and services transferred to the customer under a contract, where such kind of revenue is highly probable that it will not reverse. It is highly probable that a significant reversal of revenue will not occur in future. How much of reversal can occur in future? To a maximum of 5%. That is the management estimate. So therefore, while recognizing revenue and to consider a transaction price, instead of taking 1000, I will include even that 5% of a discount which I would offer in general. So that means about 50 rupees. Therefore, I will only recognize a revenue for 950 rupees. The balance 50 rupees which is expected to be reimbursed to the customer will be shown as a liability. Clear? If I have to reimburse this, then the liability portion will be paid off in cash or adjusted against the subsequent bill. Or if in case the discount need not be offered, then at a subsequent period of time, that is after 6 months in this contract, after 6 months, if there is no significant discount being offered, such liability will be subsequently recognized as revenue. So what is your accounting entries that will occur in this? Customer account debit or bank account debit to sales, but customer will be debited by 1000. To sales, revenue recognized only for 950. To liability for rebate, 50. This liability for rebate, if I have to adjust in future or to repay in future, then the liability account debit to bank will be the entry. If in case during the period of 6 months, I have offered only a discount of 20 rupees maximum to any customer, then the entry will be liability account debit 50 to to your cash, which is to the extent of 20, and balance 30 will be recognized as sale. Clear? So liability for rebate account debit 50, to cash 20, to sales 30 rupees. So this way, whenever you are not certain of what is the transaction price, then recognize revenue only to the extent where there will not be a significant reversal of revenue in future. To such extent, I can recognize revenue. So here I will recognize revenue on the date of transaction to the extent of 950 rupees only. Electronic manufacturer M sells 100 televisions to a retailer for 50 lakhs, which is 5000 rupees per television. M provides price reduction to R by agreeing to reimburse R for the difference between the price and the lowest price that it offers for that television during the following 6 months. Again, very similar to what we have seen in the previous question. Based on M's extensive experience in similar agreement, the following are the estimated outcomes. When there are multiple outcomes regarding a transaction price, there are two ways of determining transaction price. If there are only two possible outcomes, then the most likely outcome will be identified. If there are more than two, then I'll have to go for something called as expected value. What is expected value? Expected value is a sum of probability into outcome. So each time there is a probability being set up or estimated, identify the outcome, identify their probability, multiply all the estimated outcomes into probability and get the total. That is called as expected value. This occurs only in situations where there are multiple outcomes possible in a transaction price and the number of outcomes are more than 2. If there are only 2, then I will not go for expected value, but I will go for most likely amount. So here there are 3 estimated outcomes. So where the price reduction is 0, the probability is 7000. Guys, if the price reduction is 0, then the transaction price will be entire 5000 rupees per television. If the price reduction is 500 rupees per television, that means the price will be 4500. Then the probability is 20%. A price reduction of 1000 is also possible. That means where the television is only offered at 4000 rupee transaction price, having a probability of 10%. Determine the transaction price. Find out. So 5000 into 70% plus 4500 into 20% plus 4000 into 10%. Calculate and check. 5000 into 70% is 3500 plus 4500 into 20% is 900 plus 1000 into 10% is how much? 1000 into 10%, sorry, 1000 is the discount, right? 4000 into 10% is 400. That means answer is 4800 is the expected value. That is the expected value or the transaction price at which the manufacturer M shall recognize revenue. So manufacturer M will recognize revenue for 1000 televisions at the rate of 4800 per television. Therefore, the revenue will only be recognized to the extent of 48 lakhs and not 50 lakhs. Clear? After considering the relevant fact, M has expected value. Total predicted consideration will be entitled. As a result, the expected value is 4800 per television multiplied by 1000 televisions which are sold to retailer R. Therefore, the answer is 48 lakhs. A construction company C enters into a contract with customer E to build an asset. Depending on when the asset is completed, C will receive either 1,10,000 or 1,30,000. Guys, again, transaction price having multiple outcomes. What are the two outcomes? If you have completed within the particular time, then I will receive 1,30,000. If it is not completed, then if it is not completed within the given time, it is 1,10,000. So if the project is completed on time, 1,30,000. If project is delayed, 1,10,000. The probability that I will complete the project is 1,30,000 for 90% of the times. There is always a chance that I may not be completing the project on time, but the probability of occurrence is only 10%. In this case, do not go with expected value. Why not to go with expected value? Because the multiple transaction prices available here or multiple outcomes available here are only two. When there are only two possible outcomes, then instead of going for expected value, I will choose what is the most likely amount. What is the most likely amount here? 90% probability of occurrence is that the project will complete on time. Therefore, I will consider the transaction price as 1,30,000. If you would have multiplied with the probability, then your answer is wrong, because I will only multiply with probability when the number of outcomes in determining a transaction price are more than 2 in number. Then the probability multiplication will come up. Here only two outcomes, most likely amount and not expected value. Therefore, 1,30,000 is the most likely amount. Therefore, that is the transaction price at which the transaction shall be recorded or revenue shall be recognized. Look at question number 23. A franchisor Y licenses a right to operate a store in a specific location to franchisee F. The store bears Y Limited's trade name and F has a right to sell Y Limited's product for 10 years. F pays an upfront fixed fees, and the franchisee contract also requires Y Limited to maintain the brand through their product improvement, marketing campaigns, etc. Determine the nature of license. Again, this happens to be the same additional paragraph which was introduced by ICA, where we said licenses are of two nature, where there is a license of intellectual property as it exits at the point of contract or as the content gets created. So therefore, it is over a period of time or at a point of time. Now look at this question and let me assess or analyze in which category does this license fall. Y Limited has given license to franchisee F. Clear? So what is the right which is given? To use their intellectual property of Y's trade name. Okay, that means you use Louis Philippe or Arrow or any other brand that you want. You use it and you start selling the product. Provided, what is he saying? Y Limited will sell the product for 10 years. F Limited will sell Y's products for 10 years, and they will have to require Y Limited to maintain the brand through product improvements, marketing campaigns, etc. Therefore, here F Limited, when he is taking a license from Y Limited to use his trade name and also to sell his products, he is expecting the franchisor Y Limited to maintain his product improvements and marketing campaigns throughout. That is the reason why we will say that the entire contract is not to be recognized at a point of time, but should be recognized over a point of time. Clear? So here in this case, the license is required to be created over a period of time. This is exactly what we are saying. So the intellectual property is for over a period of license and not as it exists at a point of time when the license is granted. Therefore, revenue should be recognized over a period of time. Look at the question. Answer is estimate Y Limited assesses the intellectual property. F Limited accesses the intellectual property as it exists at any period of time on the license. This is because he is required to maintain, while he is required to maintain the brand which is significantly affected by the intellectual properties. Any action by Y Limited has a direct positive or negative effect on Y, and these activities do not transfer good and service to F. Therefore, Y recognizes the upfront fee over the entire 10 years of franchisee period. That is the reason why I stated that sentence. License provides F Limited to access the IP as it exists at any point of time during the license period, not as it exists at the point of time. At any point of time during the license period, however the license exists, he will start getting the benefit. We have seen Netflix example out there, if you remember, right? So as the content gets uploaded on Netflix, the viewer has a right to access such kind of information. Clear? Question number 24. Contractor P enters into a manufacturing contract to produce 100 specialized CCTV cameras for customer X at a fixed price of 1000 rupees per sensor. Q can cancel the contract without penalty after receiving 10 CCTV cameras. Specify the contract units. Guys, whenever I talk about a contract unit, then it should be a non-cancelable contract. A unilateral right of any party to terminate a contract without payment of any damages to the other party cannot be considered as a contract with customer at all. I'll repeat the sentence. I said, as a part of Ind AS 115, when we are looking at contracts, I said a contract which gives a unilateral right to any party in the contract to cancel the contract without payment of damages to the other party cannot be considered as a contract within the scope of Ind AS 115. Here, though the contract is for 100 CCTV cameras, which have a price of 1000 rupees per unit or per sensor, he is saying that Q can cancel the contract without payment of any penalty after receiving 10 CCTV cameras. So without payment of any damages to the other party, there is a right given to customer Q to cancel all further orders. Therefore, according to Ind AS 115, I will only consider the contract to be of 10 units itself. Here, read it. P determines that there is no substantive compensation amount payable to Q on termination of the contract, no termination penalty. It is akin to a contract to produce 10 CCTV cameras to give it to Q and an option to purchase the additional 90 CCTV cameras. Hence, the contract of 10 units. Clear? Yes, guys, so let's continue solving the questions. Let's look at question number 25 here. Software company S enters into a contract to license its customer relationship management software to customer B. 3 days later, they enter into a separate contract where S agrees to provide continuing services to significantly customize the licensed software to function in B's IT environment. B is unable to use the software until the customization services are complete. Now, should the contracts be combined or not? Guys, this combination and separating of contracts is a separate segment that we have discussed under Ind AS 115. Let's try to look at them in this perspective of question number 25. Both the contracts are entered into at the same time or near the same time. Yes or no? Yes. Because the second contract was entered into 3 days later. So it is not exactly at the same time, but it is near the same time. Second thing, the contract to sell the customer relationship management software itself does not benefit the customer. Very clearly, he stated down below, B is unable to use the software until the customization is complete. Therefore, both the performance combination are basically integrating to result in one single outcome to the customer. Therefore, both of them have to be combined to be treated as a single performance obligation. Third thing, they are not distinct. They are not distinct goods and services. They are highly interrelated and interdependent with each other. Therefore, we can say that both these contracts, one to supply the software, other one for customization contract, both should be treated as one single contract. Clear? That is question number 25. Look at question number 26 then. Manufacturer M enters into a contract to manufacture and sell cyber security systems to the government related entity P. 1 week later, in a separate contract, M enters into a contract to sell the same system to government entity Q. Both entities are controlled with the same government, and during the negotiation, M agrees to sell the system at a deep discount if P and Q purchases security software. Should the contracts be combined? Again, the answer is yes. They have to be combined. Why is that so? Though it is with two different entities, they are represented or controlled by the same government. And what makes you say that both should be combined? Because the price of one contract is significantly dependent upon the other contract. Look at the last sentence. During negotiation, M agreed to sell the systems at a deep discount if P and Q purchase the software. So that means the price of one contract is significantly dependent or interrelated to the price of the other contract. Therefore, these contracts are said to be combined because they are more or less entered at the same time, 1 week later. So near the same time is what we can consider. Therefore, the contract with entity P and contract with entity Q both are entered at the near same time, and the contract price or the transaction price of each contract is highly interdependent on the contract with another entity. Therefore, both the contracts should be combined for recognition of revenue for manufacturer M. Look at question number 27. Telco T Limited enters into a 2-year contract for internet services with customer C. C also buys a modem and a router from T Limited and obtains the title of the equipment. T Limited does not require the customer to purchase its modems or routers and will provide internet services to customers using equipment that is compatible with T network. There is a secondary market in which modems and routers can be bought or sold for amounts greater than scrap value. Determine how the how the performance obligation does T Limited, how many performance obligation does T Limited have? Guys, there are three things out here, or I'll broadly divide them into two things: modems and routers and internet connection. Remember, they can be the customer can benefit from the internet services alone with the help of the existing softwares or any other modems and routers which are readily available in the market. Yes, that means they are distinct. So the identification of distinct good and service has been met. Internet services, routers and modems are two distinct goods and services because C can benefit from modem and router alone and also from the internet services alone. They can take internet services from the company C, from that particular company T Limited, and they can purchase modems and routers from any other network or with readily available resources with the customer. Second thing, are they highly interrelated or interdependent? Absolutely no. Internet services can still continue if they have a separate modem and router which is compatible with T's network. Therefore, they are not highly interrelated or interdependent. Therefore, the supply of modems and routers and the provision of internet service, they have to be treated as distinct goods and services or separate performance obligations under the contract. V Limited grants customer C a 3-year license of an antivirus software. Under the contract, V promises C Limited with when and if available updates to that software during the license period. The updates are critical to be continued for the continued use of antivirus software. Determine how many performance obligations does the entity have. Guys, the software updates will be provided when and if available. Therefore, there is no compulsion on V Limited to provide its customer with those kind of updates. However, they have to be, they are critical for the continuous use of the antivirus software. However, I would say that the customer has been taking the license of the intellectual property as it exists at the point of time. Therefore, in this case, you can say that the V Limited can conclude that the license and updates are not separately identifiable because the software and service inputs are combined into one contract, and nature of V Limited's promise is to provide a combined antivirus software for a particular term of contract. Therefore, V Limited accounts the software and the updates as one single contract. Therefore, you will have to recognize revenue over the period of time, that is 3 years of license in this case. Clear? So because without the updates, then the critical use of the software will be defeated. Therefore, it is integral to a part of the particular contract, or the customer expects V Limited to keep on upgrading the software. Therefore, fundamentally, you can say that this is a contract or a license of intellectual property, to make sure that the software as it exists at any point of time during the contract, they're taking the license. Yes, guys. So let's continue to look at question number 29. So again, we are continuing with India's 115. A media company P Limited offers magazine subscriptions to customers. When customers subscribe, they receive a printed copy of the magazine each month and access to the magazine online content as well. Determine how many performance obligations does the entity have. Guys, understand there are two obligations which in the contract which applies to media company P Limited. What are the two obligations? One to provide a printed copy, other one to give an access to magazine's online content. Understandably, both are distinct from each other. How do you say that they are distinct? Because each of these obligations under the contract benefit the customer by itself. It does not mean that the online copy can only be deriving content with the help of a physical document, or the physical copy can derive benefit only with the help of online content, nothing as such. Therefore, both are distinct in providing benefit to the customer. Therefore, both these goods and services which are provided as a combination in the same contract, they are distinct from each other. Second thing, they are independent. Your online copy and your physical document are completely independent. There's no significant integration. They do not modify the content provided to the customer. So therefore, they are independent. They are distinct. Therefore, both your online copy as well as the printed copy should be treated as separate performance obligations within the contract under Ind AS 115. Look at question number 30 then. Software company K Limited enters into a contract with reseller D, which then sells software products to end customers. So K Limited sells to reseller D, D sells it to customers. K has a customary business practice to provide free telephone support to the end customers without involving the reseller, and both the reseller and the customer expect K Limited to continue to provide this support. Determine how many performance obligations does the entity K Limited have. K Limited has two obligations here. One is to provide the software, and second one is to provide a free of cost telephone support. So both these services have to be identified distinctly. Clear? Why? Because you need to understand that both these performance obligations are arising separately, and understandably, both the reseller and the customer is expecting K Limited to continue to provide this support. Therefore, this support, where I will start recognizing revenue over a period of time throughout the period for which such free of cost support has been provided. But the revenue for the product or for the software sold, I'll recognize at the time when the control is transferred to the buyer or the customer. Clear? A gym sells membership to for 7,500 rupees per year to 100 customers, with an option to renew at a discount for second and third year at only 6,000 rupees every year. Entity estimates an annual attrition rate of 50% every year. Determine the amount of revenue to be recognized in the first year and the amount of liability against the option given to the customers for renewing their membership at discount. So what is the revenue? What is the liability for the renewal discount? Both have to be ascertained. Look at it. First, the customer pays 7,500. Subsequent, for the next 2 years, he will be eligible to take the subscription only at 6,000 rupees per annum. That means they're providing a discount of each year at the rate of 1,500. But are all the customers going to renew? No, he's saying that the annual attrition rate is 50%. That means in the first year, if 100 people have subscribed to the contract or subscribed to the membership, then in the next year, only 50 people will basically take the subscription again at a discounted price of 6,000. The third year, out of this 50, only 25 will take the subscription. So 100 people who are subscribing on today's date will subscribe, 50 people will subscribe in year 2 and 25 people will subscribe at the end of year 3. 100 people in the first year will give you a contribution of 7,500 rupees per person, per membership. Second year, 50 people will give you 6,000 rupees per annual membership. Finally, in the third year, 25 people will give you 6,000 rupees of annual membership. That means the total memberships which are attributable to 100 memberships in year 1 is not 100 but 175, because there's a discounted membership offered in year 2 and year 3. So look at it, 100 into 7,500 is 7,50,000. 50 into 6,000 next year, they'll give you 3 lakhs. 25 into 6,000, third year, they'll give you 1,50,000. So that means 7,50,000 plus 3 lakhs plus 1,50,000. In total, they'll give me 10 lakh. Sorry. In total, they'll give me 12 lakhs as a total revenue. On how many subscriptions? The total subscriptions are 175, 100 customers, but 175 subscriptions over 3 years. That means the average cost is 6,857 is the price of each subscription to be spread over 3 years period. So 6,857 is the revenue to be recognized in the first year. But how much did you collect in the first year? 7,500. So recognize a journal entry now. Bank account debit 7,500. To revenue or sales 6,857. To liability for discount in subsequent years. What is the liability for discount in subsequent years? It is 643, I guess. Is the amount? Yeah, 643 is the amount of discount which has to be provided as a liability. Next year when he subscribes, he pays only 6,000, but my revenue shall be recognized to the extent of 6,857. That means bank account debit 6,000, liability for discount provided to the customer for subsequent subscription is 857, to revenue 6,857. This way I will recognize the record transfer entry in the subsequent years, that is year 2 and year 3. So though I collect only 6,000, my revenue will be recognized to the extent of 6,857 in both year 2 and year 3. So this is fundamentally the concept of revenue recognition whenever the customer has a right to avail discount in subsequent years. Customer D Limited provides advertisement services to customer. Okay, company D Limited provides advertisement services to customer. D enters into a subcontract with a multinational online video sharing company, and F Limited under the subcontract places all the advertisements of D's customers. D notes the following. D works directly with the customers to understand their advertising needs before placing the advertisement. D Limited is responsible for ensuring that the advertisement meets the customer needs after the advertisement is placed. D directs F Limited over which advertisement to place and when to place it. D Limited does not bear any inventory risk. There is no minimum purchase requirement with F Limited. D does not have a discretion in setting a price because the fees are charged based on F's scheduled rates. D is a principal or an agent. Now, what makes a huge difference? Does it make a lot of difference when I call about a principal and an agent? Yes, it does. If you say D is only an agent, who is acting as a mediator between the customer and company F Limited, then he shall recognize his share of revenue only to the extent of commission income. Only to the extent of commission income. Let's say I book the advertisement space on F Limited for in company F for 95 rupees, sell it to the customer for 100, then my commission is 5 rupees, which I will recognize. That is my revenue recognition concept. However, if you say D Limited is a principal and not the agent, then he will recognize the revenue for the entire 100 rupees and will recognize cost of goods sold or cost of services sold at 95 rupees. So recognition of revenue itself will significantly change whether D is an agent or a principal. In this given case, the one indicator which says D is just an agent is that D does not bear an inventory risk, but there is no minimum purchase requirement with F Limited. However, you cannot assess just based on one single sentence. Look at other things. First 2 points. D directly interacts with the customer to understand their advertising needs and is responsible for ensuring that the advertisement meets the customer needs. So it is his responsibility to ensure that the customer requirements are met. Second thing, he shall directly communicate with the customer to understand their needs and make sure that the D Limited will direct F Limited. Guys, if he was an agent, F Limited will direct D Limited to sell the space in a particular manner. But point number 3 is even more clear. D directs F Limited over which advertisement to be placed and when to place it. The first 3 sentences are more than sufficient for us to conclude that D is not an agent but is a principal. Though the last 2 points might indicate as if he is an agent, but the first 3 in substance are much more in proportion than the other 2. Therefore, I'll go with the substance over form. I'll create it. I will categorize D only as a principal in this case. Yes, guys. So let's start looking at question number 33 here. Now we are continuing with Ind AS 115 yet. So let's look at question number 33. An entity manufactures and sells computers that include an assurance type warranty for the first 90 days. So it's just an assurance that the product is working fine. There's any fault which I find in that particular product, either I return the product and replace the product or I get it repaired. The entity offers an optional extended coverage plan under which it will repair or replace any defective part for a period of 3 years from the expiration of the assurance type warranty. So after this 90 days, I have offered you an extended coverage which will be applicable for 3 years. Over that period, either there will be a repair or replacement of a defective part. Since the optional extended coverage plan is sold separately, the entity determines that the 3 years extended coverage represents a separate performance obligation. Absolutely true. Since it is sold separately, I have to treat it as a separate performance obligation, and such performance obligation of an extended coverage should be recognized as revenue over the period of the coverage. That means over the entire period of 3 years, I will recognize revenue. Look at it. The total transaction price, the sale of computer and the extended warranty together is 36,000. The entity determines that the standalone selling price of computer and warranty is 32,000 and 4,000. So exactly at the same price, if you add both of them, it will come down to 36,000. So that computer along with 90-day warranty is sold for 32,000. The 3 years extended warranty or extended coverage plan is sold for 4,000. The inventory value of computer is 14,400. Furthermore, the entity estimates that based on their experience, it will incur 2,000 in the cost of repair defects that arise within 90 days of coverage period for the assurance type warranty. So during that 90 days of assurance warranty, there will be an expected cost of 2,000 rupees per unit being met. Now, he's asking you to pass the required journal entry. Remember guys, this 32,000 I will recognize as revenue immediately on the day on which I have done the transaction. or I have completed the transaction. So here, look at it. First, how much did I receive? I received 36,000 as revenue. So bank account debit 36,000. Two, what is the credit which I have to give to? I'll have to give a credit to the sale for 32,000. I have to give a credit to the sale for 32,000 because that is representing the price of standalone price of computer. However, since I expect to incur 2,000 rupees for the period of the 90 days of warranty or assurance warranty, I'll have to recognize even this 2,000 as a cost. Therefore, what is the entry? Bank account debit 36, warranty expense account debit 2,000, to revenue 32,000, to provision for warranty expenses 2,000, to provision for warranty expenses 2,000, to revenue from extended coverage 4,000. This revenue from extended coverage will be recognized as revenue or will be deferred, will be recognized over the entire period of the coverage, that is for 3 years. Look at the entry that you have passed. Bank account debit 36,000, warranty expense account debit 2,000, to warranty accrued warranty cost of 2,000, to contract liability because he is deferring that recognition of 4,000 rupees for extended warranty over the period of the contract, that is 3 years. To revenue, immediately I will recognize 32,000 of revenue. The second entry is just an additional entry that he has passed. He wrote the entry as cost of goods sold to inventory to the extent of cost of inventory of computer, that is 14,400. That's an additional entry. The first entry is the most important entry. I'll repeat how he has written it. I sold a computer along with an extended warranty for 36,000. I collected 36,000. So bank account debit 36,000. Right? 2. 32,000 is my revenue from sale of computer to be recognized immediately. 2. Accrued revenue or liability for extended warranty 4,000, which I will recognize as revenue over the period of warranty, that is the entire 3 years, right? But there is a 2,000 rupee of estimated cost during the assurance warranty period. For such 2,000 rupees, I am adding an entry as assurance expense to liability for assurance warranty. Now, what is this liability for assurance warranty? He used the name accrued warranty cost because these are expected costs. So I'm creating a provision to that extent. Clear? Moving on. Question number 34. Entity sells 100 ultralife batteries of 2,000 each, provides the customer with 5 years guarantee that the battery will withstand the elements and continue to perform to the specifications. The entity, which normally provides 1 year guarantee to the customers purchasing the ultralight batteries, determined that the year 2 through year 5 represents a separate performance obligation. The entity determines that 1,70,000 out of the entire 2 lakh of transaction price should be allocated towards batteries and 30,000 towards service warranty based on the estimated standalone price and their relative selling price allocation. The entity's normal 1 year warranty cost is just 1 rupee per battery, which is immaterial among that entire 2,000. If you want to recognize, you recognize. Otherwise, you can leave it because it is immaterial. Even if you consider it as material, I'll give you what is a journal entry which is necessary to be passed. Pass the necessary journal entries. Pass the first entry. Bank account debit. How many batteries? 100 batteries, each battery of 2,000. So bank account debit 2 lakhs. 2. Revenue. Revenue from sale of battery to be recognized on the date of transaction based on your standalone selling prices and relative price allocation is 1,70,000. 2. Your contract liability or the extended guarantee liability is 30,000. This guarantee liability will be recognized as revenue from year 2 to year 5 over the period of the contract. Clear? Not at the point of contract. It will be recognized as revenue over the period of contract, that is for 4 years. Now someone will come with a question, sir, first year warranty you did not take into consideration. I will come to that. I said since the normal entity's warranty cost is only 1 rupee per battery, I would generally ignore that concept. However, since I have to recognize an entry, I'll recognize the entry like this for 100 rupees. What is the entry that you will recognize? it is 1 rupee per battery for 100 batteries. So I'll recognize the entry as warranty expense account debit to provision for warranty. That is 100 into 1 rupee per battery. That is 100 rupees. Clear? Guys, the answer is not 10,000 guys. That is 100 rupees because he has given it as 1 rupee per battery. So it is 100, not 10,000. It is 100. Look at question number 35. Production company Y sells a television show to a television company X. The consideration under the arrangement is fixed amount of 1,000 plus 100 advertisement slots. So the consideration is given in two forms: cash, non-cash. How much is cash? 1,000. How much is non-cash? 100 advertisement slots. They determine Y determines standalone selling price of the show to be 1,500, and based on market estimates, Y estimates that the fair value of advertisement slots is 600. Determine what is the transaction price. Here, to the extent of the non-monetary part or the non-cash consideration in the contract should be measured based on their fair value, which is already given to us as 600. Therefore, 1,000 rupees in cash plus 600 rupees is the fair value of the advertisement slot. The total amount is coming down to 1,600. If the fair value of advertisement slot is not given to us, then the straight standalone price of 1,500 will be considered as transaction price. However, since the fair value of the advertisement slot is given to us, the transaction price in the given question should be considered as 1,600. Question number 36. Customer C is in the middle of a 2-year contract with Telco Limited, its wireless service provider, and is required to pay an early termination penalty if it is terminating the contract today. If C cancels the existing contract with B Limited and signs 2-year contract with Telco D Limited for 800 rupees per month, then D Limited promises at the contract inception to give C a one-time credit of 2,000, referred to as port-in credit. The amount of port-in credit does not depend on the volume of service subsequently purchased by C Limited during the 2 years contract. Determine what is the transaction price. Look at what he's saying here. He's saying here that customer C is in the middle of a 2-year contract with Telecom B. Let's say Airtel. I am a customer. I have a 2-year contract with Airtel Limited. Okay, Airtel subscription of my mobile phone. If I do early termination and port myself to Jio, Jio is saying I will charge you a monthly cost of 800 rupees for a 2-year cost, for a 2-year contract. But since you're porting in from Airtel, as a token of appreciation for choosing Jio, Jio is paying you 2,000 rupees extra at the point of porting. Then he's saying it is not dependent on service subsequently. What should be the transaction price? You tell me what is the transaction price to the telecom company D Limited. If I am Jio, I am supposed to get from the customer 800 rupees over 2 years period. 800 rupees per month over 2 years contract, 24 months. So what is 24 into 800? 24 into 800 is, 24 months into 800 rupees is 19,200 is the transaction price of the contract. However, since you are porting from that network, I am giving you 2,000 rupees as incentive. Minus 2,000. Therefore, the amount of transaction price should be considered as 17,200. As 17,200. This 17,200 is for 24 months. Therefore, each month over the period of contract, when I keep recognizing revenue, then the transaction price of 17,200 should be recognized as revenue over 24 months on a straight line basis for telecom company D. Therefore, instead of recognizing 800, I will only recognize the revenue to the extent of 716.67 every month. Look at question number 37. Teleco G Limited grants a one-time credit of 50 rupees to a customer in month 14 of a 2-year contract. Month 14 is somewhere during second year, another 10 months to run, because 24 months, 2 years contract. The credit is discretionary and is generated as a commercial gesture, not in response to a prior service issues, often referred to as retention credit. The contract includes a subsidized handset, a voice, and a data plan. G Limited does not regularly provide these credits, therefore, customers do not expect them to be granted. How this has to be accounted for as per Ind AS 115. Guys, this 50 rupees of one-time credit, which is generally granted on month 14 of a 2-year contract, I'm saying it is at the discretion of the company or the Teleco G Limited. The customer, as whoever is in the contract, is not expecting such a credit to occur to him in the during month 14. Therefore, it cannot be considered as a part of transaction cost. It is purely discretionary in nature, cannot be considered as variable consideration. Clear? It cannot be considered as variable consideration. It is purely discretionary in nature. Therefore, in this case, the transaction cost should not be reduced by that 50 rupees of one-time credit. What if a customer gets what if the telecom company G Limited provides a one-time credit to any customer? In such cases, I will always call this as a contract modification, a modification in the terms of the contract. Then what should I do? Whenever there's a modification to a contract in month 14, then the contract modification which alters the transaction price, because the further transaction price should be reduced by 50. It has to be allocated over the remaining contract life, which is 10 months. Just to help you with an example, guys. Here numbers are not there, so let me take some example and I'll give you. Let's say, for example, what is a contract period or contract term? My contract period is 24 months, right? I am attaching this. I am saying the price in the contract is, let's say, 200 rupees per month. So what is the total transaction price actually? Transaction price is equal to rupee 4,800. How many months? Over 24 months. So what is the revenue to be recognized? Revenue recognized over the period of contract is equal to 200 rupees per month. I'll keep on recognizing revenue. Like this, 200 rupees per month, 200 rupees per month, I kept on recognizing until month 14. Exactly during month 14, there is a contract modification. What is a contract modification? Contract modification arises due to a credit of 50 rupees. Credit to customer is 50. What is the balance revenue to be recognized? How much did I recognize? 200 rupees per month. I kept on recognizing. How many months did I recognize? Over 14 months I recognized. So how much did I recognize so far? 14 into 200, which is exactly 2,800. Out of the total transaction contract value of 4,800, which is the total transaction price, minus I recognize for 14 months 200 rupees per month. Therefore, the total amount which I already recognized was 2,800. and the balance revenue to be recognized was 2000. What is the modified transaction price? My modified transaction price is rupee 1950. Remaining contract term how many months are remaining? Out of 24 months, 14 months is already done. So balance 10 months is left. Therefore, revenue to be recognized, revenue recognized over the remaining contract life is 195 rupees per month. So every month after that 50 rupees of credit, if it was allowed to a particular customer, instead of recognizing a revenue of 200 rupees per month, I will allocate it over the remaining contract term, which is 10 months. Therefore, I will start recognizing a revenue of only 195 instead of 200 rupees per month over the remaining contract term, that is 10 months. This is typically the change which occurs whenever you have a modification in the transaction price during the period of the contract. Now, let's look at Ind AS 102. Now, this standard talks about share-based payments. Guys, a share-based payment is basically where it is a non-monetary consideration. I have received goods from a supplier. That supplier is basically issued some shares. I have received a debt from a party and I have issued shares towards that. So these are payments which are based on shares instead of paying them consideration in the form of cash. Guys, though predominantly this topic of share-based payments might talk about everything, the more concentration part should be among ESOPs. Those share-based payments which I make to employees is the major concept of consideration here. Majority of your questions are also tested only based on your share-based payments to employees. Now, what is your share-based payment to employee and why does it even become such an important concept? On today's day, you observe that a lot of people change their companies very often. They'll say 30% hike, I jump from this company to other. So every company faces a very significant challenge regarding their human resource policy, regarding how to contain their employees or how to reduce their employee turnover. What is employee turnover? That number of times at which I have to replace a particular employee or the time period for which a particular employee is leaving the organization is basically my employee turnover. So to reduce my employee turnover, what are the significant approaches that an enterprise has to adopt is basically a big challenge on today's date. This challenge can be overcome with the help of ESOPs. ESOPs on today's date are quite widely prevalent. But understand, I deal with a lot of startups and most of the startups have this problem that the employee will definitely get a better pay packet outside in a multinational company than in a startup. Then how can a startup actually retain an employee? To retain an employee, the startup generally starts allocating certain options to the employees to exercise the shares of this company. So probably let's say at the time when Flipkart started and I have actually exercised shares in that particular company at the beginning, by the time actually the exit came up, I might have been left out with at least 5 to 6 crores for the options which I hold. So what is happening because of this? I am getting a lump sum cash flow or I am getting a consideration other than a salary in the form of a lump sum cash flow received at the time of investments. That is particularly a reason why your ESOPs have become very, very prevalent on today's date. Now, when I talk about ESOPs, these ESOPs are broadly broken down into two parts. I'm talking about the concept of share-based payments to employees. I will broadly break down these share-based payments to employees into two aspects. The first aspect is called as an equity settled plan. It is called as an equity settled plan. The second aspect is called as cash settled plan. What is the significant difference between these two plans? Equity settled plan means I will deliver to the employees certain number of equity shares. Under this share based payment option, I am delivering or I am issuing certain number of shares to my employees. The other one is called as cash settled plan. What is a cash settled plan? Cash settled plan occurs whenever you come across a situation where I am not allotting shares to the employee, but I am giving them a worth of shares in cash. Let's say, for example, I've given an employee to exercise the shares of my company at a price of 80 on a future date, let's say on 31st of March 2022. On 31st March 2022, let's say the market price of my company is 92. So what I'll say, you have a right to buy the share at 80. Today's current market price is 92. Therefore, instead of you paying me 80, I allotting you share, I will directly pay you 12 rupees as settlement. These are called as cash settled plan. And equity settled plans are generally called as ESOPs. Employees stock option plan. While your cash settled plans are called as SAR, stock appreciation rights. Stock appreciation rights. So I'm saying either there could be an equity settled plan or a cash settled plan. Whenever I'm talking about share based options. One more concept does arise where there is a combination of both. Equity settled plan with cash alternative. I'll talk about this later, but this is also a possibility. Okay, but broadly leave this concept right now. I'm not going to concentrate on this topic. I'll only concentrate on these two topics of equity settled plans and cash settled plans. They're either called as ESOPs or they're called as SAR, stock appreciation rights. Now, in either situation, there is a particular accounting treatment that I have to adopt. Let's see. Let's say, for example, on 1st April 2021, I have announced a particular plan, and my plan went like this. The plan was 1,000 options to 100 employees. 1,000 options to 100 employees. That means I have a total of 1 lakh options at a price of rupee 50 per option. Okay. This 1 lakh is basically called as options granted. This 50 rupees here per option, which is supposed to be paid to exercise that option, is called as exercise price. The price at which the employee can subscribe to that option is called as exercise price. Now, let's say I said that these options can be exercised. Today, a person joined the organization. He is entitled to those 1,000 options. He subscribed by paying 50,000. He exited the organization in the immediate next day. Purpose not served. That is the reason why whenever these options are granted, they always come with an attached condition. They always come with attached condition. Let's say the condition which he has attached here is continuous employment for 3 years. This is called as service condition. A condition which is based on the service of the employee. This way, continuous employment is called as a vesting condition. It is called as vesting condition. How long this vesting condition should be satisfied? For a period of 3 years. This is called as vesting period. So what is a vesting condition? Vesting condition is a condition which has to be satisfied for an employee to be entitled to receive the options. Let's say, for example, so 3 years starting from 1st April 2021. So 1st April 2024 is basically called as my date of vesting. It's generally a tendency for the employer or the company to allow a certain time period before which they have to exercise these options. So though they are vesting on 1st April 2024, the enterprise will come up with a logic saying that you can exercise these options up to 31st of March 2025. 1 year time period I have given. This 1 year time period is generally called as exercise period. Remember, an employee will exercise his option to subscribe for the shares of the company only if the market price of the company is is greater than the exercise price. I'm saying an option will be exercised only if the exercise price is less than market price. So therefore, obviously the exercise price is generally less than the market price. Now, if I would have issued in open market, I could have issued the share at 100. But now, since I'm giving it as a share-based payments to my employees, I'm issuing it only 50 rupees. So I am receiving 50 rupees less for each share. This difference is basically considered to be a loss to the company. Loss to company, which is purely notional. Notional loss is nothing but market price per share MPS on date of exercise of options minus exercise price per option the difference between the market price and the exercise price is loss per option multiplied by number of options exercised. For each option exercised, the loss to the company is the market price on date of exercise minus exercise price. Now, it is a loss. When do I know that the company has made a loss? I know that the company is going to make a loss on the grant date itself. On 1st April 2021, which is my grant date, that date itself when I granted the option, I know that the company will definitely make a loss in future. Conservatism concept, when you know that there is a future loss, you will have to provide it for. So therefore, as on 1st April 2021, when I'm trying to estimate the loss, I cannot estimate the loss. You'll say, why you can't estimate the loss? Because this market price is on the date of exercise of option. Do I know when is the option exercised? The option is exercised somewhere between 1st April 24 to 31st March 25. Here there will be exercise of option. You standing on 1st April 21 know that there is a loss. You are trying to estimate the loss which it would occur after 3 years. How do I estimate? Do you know? If I really know like that, then I will basically start doing stock trading only, right? So when I don't know, that is where I have to bring up this concept. Since this market price minus exercise price cannot be identified, I will estimate it based on something called as fair value of option. What is your fair value of option? It is the estimated market price on date of exercise minus exercise price per option. So I'm estimating using fair value of option. This fair value of option should be determined using option pricing models. Your option pricing models, Blacks and Scholes, binomial model, all that you'll read as a part of financial report, your strategic financial management, the same thing has to be applied in determining what is a fair value of option. Regarding this concept of number of options exercised, I don't know unless and until the options are actually exercised. Therefore, this I will try to estimate based on number of options which are expected to vest. How many employees are expected to satisfy the vesting condition? How many options are expected to vest? Based on which I will start calculating what is my loss to company. So my loss to company can be given as number of options expected to vest multiplied by fair value of option. If in case I'm saying if fair value cannot be determined, normally for us it will be given in the question only. If it is not given or if it cannot be determined, use intrinsic value of option. What is intrinsic value of option? Intrinsic value of option is without taking any estimate. Without taking any estimate, I am trying to identify the loss. How do I identify here? The intrinsic value of option is equal to market price per share on grant date. This is today's spot rate minus exercise price per share or exercise price per option. I will use this intrinsic value only if I do not know what is fair value. My first priority is always towards fair value of an option, and the loss to company is equal to fair value of an option multiplied by number of options expected to vest. When should I estimate this? This estimation of loss to company should occur on the grant date, on the day on which the options are granted. This is estimated future loss. When will the loss occur? The loss will occur anytime between 2024 to 2025. So what am I saying? This loss is expected to occur after 3 years. So by conservatism concept, I'll have to recognize this loss today only. So what I'll do? This amount of loss to company which is computed as above, either using fair value per option or using intrinsic value of option, should be charged to P&L. Should be charged to P&L, absolutely, because it is a future estimated loss. So I am directly charging it to P&L, applying the concept of conservatism. But when is this loss expected to occur? This loss is expected to occur in 2024-25, 3 years later. So what is the point of debiting the P&L at one shot? So he says this loss to P&L should be charged over the estimated vesting period, the period for which vesting condition is expected to be satisfied, on a straight line basis. In this question, when I said that the loss will occur after 3 years, that 3 years is the vesting period. So whatever loss you estimate, you will have to make sure that you're allocating the loss to each of those 3 years on a straight line basis. Clear? Got the concept? Now, let's say for example, number of employees on grant date, guys, 1st April 21. I already told you number of employees are 1000. Options per employee are 100. Exercise price of each option exercise price is 50. Let's say my fair value of option determined as per option pricing model was 70, or let's take 30. Vesting condition is continuous employment and vesting period is 3 years. Estimated employees leaving the organization. Estimated employees to leave within 3 years. In year 1, I estimate that there will be about 40 employees who will leave. In year 2, I am estimating that at least 60 will leave. But finally, when it came to year 3, the actual number of employees who left the organization without completing the 3 years of continuous employment was actually 75. Now, I am expected to solve this question. How do you solve? Look at the formula or look at the way in which I solve. 3 years, write down first each balance sheet date. What are your balance sheet dates? 31st of March 2022, 31st of March 23, 31st of March 24. First, start with number of employees expected to satisfy vesting condition. Number of employees expected to satisfy vesting. How many employees were there actually? 1000. But out of 1000, I am saying first year 40 could leave. That means how many employees could complete vesting? 960. Second year, I am estimating 60 people will leave within 3 years. So it became 940. Third year, 75 people left. 925. This is the number of employees left. Or number of employees who are expected to satisfy vesting condition. This is my part A. Part B. What is the number of options per employee? If I multiply the number of employees with options per employee, I will get number of options expected to vest. Number of options which are expected to vest. Options per employee, I have already given you at the beginning, 100 options per employee. 96,000 options expected to vest, 94,000, 92,500. These are the number of options which I am expecting to vest. To identify the total loss to the company, I'll have to multiply it with fair value of option. What is your fair value of option? I've already given you fair value of option is 30 rupees. Multiply and you should be able to get what is the loss to the company. What is the total cost to the company? Calculate, multiply. This is 28 lakh 80,000. This is 28 lakh 20,000. And this is 27 lakh 75,000. Check, is that correct? Last one I'm doubtful. 92,500 into 30. Yep, 27 lakh 75,000. These are the total losses expected to the company. Total expected loss or total expected cost. I'll call this as staff cost because I'm giving it to employees. I'm considering it as staff cost. Clear? To give a separate name for this staff cost, I can use two languages: employee compensation expense or employee benefit expense. Ultimately, it's an expense. It is staff cost. As simple as that. This loss has to be allocated over the entire vesting period on a straight line basis. So what is vesting period? Vesting period is 3 years. Correct? This vesting period has to be, this entire loss should be allocated over the vesting period. So cumulative cost or staff cost, to be more specific, to be recognized. First year, one third of the staff cost should be recognized. So 28,800, or 28 lakh 80,000 into 1 by 3. By the time I come to the second year, it should be 28 lakh 20,000, but 2 years is completed. So 2/3 of the provision should be created. Last year, 27 lakh 75,000, entire thing is completed. So entire 3 by 3. This is the cumulative cost to be recognized in the P&L. First case, can you tell me the answer? In the first case, multiplied by 30. This is 9 lakh 60,000. This is 18 lakh 80,000. Last one, complete amount of 27 lakh 75,000. This should be the amount of provision or amount of cost which should have been recognized in the P&L on a cumulative basis. Therefore, less amount already recognized in previous years. First year, I did not recognize anything in the last year. Therefore, I'll have to identify amount charged to P&L in current year. Amount which is charged to P&L in current year. Calculate. First year, I need a total amount of 9 lakh 60. Last year, I did not provide anything. Current year, you provide entire 9 lakh 60. By the time I come to second year, last year, I already provided 9 lakh 60. I should totally provide 18 lakh 80. Therefore, in the second year, I'll only provide 9 lakh 20. Third year, I have to provide 27 lakh 75 on a cumulative basis. Last 2 years, already 18 lakh 80,000 has already been created as a provision. So therefore, 8 lakh 95,000 of provision is supposed to be created in this way. I'll identify the amounts to be recognized in P&L each year. So when I'm charging it to P&L each year, I'll have to recognize an entry. So I'll have to debit the staff cost. Instead of writing it as staff cost, the standard prescribes the language to be used as employee benefit expense. Use whatever they ultimately you will charge it off to P&L only now. So what difference does it make? Employee benefit expense account debit. Now this is only a provision should be kept to be kept. I'm recognizing this entry in year 1, that is for the year 21-22. I'm only creating this provision because the actual loss will occur after 3 years. So until the actual loss occurs, I'm just parking this loss. So I'll park this loss into an account which is by name known as share based payment equity. Year 1 in the year of 21-22, I'll recognize this amount for 9 lakh 60. I have credited share based payments equity, which should be shown under presented under other equity. Why should it be presented under other equity? because this is purely of nature of purely a nature of equity share capital. So it is shareholder funds. Therefore, I'm looking at to be presented under other equity. But let's say the employees are not having an option to exercise these shares, but they have a right to receive cash settlement. That means these are not options, but they are rights, stock appreciation rights. In such case, I have a company as an obligation to pay cash. Therefore, it should not be equity, it should be liability. In such case, I'll write it as share based payment liability account. Why do you write it as liability? Because I'm saying that sometimes there could be share based payments which are equity settled or sometimes cash settled. If it is ESOP equity settled, then I will transfer it to share based payment equity. If it is SAR cash settled, then I cannot transfer it to equity, but I have to transfer it to liability. So it should either be presented under current liability or non-current liability. Clear till now? Any doubt till now, please let me know. Any doubt so far, please let me know. Now, until now, whatever we discussed is a simple concept of how do we record. But there are two things that we have to get into now. One, what happens when they exercise the option? Second one, what happens then when they lapse the option? First, I'll talk about this lapse of option. Lapse of option can occur in two instances. One, where the employee is not meeting the vesting condition itself. That means he is not sticking in the company for 3 years, then obviously they lapse. Or number two, He was there in the organization for 3 years, but he did not want to take up ESOPs. He did not want to pay that 50 rupees per share. So there also they can lapse the option. So two ways there is a lapse which can happen. One, unvested option can lapse when the vesting condition is not satisfied. Vested option can lapse if they are not exercised. Both the situations are very much possible. Let's see what we do when there is a situation which emerges like that. First, let me talk about exercise. Let's say that every option here has been exercised. Let's see what is the entry that you pass in year 4. That is in 2024-25. 24-25. This is the year. Let me record entry. First, I'll have to collect 50 rupees from each person. Bank account debit. How much will I collect? 50 rupees into number of employees who are actually satisfying the vesting condition. Assuming that there is no lapse, 925 employees have satisfied the vesting condition. So 925 employees. Each employee is entitled to receive 100 rupees. Calculate 925 into 50. 925 into 50 into 100 is 4 lakh 60. Sorry, in 46 lakh 25,000 is the amount. 46 lakh 25,000 is the amount which the company will collect. They have an obligation to allocate shares, but don't forget there is a loss which you have already recognized. You have to reverse the loss. So SBP, I'm writing in short, share-based payments. Share-based payment equity account debit. How much provision did I create that I have to reverse? I've created a total provision of 27,75,000 over 3 years. First year 960, second year 920, third year 895. The total is 27,75,000. So that 27,75,000 of provision which I created for these share-based payments, I have to debit it. I have to nullify because they're exercising. Once they exercise, they are entitled to receive equity share capital. How many shares? 50 shares. I'm sorry, not 50 shares. 925 shares or 925 employees. Each one entitled to receive 100 options. Let's say face value of each share is 10. Therefore, they will get 9 lakh or 92 lakh 50,000. Or no, 9 lakh 25,000. The balance will be considered as my securities premium. The balance to the credit should be considered as my securities premium. Balancing figure. Pick it up. How much? ₹64,75,000. This is the entry which I will recognize whenever the options are exercised. But this is only possible when these are considered to be ESOPs. That is equity settled. If I assume that these are not ESOPs, but instead they are SAR, then what I'll do? Net cash settlement should happen. So I'll debit share-based payment liability account. I've created a liability here. It was not equity. And I will credit it to bank because I'm paying them in bank in net cash settlement. Amount, the total amount of provision which I created, that is 27,75,000, will be paid off to my employees. Clear? Now let's come to this concept of lapse of options. I told you that there are two lapses which can occur. One, an unexercised option can lapse. An unexercised option can lapse whenever I can come back, whenever they do not satisfy the vesting condition. Unvested option can lapse when they don't satisfy vesting condition. Unvested options if vesting condition is not satisfied. Same way, there can be a lapse of a vested option if the vesting condition is not satisfied, but if they are not exercised. Within the vesting period, I've given you 1 year to exercise it. Within the exercise period, if they are not exercising these options, automatically at the end of the exercise period, that is 31st March 2025, these vested options shall lapse. If there is a first type of lapse, that is where the unvested options lapsed when the vesting condition is not satisfied, here there is no separate accounting. Then what do you do? In this case, without doing a separate accounting, I will adjust it against the provision to be created for subsequent years. Adjusted against provision to be created in subsequent years. Look at this problem which we have solved just now. There was a lapse, right? The number of employees which was considered as 960 has reduced to 940, 20, reduced to 925, reduced by 15 again. So if you look at the provision to be created, initially I created 960. But subsequently what happened? Automatically I created only 920. If you look at, actually the total amount to be created is 18,80,000 over 2 years. Guys, 18,80,000 if I create over 2 years, each year I should have created a provision of 9,40,000. But first year I created a provision of 9,60,000. Extra 20,000 provision I created. So that's why when it came to the second year, instead of creating 940, the excess provision of 20 was reduced and the amount of provision is only 920. If I have to create 27,75,000 over 3 years period, then that means I'll have to create only a provision of 9,25,000. Correct? I'll only have to create a provision of 9,25,000. But look at what happened. While creating this 9,25,000 of provision, I created an excess provision of 9,60,000, which is 35,000 in excess. Second year, I only created 9,20,000, 5,000 deficit. So therefore, 30,000 excess provision is still existing. That's why instead of 925, I created only 895. So whenever there is a lapse, instead of writing a separate accounting entry, I'm just adjusting it against the subsequent year amount of provision. That cannot be possible in this case. When the vested options are not exercised within the exercise period, in such cases, accounting entry to be recognized is, I've already created a provision in form of share-based payments equity. I don't need now. So share-based payment equity account debit, I don't need that amount anymore. Earlier when I created this provision, I created it through P&L. So either I'll give it back to P&L or you can give it back to general reserve. Now, someone can come up and say, sir, what if stock appreciation rights are not exercised? Right? Stock appreciation rights will anyways be exercised because it is a right to receive cash. Who will say no to cash? So, share based payment liability, which is created for a stock appreciation right, there cannot be a lapse. There cannot be a lapse. They will definitely accept that cash. Therefore, there cannot be a lapse, no accounting entry. But when it is employee stock option plan, there can be a lapse. In such case of a lapse, I'll recognize a separate accounting entry where I debit the share-based payment liability and I credit it to either the general reserve or the P&L. That is your wish. Clear? This will bring us to the end of the concept regarding accounting for a share-based payment. There are also topics that we have to look at. One is regarding modifications and cancellations, and one more which we have to look at is the relationship between a parent and the subsidiary. Clear? So we have seen already the basic structure of how Ind AS 102 should be accounted for. Now I'll add one adjustment that is called as modifications to an option or a share-based payment. A share-based payment plan, if it undergoes any modification, how does the accounting really occur? Modification in share-based payment plan. Now, generally the modification can occur in this way, that suddenly the company comes up and says that probably the exercise price has to be increased, or sometimes let's say the market price of share has come down, so the exercise price is reduced, or sometimes they can come up and say that I don't think so I can afford this share-based payment plan, so I'll have to scrap off this plan. So this way the modification can be broadly divided into two categories. The first category where there could be an increase or decrease, where there is an increase or decrease in the fair value of options or sometimes there is a cancellation of a plan. That means the benefits of the plan are not eligible to be received. The plan is cancelled. The easiest to discuss is cancellation because there is no further accounting treatment out there. So whenever there is a cancellation which occurs, then the provision existing on the date just a second. Yes, guys. So what we were discussing was regarding modifications of a share-based payment plan. There could either be an increase or decrease in the fair value of an option. Suddenly there is a fall in the fair value of the shares or market price of a share. So I change the exercise price. Automatically the fair value of the options will increase or decrease. Sometimes there could happen where I included more number of employees who are eligible to receive the plan. Then automatically there's an increase or decrease. Sometimes there could be a cancellation of plan itself. Whenever there is a cancellation of plan, that means the enterprise is saying that they cannot continue with the plan anymore. In such cases, the provision which is already recognized in previous years should be reversed. That means as good as a lapse of options. As good as a lapse of options. So I'll write the entry as share-based payment equity or share-based payment liability account debit to your P&L or general reserve. This happens whenever there is a cancellation of a plan. Let's say I have an increase or decrease in fair value. In such case, where I have an increase or decrease in fair value, such increase or decrease again it's signed out, sir. So we are coming up with the logic to say that sometimes there is a modifications to the share-based payment plan. What do you mean by a modification? A modification in the sense that the plan which was announced initially, there is a change in the plan. What changes can occur? The change can occur where there is an increase or decrease in fair value. What do you mean by increase or decrease in fair value? That means the number of people who are entitled to the plan have increased or decreased, or the fair value of the options in the plan have increased or decreased. Exercise price changed. Automatically, there is an increase or decrease in fair value. Sometimes there can be a modification which might lead to cancellation of the plan itself. That means the plan has been announced in such a way that the benefits under the plan are not eligible to receive anymore. The company is not in a position to pay the benefits. In such cases, automatically the plan gets cancelled. If the plan is cancelled, then the provision which I already recognized in the previous year should be reversed. But whenever there is an increase or decrease in the fair value of an option, such increase or decrease should be recognized in P&L should be recognized on in the P&L on a prospective basis. That is, what do you mean by prospective basis? Subsequent provision, that is subsequently recognized in P&L on straight line basis. Let us understand this. What is the subsequent recognition in the P&L on a straight line basis? Let's come to this logic. Let's say, for example, benefits of share-based payment plan are going like this, where the number of options are let's say the number of options are about 1000. Okay. And let's say fair value is 80. Okay. Vesting period is 5 years. Okay. Subsequently, somewhere in year 3, let's say after 2 years, year 3, there is a modification to the plan. Modification. This modification has given rise to increase in fair value, rupee 30 per option. In such case, how do I recognize the amount to be recognized each year? Now, forget about this modification. Without modification, you tell me first. Without any modification, 80 rupees is the value of the option, fair value of the option. Therefore, each year, how much should I recognize? 80 into 1000 divided by 5. Recognize in P&L each year. How much? 1000 options. 80 rupees is the fair value per option divided by 5, which is nothing but 16,000. This will not change even after modification. Then what will happen with the modification? For the modification, I'll have to apply a prospective basis. So what is your prospective basis meaning? Prospective basis means recognize in P&L from year 3 to year 5 only. Prospective. This is what I meant by the word prospective. How much will I recognize? Calculate. 1000 options. Increase in fair value per option 30. Remaining vesting period 3 years. Therefore, the amount to be recognized in P&L each year is 10,000. This 10,000 should be recognized only from year 3 to year 5. But for that 16,000, from year 1 to year 5, I'll recognize 16,000 only. So year 1 and year 2, I'll recognize only 16. Year 3 to year 5, I'll recognize 16. Plus additionally, I will recognize additional 10,000. So from year 3 to year 5, 3, 4 and 5, instead of 16,000, I'll recognize 26,000 in the PN. Clear? This is the concept which emerges due to modification. Whenever there is an increase or decrease in fair value, it should be recognized in P&L on prospective basis. That means subsequently recognized in P&L on a straight line basis. So whatever has already been done pre-modification, that will not change. Clear? So sometimes there can happen a situation where the employees of the subsidiary are given option to subscribe the shares of parent enterprise. It is the parent who is giving the shares, but it is the employee of the subsidiary. Where is the employee cost recognized in the subsidiary? But whose shares are being diluted? Parent enterprise. Now this becomes a very interesting contention. Let's take this with the help of an example. Let's say, for example, I have a situation where a parent enterprise and there is a subsidiary. To the employees of the subsidiary, employees of S, the options are given by parent. Options of parent. Where is the employee cost recognized? The employee cost should be recognized in subsidiary. The equity shares are flowing from the parent enterprise to the employee, while the employee cost recognized in the subsidiary. Therefore, you will have to recognize a transaction between the parent and the subsidiary. What is the transaction which I will record? To the extent of fair value of shares issued, I'll record it as an investment in the subsidiary in the books of parent. Fair value of shares is equal to investment in subsidiary, which will be recorded by the parent enterprise. Subsidiary will also record something. Subsidiary, because they have taken the shares from the parent to be issued to their employees, they will recognize it as other equity. Let me give you an example to explain this situation. Let's say, for example, the parent has offered about let's say 1,000 shares of parent enterprise to employees of the subsidiary. At the rate of an exercise price of 50 rupees per option. Let's say the fair value of option is rupee 20. In such situation, if I have to go for a recording for this transaction, how do you record? Look at the books of P Limited. P will record this entry as like this: to equity share capital, to securities premium, debit, bank account debit to the extent of 50 rupees. 50 rupees on 1,000 options is 50,000. 1,000 shares of 10 rupees each is 10,000. But don't forget, there is a loss to the company for approximately 20 rupees. This loss to the company should be recorded as investment in P. Why am I debiting investment in P limit, investment in S? Because the cost will be actually recognized by the subsidiary. So therefore, P cannot debit the provision. The provision is in the books of subsidiary only. Therefore, investment in S to the extent of 20,000, 20 rupees of 1,000 shares. Therefore, 60,000 is my securities premium. Similarly, what will S Limited record? S Limited will record staff cost or your expenses, employee benefit expense, account debit. How much will they record? The staff cost is how much? To the extent of the fair value of option, that is 20,000. But they did not issue the share. So you cannot credit to your share capital. Therefore, I will present it as other equity. In other equity, I'll present it, and the value to be presented in other equity is 20,000. Here, let's say for suppose subsidiary is reimbursing the parent enterprise to the extent of 50% of cost. How will your entry change if subsidiary is reimbursing the parent enterprise to the extent of 50% of cost? If that situation happens, instead of this 50,000, it will become 60,000. 50 which I received from the employee, 10 which I received from the subsidiary. My investment in subsidiary will now be only 10, because out of the fair value, 50% is reimbursed by the subsidiary and only 10 rupees will be the cost. And if I look at this cost, staff cost is 20,000 rupees, correct? But I'll also record to bank 10,000 and this will be only 10,000. This would be my situation if I am saying 50% of the cost is reimbursed by the subsidiary to the parent enterprise. Clear? So this is one more adjustment which comes up. Whenever I'm talking, the parent is issuing the shares or issuing options to the employees of the subsidiary as a share-based payment option. Clear?